Hello, good morning, dear students. My name is Balasubramaniam, the senior faculty in Masterminds. So, in this video, I'm going to take financial management marathon classes. Dear students, the surprising of this marathon classes is if you go with this from all the classes, right? All the classes, including all the hours, then you won't find any surprise in public exam. Because I'm standing in front of you to take this video after going with RTP, MTP, past exam, past exam question paper, study material, and along with our mastermind material, right? By keeping the examiner standard and by keeping the past exam trend, right? I'm going to give you the fundamentals and conceptuals of financial management where you never feel surprise in coming exam. It's my promise, keep it in mind. And before that, right, after watching this entire my financial management marathon class, you will get voice from here that yes, at any cost, I'm going to clear financial management. But the thing is, I need much attention, much attention. Take a notebook and make all the concepts, and certainly you will get better judgment. It's my promise. Right, dear students, financial management, right? Financial management. It is one of the important subject, the subject of decision making actually. Coming to CA Inter Financial Management, how it related to exam, I'm going to discuss. Right, in CA Inter, financial management comes in Group 2. Okay, Group 2. Its weightage is nothing but 60 marks. So we have to score 60 marks. It's weightage. Right, then you have to understand before going to get the question paper, try to understand before going to clear the question paper, we should understand the pattern of question, right? For example, a cricketer goes to play cricket, right? Before playing game, right? He will have his own game plan. Being a financial management student also, we must have what is the question paper we are going to answer. So how this question paper is, instead of running without proper plan, right? You will face big clash, right? Then we should go into discuss now financial management question paper pattern. Question paper pattern. How this question paper pattern would be, dear students? Let's move here. Here, the question paper would be like this, dear students. Number one, first question consists 20 marks. First question consists 20 marks. In this question, you will find 4 questions. Each question carries 5 marks. That means 20 marks you are going to get it. Now you have to make a plan from which chapter, which concept may have a chance to ask 5 marks. You must able to judge now itself. Yes, whenever you will open a study material or material, you should able to identify it. Could it possible to ask this question for 10 marks or 5 marks? You must able to identify it. That is, so question number 1, you will have a 4 questions. Each question carries 5 marks, 20 marks. Total weightage is 60. Out of 60, 40, 20 marks you already covered. Next question number second. Under this category, you will have second question number. This is for 10 marks again. So question number 2. Question number 3, 10 marks. Question number 4, 10 marks. Question number 5, 10 marks. Question number 5, 10 marks. Question number, already you see, 10, 10, 10, 10. Okay, 40. 40 plus 20, 60 marks. There the paper is finished. It means that first these four questions are there. No, sir. Balu sir, is it a theory or problematic? Absolutely problematic, dear students. What about this 4 questions? Theory or problematic? Absolutely problematic, dear students. So it means that financial management is a completely problematic chapter. Not chapter, subject. If you are good at with the problems, keep it in mind, you are good at problems, right? 100%. If you are good with the problem, you can get the 60 out of 60 by solving the problems. But you have last question number 6. Sometimes, dear students, among these 4 questions, right? Any question, if you feel very difficult, concept is not clear, problem is not clear, or sometimes the examiner gives or examiner designs in such a way that by solving the question you cannot solve the other questions because it would be not only complex but also comprehensive. In such a situation, you better to skip. Better to skip. In such a case, what should I do, sir, for the 10 marks? Better to come to the question number 6, right? Question number 6, you will find 10 marks theory questions. Yeah, under this question number 6, first category you will have theory 4 marks question. Another one is a 4 marks again theory question, and C question would be there. This is for 2 marks, and it has internal alternative choice is 2 marks. So it means that question number 6, your weightage would be given for 12 marks, but you have to write 10 marks only. Among this, any of the question from the 4 questions, if you feel any question is difficult, then better to don't make any experiment, better to come to the theory part and concentrate on that and get the theory question to be attempted, because at any cost we have to clear. Okay, so this is your question paper pattern. Have you got it? Financial management, group 2, weightage 60 marks. Question number pattern, question number 1, 4 into 5, 20. Question number 2, 3, 4, 5, 40 marks, 40 plus 20, 60. So completely problematic. Any problem is little bit difficult or complex or comprehensive, better to come to theory part. So what are the chapters where you have to make much attention in order to get the good marks from the theory? Means the 3 chapters: scope and objective of financial management, types of financing, and working capital management. Majority from these chapters they will ask, but I'm not going to sure that only these questions to be identified, because examiner strategy is examiner strategy itself, right? So this is the pattern. Okay, once you know the question paper pattern, right, then we are going to move with the each and every chapters. What the chapters I'm going to cover in this marathon, I'm going to in detail I'm going to give you, dear students. In this marathon chapters, I'm going to explain क्या करते हैं ना. I'm going to take first chapter, time value of money. Time value of money, I'm going to give you the fundamentals of time value of money. Thereafter, I'm going to take cost of capital. Thereafter, I'm going to take investment decision. And thereafter, we have capital structure. And then we are going to handle leverage analysis. And then we are going to take dividend decision. Then we are going to handle risk in investment decision. Then we are going to for working capital management. Thereafter, we are going to take ratio analysis. Right? These are the chapters I'm going to cover, dear students. So take your notebook and a pen and put attention, right? Focus is very, very important. You have to identify it. Out of this, right, the time value of money is not in your syllabus actually. But the thing is, without knowing time value of money, you cannot understand the rest of the chapters effectively. These are the chapters I'm going to cover, right? The order may be changes. Okay, let's move to time value of money. Time value of money. Time value of money. Dear students, financial management is a subject of decision making. Financial management is a subject of decision making. Financial management is a subject of what making? Decision making. So being a financial manager, your ultimate job is to take various decisions. These decisions being classified into 3 types. One is financing decision. Another one is investment decision. Another one is dividend decision. Keep it in mind. They may be asked you 4 marks question. What is a financial management? Explain various decisions. It indirectly covers. So financial management is systematic estimation of how much finance is needed, how this finance to be raised, how this finance should be utilized in effective way so that the wealth of the company should be managed. So financial management, in brief, if you observe, it is a concept of 2 things: finance and management. All the money related activities of the company comes under the category of finance. So success of any business is depends upon how effectively you are going to manage your finance. So from this management, it includes from estimation, procurement, and utilization. Everything comes under the category of financial management, dear students. But if you want to take all these financial management decisions, right, you must understand one of the facts. All the decisions indirectly, directly depends upon one of the fact or one of the principle, that is called basic principle. Basic principle. all the decisions of financial management is depends upon what is that? Basic, one of the basic principle. That principle is called what is that? Time value of money. It is called time value of money. Okay. What is the time value of money? The time value of money is nothing but the value of rupee today is not equal to value of rupee to be earned in future. The value of rupee today is not equal to value of rupee to be earned in future. So what do you mean of this? It indicates that whenever, wherever you have a chance to make investment in any business project, if you invest 1 rupee today, if that project gives you after 5 years the same 1 rupee, will you take it, that one? No, you should not take. Why? Because the present rupee is not equal to the rupee to be earned in future. That's why being a financial manager, whenever you will make investment in stock market or in fixed assets or current assets, whatever it assets, even in bank, right? If the same bank gives you after 5 years, same amount what you were invested, will you take it? If you invested in a business to make a profit, but after 5 years you are unable to recover at least profit, you are getting same your investment back, will you take that one? No. Why? Because even you are getting the same invested amount also, you should not encourage that one, you should not undertake that one, you should not touch such a business. Because the value today you invested, if the same business, same project gives you same in future, means you should not consider. Why? Because today value is more powerful than the rupee or value of rupee to be earned in future. If you accept that, if you invested 1 lakh rupee, after 1 year, same bank gives you 1 lakh rupee, if you are taking, means you don't know basics of financial management. It is better to don't do such a business. You are not at all financial manager, I assure you. That is the reason, right? First, you should understand. It means that the bank which cannot gives you interest, don't deposit. The real estate which cannot gives you growth, don't deposit. The business won't give any profit, don't do. Or any transaction, don't never undertake when it won't give you any benefit comparing to your investment amount. That is the hidden reason for the time value of money. So what the time value of money speaks here? Simply, time value of money, TVM, means what? It is the value of rupee. Time value of money indicates, right? Time value of money, TVM, it indicates value of rupee today is not equal to rupee to be earned in future. Rupee to be earned in future, or rupee in future. It's not at all beneficial. How do you indicate, sir? Simply, what is the rupee today? It is present rupee. If you after 10 years you are getting here the future rupee. Now tell me, rupee today in rupee in future, both are same. Such both are same. From the currency point of view, both are same. But purchasing point of view, this rupee is more valuable comparing to this. Because of what is the reason? Can you tell me, Balu sir, what would be the reason for present rupee is more valuable? How do you say present rupee is more valuable? Present rupee is more valuable. How do you say present rupee is more valuable? I have a wonderful reasons to you to consider that the present rupee is more valuable. Number one, what is that? Inflation impact. Number one, inflation. You see, present rupee, you could not find what is that? Inflation. But the future rupee certainly affects the inflation. Means whatever the things you are going to buy by spending the present rupee, the same amount you cannot get it in future. By spending the same amount in future, you cannot get it because of inflation impact. My grandfather once constructed a house by spending of 10 lakh rupees. Could I able to plan to construct house by spending 10 lakh rupee? No. But whereas my grandfather time period 10 lakhs and in my time period also 10 lakh is there. But purchasing capacities varies. If you invest 1 lakh rupee in a bank, if you wait for the 5 years, right? If the bank gives you 1 lakh rupee, will you take it? If bank assures you that whatever the 1 lakh you are given to us, right? We are giving same 1 lakh rupee, Balu, will you take it? I don't take it because inflation impact. 5 years back, by spending 1 lakh rupee, how many commodities I would have purchased? Could I able to purchase the same commodity now? No, it's not possible. So that is the inflation. Another one is opportunity cost benefit. Opportunity cost. Present rupee has an opportunity. Okay, if you take or if you take the present rupee, you have a chance to make investment. But if you take the future, you are going to lose your opportunity. That's why present rupee is worthful. Another one is risk of uncertainty. Risk of uncertainty. When you have a present rupee with you, the risk of uncertainty is very, very low. Frankly speaking, no. But whereas if you depend to take the rupee in future, then certainly you will have a risk of uncertainty. Another one is personal sacrifice or present preference of present consumption. Preference of present consumption. Preference of present consumption. It means that if you have a present rupee today, you can use that rupee and you can solve your wants and needs. But whereas if you expect to get amount in future, you cannot. You cannot. Means you have to sacrifice in order to get your wants are solved. So that would be the reason for these students. Present rupee is always worthable than the rupee to be earned in future. Present rupee is always worthable than rupee to be earned in future. That is the reason we have to expect, right? You have to expect time value of money. It indicates indirectly what it conveys, Balu sir. Simply that it indicates that whenever you will make investment, right? Whenever you will make investment in any business, what it indicates, if you deposit money in bank, right? Certainly you should expect interest. If you do business, you have to expect profit. If you invest in real estate, you have to expect growth rate. Okay, that would be the reason. But entire financial management guides you as to that we are going to invest in business. So we have to expect a return. But the return is risk oriented. But being a financial manager, when we make investment in business, we will expect a return. That return is risk oriented. But how much return we supposed to generate will depends upon, without taking risk, how much return we supposed to earn. That is nothing but bank rate of interest. So entirely time value of money guides you that if you go and deposit your money in bank, what would be the rate of interest you supposed to earn? How the banks used to compute various types of interest, what is the pattern of compounding, what is the annuity fees, different types of terminologies we are going to learn in this chapter called time value of money. The reason is that if you deposit your money in bank, you must expect interest. But that interest is risk-free rate. But if you invest the same amount in business, you must expect profit. That profit is risk-oriented. When our intention is to generate the return, then we must have the knowledge that how much return we can generate by investing money in business. Sorry, in bank. Bank we have to consider. That is the reason. First of all, now being a financial manager, I'm a financial manager. I have a money. Okay, this money, with that I go to the market, I will invest in business, right? In business, I should expect what is that profit. But in profit is risk oriented, right? My point is how much risk, how much return I should expect in a business means I must go to the bank and I should know if I invest what would be the interest the bank supposed to pay to me. So for that purpose, I should understand that if I go to the bank, if I make a deposit, bank has to pay interest. The methods which bank is to compute, methods of estimation of interest. So how this banks will estimate the bank rate of interest? It is a bank, SBI bank. Okay, SBI bank. Okay. If you deposit your money in SBI bank, so how the SBI bank used to pay interest? Generally, the methods of estimation of interest, you will have two types of methods, dear students. One is simple interest method. Another one is compounding interest method. Coming to first method, simple interest method. So in this method, simple interest method means simply they pay interest to you, right? Simply they pay interest to you. So in this method, right, every year interest remains same. Earned interest never be added to principal in order to compute the interest. So simply they will pay interest. Presently, there is no simple interest method because this method indirectly ignores opportunity cost benefit of investor. So that is the basic idea. So simple interest, how do you calculate? Simple interest means PNR, right? Principal, number of years, R. Where amount, how do you calculate? Amount equal to simple interest plus what is that? Principal. So if you understand this two, you can calculate simple interest. So nowhere now currently simple interest is not there because it ignores opportunity cost benefit of investor, right? Basing on this, can you be able to solve the problem? Here you see there is a simple interest formula. Just now I told you what is the formula of simple interest? P and R. So how do you, if banks provides you simple interest method, then what would be the procedures to compute? Find the simple interest method 60,000 at 6% per annum 5 years. Also find the amount. Now tell me what the formula I gave it. Simple interest equal to PNR where amount equal to simple interest plus principal. Come to here. So 60,000 into 6%. Simple interest. PNR principal 60,000. Number of years 5 years. Rate 6%. 60,000 into 6% into 5 years. 18,000. Is it correct or not? Take a calculator, Nikalo calculator, Karo actively. 18,000 is the simple interest. Means if you deposit 60,000 in a bank, if you keep that amount over the period of 5 years, if the bank has a customary to pay 6% rate of interest, if you wait for how many years? 5 years. At the end of the period, you may get the simple interest 18,000 rupees. Whereas, how do you calculate amount? Amount is nothing but principal plus simple interest. This is your principal amount. This is 16,000. 60 plus 18, how much? 78,000. This is your amount. Got the point? So that is the simple interest method, dear students, right? Coming to next method, what is that? Compounding interest method. Is it fast? Right? Okay, no? Right. Compounding interest method. Compounding interest method. Let's, dear students, what is the word of compounding? Let us take this word. Compounding means adding. What to what add? Interest add back to principal in order to compute the interest. Such a method is called, what is that? Compounding interest. This method is very, very important method. So in this method, right? In this method, earned interest is add back to principal in order to calculate the interest. Calculate interest. Calculate interest. Thus, dear students, in this method, interest can earn interest. Interest can earn interest, or interest on interest is possible. Basing on this compounding interest, we will estimate what is the future value of single amount. In this method, what is identified? If you go to the bank, right? So here, estimation of, basing on this simple interest, compounding interest, estimation of future value of single amount we will calculate. Future value of single amount. Future value of single amount means you are a financial manager. You are a financial manager. You went to bank and you made a deposit of 1 lakh rupee. You waited for 5 years. Bank is paying 10%. In such a case, what would be the value you supposed to get it? So this is, but here deposit is, what is that? Just a single amount. Just a single amount. So that is called, if the bank follows, future value of single amount. Generally, future value of single amount can be calculated using the formula, right? Future value equal to whatever the value you deposited is called present value into future value factor or percentage rate of interest. Where keep in mind, future value means the amount to be deposited, amount to you are going to get it in future. Present value means the principal amount what you are going to deposit. R means rate of interest per compounding. Per compounding, why I am using per compounding means rate of interest per annum may takes place, right? But if the compounding takes place annually, then there is no difference between rate of interest per compounding, rate of interest per annum. Sometimes the banks may provide compounding annually, semi-annually, quarterly, monthly, whatnot, sometimes daily also. In such a case, R means not a rate of interest per annum, it is a rate of interest, rate of interest per compounding. Whereas N means number of years, number of compoundings in a given time period, number of compoundings in a given year. Balu sir, if the compounding takes place annually means, then rate of interest per annum, number of compoundings both reflects same. But if the compounding goes more than once, then you have to adjust rate as well as N. So simply, in order to find it out the future value by considering given rate and given number of years, we have a table. The table is called future value factor table. Future value factor or cumulative value factor table, table number 1. So this table number 1, basing on this table number 1, you can find it out the value of rupee and you can calculate the future value. Future value of single amount, right? What is the benefit of this? So it enables, if you know the future value of single amount, it enables the financial manager where the given fund should be invested. The given funds must be invested. Dear students, you are learning time value of money, particularly future value of single amount. So what is the purpose? You are running for the marks, right? Try to understand. By learning this concept, you can guide your client in such a way that you have a limited funds, right? Or funds. Go to bank, deposit there and wait for this given period. This amount is going to this much in concerned future. Why? Because in this topic, in this method, you are going to advise a company that if you want to earn more money, right, better to choose a bank which pays high rate of interest. Better to choose the bank which gives you more number of compounding. So the bank which provides you more number of compounding, high rate of interest, that can, by depositing your money in that bank, you may generate what? Huge future value that may solve your financial problem in future. So that would be the reason. So how do you calculate the future value for this single amount? Future value equal to present value into future value factor R percentage and number of years. As rate of interest increases, your future value amount also increases. As number of years increases, your future value amount also increases. Okay. Now, basing on this, shall we have a problem here? So let us check it here. If you deposit 10,000 today in a bank which pays how much? 12% interest compounded annually. How much will the amount grows 4 years and 8 years? If you wait it for 4 years interest you are going to get it. If you wait it for 8 years interest you are going to get it. Certainly the future value would be high comparing to 4 in 8, right? Let us take in 4 years. What is the principal amount? 1,000. What is the rate of interest? 12%. Future value equal to present value into future value factor R percentage and number of years. If you deposit 1 rupee, if you wait for 4 years, this 1 rupee will become 1.574. When 1 rupee will become 1.574, the 1,000 rupees will become how much? This is 1,574. This is the amount, right? Coming to, if you hold for 8 years, so what is the formula? Future value equal to present value into future value factor R percentage and number of years. Future value factor at how much percentage? 12%, 8 years it would be 2.476, or else you can also use the formula 1 plus R whole power of n. So that means 1.12 whole power of how many years? 8 years. You will get the factor value. 1 rupee will become how much? 2.476. When 1 rupee will become 2.476, try to understand, then 1,000 would be 2,476. It means that if you deposit 1,000, wait for 4 years, it will become 1,574. If you deposit 1,000 for the period of 8 years, it will become 2,476. Okay, 2,476. As number of years increases, right? future value also increases. Right. Thereafter, would it be difference if interest is compounded half yearly? Just now I told you, sometimes the bank may provide you compounding annually as well as what is that semi-annually also they will provide. Here, how much? Half yearly. Half yearly means semi-annually. So monthly, every month. Quarterly, 3. So per year means annually means only once. Now in such a situation, what happens? For that purpose, I will tell you what is the future value factor, right? 1 plus r whole power of n, So the logic, keep it in mind. Whenever compounding takes place more than once in a year, then r to be divided, n to be multiplied. R to be divided, n to be multiplied. It means that what is the rate of interest? 12%. Compounding takes place half yearly. Half yearly means 2 times. So divided by 2, you will find how much percentage? 6%. R to be divided, n to be multiplied. Here, n to be multiplied. 2 into 4, 8. So now, if you want to find it out the future value factor, you have to take 6% rate of interest. How many years? 4 years. In 4 years, how many compoundings? 8. If it is 8, then it is 6. You have to search the future value factors at 8% and at 6%, 8 compoundings and 16 compoundings. In first option, if maturity period is how much? 4 years, then future value equal to present value into future value factor or percentage. So 4 years means how many compoundings? 4 compounding 6 year 6%. Then it would be 1.594. When 1 rupee will become 1.594 means then 1000 it will become 1594. Then coming to if it is a 8 years means 16 compoundings. In such a case, 16 compounding 6%. In such a case, it would be 2.54. Here, how do you find it out? 1 plus r whole power of n means 1.06 whole power of how many? 18. You will find 2.547, 540. If you multiply both, you will get it at 2,547. When compounding takes place semi-annually in 4 years, it would is just 1,594. Whereas if it is a 8 years, then 16 compounding takes place, you may comfortably generate 2,540. So as keep it in one of the shortcut. If you want to earn more future value, rate of interest to be increased, number of compoundings to be increased, or even if you wait for the long period also, you can get more future value. So what is the future value? Future value is nothing but the value of rupee you are going to get it in future by depositing as on today at the given rate of interest, given number of years. What is its characters? As rate of interest increases, future value increases. As number of years increases, future value increases. As pattern of compounding increases, future value increases. Right? R means not rate of interest per annum, rate of interest per compounding. If rate compounding takes place per annum, then rate of interest per annum, rate of interest compounding, both are same. Right? Then base, this is the concept. Thereafter, we are going to discuss the next concept. Right, dear students, the next topic is we were going to discuss is a present value. Yesterday we discussed about present value, simple interest we calculated, compound interest, and next before going to this we have to find it out what value means. That is present value, present value of single amount, present value of single amount. Right, in time value of money we have a present value. How to find it out? Present value, present value of single amount value. So present value means what is it? It is the value of rupee, it is the value of rupee as on today, which is going to be realized, going to be realized in future. See, what is the present value? It is a value of rupee as on today, which is going to be realized in future. Dear students, whenever any financial manager wants to make investment in any project, it is the due responsibility of concerned investor to know what is the worth as on today. Either it may be bond, it may be share, or it may be security, whatever it may be, which offers him in future because of your investment. In such a case, it is your responsibility to find it out what would be the worthable amount to be invested in future. For that purpose, what we do, it here is the present value, here is the future value. What we do, for the present value, interest gets adding, means compound, then we will get a compounding, then we will get the future value, right? But the same, it means that in future value means it includes present value plus interest, right? Because the present value interest gets what? Compounding. Now what to do? If you deduct the interest from the future value, then automatically you will get present. So it means that when you do discounting of future value, then you will find what value? Present value. So present value enables the financial manager. Present value enables the financial manager. Financial manager, how much to be invested. Or you can also know fair value of money to be invested. Okay, because once you want to make investment, you should know that what is the benefit you are going to get it in future. For that purpose, what is the value to be identified. So generally, to find it out the present value, what we do is we will take future value into, we will multiply with present value factor or percentage and number of years. So this is the one alternative, or else present value equal to future value divided by future value factor. So you may get it, the future value divided by future value is nothing but present value. Future value into present value factor, you will find it out present value. Sir, where will I find future value factor? Table number 1. Where I will find present value factor? Table number 3. Table number 3, you will get it. What is the formula for future value? 1 divided by 1 plus r whole power of n. What is the future value? Future value is not 1 plus r whole power of n. Even with the support of calculator also you can calculate. Basing on this, we had a small problem to be done. Now, the cost of new mobile phone is, let us take 10,000. 10,000. After 5 years, the interest rate is 5%. How much money should be aside? It means that here is the 10,000. You are going to get it in 10,000 in the future. Over the period of 5 years, rate of interest is 5%. Now, how much money should aside now? It is nothing but what value? Present value. Simply, future value is 10,000, rate is 5%, n is 5, present value you have to find it out. So present value equal to future value into present value factor, 5%, 5 years. That factor value would be 0.787. 10,000 into 0.787, you will get the 7,840. It means that if you dip aside amount 7,840 now over the period of how many years? 5 years. At 5 years, 5%. This 7,840 will become, what is that? Future value of 1,000. So this is the present, how to find the present value. Got the point? In capital budgeting, this method is very, very important, dear students. Then basing on this, we have one more point problem also given, the same problem. But X as to buy a machine cost is 20,000 lakh. After 3 years, how much money should aside? It means that 20k, 20 lakhs is the future value. Then you have to find the present value. Present value equal to, how do you solve, man? Here, present value equal to future value into present value factor r percentage n number of years. But how much money should we deposit? Means here r percentage, how much? 10%. How many years? 3 years. Then 10% 3 years present value factor is 0.751. It means that the 1 rupee what you are going to get it at the end of each year. Third year, if the prevailing rate is 10%, then its present value is 0.751. When 1 rupee will become 0.751, means 20,000 would be 15,000, 15 lakhs, 2,000 rupees. Okay. The next we will find it out, annuity. Annuity. Dear students, annuity means, what is the annuity? So now we find it out, what value? Present value, simple interest we completed. Future value of single amount completed. Present value of single amount also completed. Next we are going to discuss annuity. The annuities means same amount which is going to happen over the period at the given time period at a regular interval is called, what is that? Annuity. Annuity means a stream of cash flows which may arise or which may arise or which may be deposited is called annuity. For example, same amount, because of, if you make a deposit in a fixed deposit, because of your fixed deposit, every year you used to get it, what is it? Same amount of interest. This is an annuity. Or else, if you are, for the sake of your retirement scheme, if you are depositing every year same period over the period of given number of years, then you will find a bulk amount at the end. That is also comes under annuity. So annuity is nothing but same amount over the given time period. So annuity is being classified into two types of annuities. One is, what is that? Future value of annuity. Another one is present value of annuity. What is that? Future value of annuity, present value of annuity. So future value of annuity, how it works means, you see, future value of annuity. Future value of annuity is nothing but while going on making deposit over the period, right? For example, year 1 you deposited, year 2 1 rupee deposited, year 3 1 rupee deposited, year 4 1 rupee deposited. At the end of fourth year, you want to find it out. The total value at the end of fourth year is called, what is that? Future value of annuity. Whereas present value of annuity, present value of annuity. Present value of annuity means you are given a chance that year 1 you have a chance to receive 1 rupee. Year 2 maybe 1 rupee. Year 3 maybe 1 rupee. Year 4 you are going to get it a 1 rupee. So now the point is, what is the total present value of this total amount as on today is called present value of annuity. Future value of annuity enables systematic saving in which bank, in which segment we have to deposit so that we supposed to get more future value. But present value enables that how much worthable amount to be deposited is called present value. So how do you calculate the future value, dear students? Future value of annuity equal to periodic payment into future value of annuity factor r percentage and number of years. You will find future value of annuity factor table number 2, or else you can say 1 plus r whole power of n minus 1 divided by r. With a calculator you can calculate. So future value of annuity supports you where the given amount to be deposited in order to get more future value. Then present value, how do you find it out? Present value of annuity equal to periodic payment into present value of annuity factor r percentage and number of years. By which factor table we supposed to use it means present value annuity factor table number 4. So if the table number 4 is not given, then you can also go with like this. 1 plus r whole power of n minus 1 divided by r into 1 plus r whole power of n. With the support of this formula also, you can trace it out. But my personal opinion is don't take this one because tables you will give it. Just in order to make the capital budgeting effectively, we will calculate future value of annuity, present value of annuity. Okay, future value of annuity, periodic payment into future value of annuity factor r percentage and number of years. Present value, periodic payment into present value of annuity factor r percentage and number of years. Let's have few solutions here. We will have problem number future value of annuity. You see, find the future value of annuity. The following: X Limited wants to deposit over the period of how many years? 25,000 every year, right? Over the period of 5 years. So the rate of interest which is available at 8%. He wants to know maturity value at the end of 5th year. It means that future value of annuity needed. What is that? Every year he is supposed to deposit 25. That is periodic payment. Rate of interest 8%. N is 5 years. Future value of annuity. Future value of annuity factor available in table number 2. By taking 8%, 5 years, you will find the factor value would be 5.867. If you multiply this, then it would become 1,46,675. What it explains? Go to the bank, deposit 25,000 over the period of 5 years. At the end of 5th year, you may collect how much? 1,46,675. But second one, they asked it, what happens if the rate of interest increases to 10%, decreases to 6%? If the rate of interest increases, then you have to find it out the factor value, 10% 5 years. Then factor value would be 6.105. When you multiply 25,000 into 6.105, then it would be 1,52,625. Whereas rate of interest decreases to 6%, then 5.635 into 25,000 equal to 1,40,925. So this is the way. So future value depends upon the rate of interest. As rate of interest increases, future value of annuity increases. As rate of interest decreases, future value of annuity decreases. And coming to, is there any present value? Coming to here, the present value means present value of annuity equal to present value of annuity periodic payment into present value of annuity factor or percentage n number of years. It enables how much to be deposited. For example, basing on this concept, Mr. Ram wants to purchase a building which is given for the lease rental. Annual lease rental, he will get it 6,000 as per term of contract. Annual lease rental will be increased by 2% forever. So he wants to know the maximum price. Actually, here this is called what is it? Perpetuity they have given. Present value annuity they should be considered. But present value of annuity, it means that if you are asked to make it 10,000 deposit today, we will give you every year 5,000, 5,000, 5,000 over the period of 5 years. Means what is the worthable amount to be deposited. For that purpose, whatever the cash inflow you used to get it in future, you have to bring into present. So that is present value of annuity. Then you have another concept is perpetuity. Perpetuity. Let us take it as another topic is perpetuity. Perpetuity. Perpetuity, it indicates what is that? Infinite cash inflows. Infinite cash inflow. See, perpetuity, it indicates because of your investment decision. Okay, if you have a chance to get forever income, is called what is that? Perpetuity. This perpetuity is being classified into two types. Perpetuity is nothing but infinite cash inflow. What is that? Infinite cash flows. That is called perpetuity. Or you can say endless annuity. You can say endless annuity. So annuity has certain end, but endless annuity is called what is that? Perpetuity. Whereas the types of perpetuity, there are two types of perpetuities. One is present value of normal perpetuity. Present value of normal perpetuity means, which is also called present value of perpetuity, cash flows divided by rate. Then present value of growing perpetuity equal to cash flows divided by rate minus growth. As difference between present value of normal perpetuity whereas present value of growing perpetuity. So in normal perpetuity, what happens? Because of your investment, every year same cash inflow arises over the period. So over the period, it may arises over the period. But in growing perpetuity, cash flows gradually what happens? Increases. Such a perpetuity is called what is that? Growing perpetuity. You try to understand what is the difference here and there. Here, what is that? The cash inflow will come in the same way, but whereas here growing. Generally, because of considering inflation impact, we expect the cash flows to be increased. Such a concept is called growing perpetuity. When every year cash inflows same, then it is called normal perpetuity. Okay, for example, Puttaparthi group of organization, Tirumala Tirupati Devasthanams, all Nobel prizes, Vatican City Security Fund, all these things comes under what is that? Perpetuity. Because infinite cash inflow, you are going to get it. Okay, basing on this, we are going to discuss some few problems here. See here the problem, two part for problems are given, right? One is Mr. Ram wants to purchase a building which given lease rental over the rent of how much? 6,000 as per the contract. The annual lease rental will be increased 2,000. And he wants to know the maximum price offered to the purchase the building at 12%. Will your answer be different if Ram opportunity cost is 10% or 12%? What is your observation? Let us take. Mr. Ram wants to buy a building. You try to understand this is the problem. Mr. Ram wants to buy a building. This is the building you want to buy. We don't know this building, but this Mr. Ram gives this building to lease rental. He is supposed to get it. The cancer value of lease rental would be 6 lakhs. His opportunity cost rate is 12%. So now the question is asked. So lease rental is going to get it 6 lakhs. 6 lakhs. 6 lakhs. 6 lakhs. Whereas his rate is nothing but his investor expected rate is 12%. In such a case, normal perpetuity. So Mr. Ram has to think in such a way that what is the cash flows he is going to get it forever. If he bring into present, then what would be its worth as on today? For that purpose, normal perpetuity equal to cash flows divided by rate. It means that 6 lakhs divided by 12%. Thus 6 lakhs divided by 12%. Here investor expected rate is, here it is 12% actually they have to take. Investor why? Because he wants to maximum price that could be offered. Ram opportunity cost is 12%. In such a case, 6 lakhs divided by 12%. 6 lakhs divided by 12% would be 50 lakhs. So it means that 50 lakhs is the total value he is supposed to get because of making investment in this project. That's why Mr. Ram can make investment in this project worth of 6 lakhs. And second bit is asked, what would be the worth he is supposed to make investment? If this 6 lakhs increases over the period for 2%, that means the growth rate is given is 2%. In such a case, we need to find it out present value of growing perpetuity. Present value of growing perpetuity equal to cash flows divided by rate minus growth rate. So cash flows is how much? 6 lakhs. What is the rate? 12% minus 2% because growth rate is 2%. Then 6 lakhs divided by 10%. 6 lakhs divided by 10%. That means 60 lakhs. So this is the worth is supposed to get it in future. So this is the way to find it out. What is that? Normal perpetuity, growing perpetuity. Normal perpetuity. Here the problem associated with given. If the RAM opportunity cost of capital is 10% and 14% means basing on opportunity value also changes. If the opportunity cost is 10% means 6 lakhs divided by 10% 2, that is a 75 lakhs. 6 lakh divided by 14% minus 2, that is a 50 lakhs. This is an opportunity cost based. So finally, time value of money is one of the basic concept. In this time value of money, nowhere concerned to financial management paper. But the thing is, unless until you don't know present values, you cannot able to solve the investment decision. Sometimes even dividend decisions also, the time value of money is important element. Right? From this point, dear students, what are the topics I covered here is, I discussed with you simple interest. I discussed with you future value of single amount. Okay, simple interest to be calculated formula. And I discussed with the present value of single amount. I discussed with you future value of annuity, discussed with you present value of annuity. I discussed with you present value of normal perpetuity, and I discussed with you present value of growing perpetuity. So all these things comes under the category of time value of money. So initially, if you can't understand, listen this video once again, repeat it more, then certainly you can understand, right? With this, time value of money concept is completed. Hi, dear students. First chapter successfully we completed, that is time value of money. Next, we are going to discuss the another chapter called cost of capital. What is that? Cost of capital. Cost of capital. This is the second chapter we are going to discuss, dear students. Right. What is cost of capital? See, the cost of capital, the chapter title itself is indicates that whenever a company wants to do business, it need a capital. This capital company rises from various sources. In such a case, what would be the cost it's supposed to pay? Unless until you don't know what is the cost to be paid, how it will takes an investment decision, how it takes is performance efficiency, how it will takes that whether it can have a credit policy to be given or not, how it can take the performance of the company. That is called cost of capital. Right. What is the cost of capital? Let us take the notes and make it fast way. What is the cost of capital? See, cost of capital is the minimum rate of return that a company must earn to pay to fund providers. They are nothing but number one, equity shareholders, number two, preference shareholders, debenture holders, bank loans, and retained earnings. Retained earnings, here two conditions are there. Number one, condition number one, the company must be high profit making company. Number two, the company as a blue chip company. It's an existing company and it must make a profit in a best way. That is called, what is it? Retained earnings. Now the coming to how the cost of capital. So have we got it point? Very simple. What is the cost of capital? Cost of capital. Company need a capital. Company raises capital from various sources. The whomever the invested or whoever the provided fund to the company responsibility is to that cost to be paid to them. That is called what? Cost of capital. It is denoted as KE, not KE. So it is denoted as KOR, weighted average cost of capital, and it represents in rate or percentage. Then, how the corporate companies estimate the cost of capital? How the corporate companies estimate the cost of capital? So, the second part is estimation of cost of capital. How the companies estimate the cost of capital? There are two steps the company follows. Step number one, they will estimate specific cost. Estimation of specific cost. Specific cost is nothing but KE, KP, cost of preference, KD, KR, and cost of term loans. If at all company raises funds from various sources, we will take, what are they? KE plus KP plus KD plus KR plus cost of term loan. Then we will go with the step number two, estimation of weighted average cost of capital or KO. So first step is you have to calculate various specific costs, then you have to consider what is that weighted average cost of capital. So weighted average cost of capital, how do you take? This is your KO. To find it out KO, you need to get KE, KP and KD and KR and cost of term loan. Now we will add all these costs. So summation of all this cost is nothing but weighted average cost of capital. This is the procedure we find it out, right? This is the cost of capital, right? Thereafter, first one we used to calculate how the cost of debt is to be estimated. How the corporate companies estimate cost of debt. So cost of debt. How the cost of debt is to be estimated. Dear students, when the company wants to raise the capital by issuing of debt, then company go with what is that? Debentures. So cost of debt is the minimum rate of return that a company must earn to pay to fund providers, particularly debentures. So cost of debt, what is the KD? It is the minimum rate of return that a company must pay to whom? Debenture holders for rising of debt. Okay. For rising of debt, it is the minimum rate of return that a company must earn to pay to debt holders. Okay. Okay. Then how do you calculate estimation of cost of debt? When you want to estimate cost of debt to these students, you should understand the cost of debt would be, there are two types of debentures. One is irredeemable debentures where principal never paid, only interest paid. Such a debentures are called irredeemable debenture. Irredeemable debenture formula would be interest into 1 minus tax divided by net proceeds or market price. Into 100 we will convert and we will project in percentage. Interest, how much interest you will pay. Since you used to get the tax advantage, right? How much interest you will pay, from that interest to the extent of tax rate you will get tax benefit because you are paying interest. This interest you will show profit and loss account debit side. When because of showing profit and loss account debit side, your taxable income decreases. With effect you will pay what is it? Low tax, right? So indirectly because of paying interest you are getting tax advantage. So for that purpose, what happen? Interest into 1 minus tax to be considered. Whereas net proceeds you will take face value minus discount plus premium minus flotation cost. Okay, flotation cost also called issuing cost. Flotation cost or what is that? Issuing cost. Issuing cost. So net proceeds face value minus discount plus premium minus flotation cost. So flotation cost also called issuing cost. Bank charges, document charges, printing, everything comes under flotation cost. Thereafter, you have a market price. Sometimes companies also estimate cost of debt for existing companies. Existing company market price as on today. So this is the procedure to find it out cost of capital. For when new company enters into the market, they will find it out cost of a net proceeds like this: face value minus discount, premium minus flotation cost. Whereas in market price, existing company market price as on today. Okay, this is the point to be analyzed. How the procedure to be calculated. Cost of debt equal to interest into 1 minus tax divided by net proceeds or market price into 100. Let us take it here. There is a small problem we will solve here. Raghuram Limited 12% irredeemable debentures. Market price is 103, premium is 3, and their par value is 100. Flotation cost is 2%. Issue price. The company pays corporate tax rate is 35%. Calculate cost of capital, cost of debenture at the time of issue. So for first part, what we'll take? Net proceeds. Face value plus premium minus flotation cost. 100 rupees plus 3, 103 into 2. That is 103. Cost of debt equal to, what is the formula? Just now we discussed. Interest into 1 minus tax divided by net proceeds. 12 into 1.035 divided by 100.94 equal to 7.73 percentage. Okay, because here we take net proceeds. Assume debentures are issued at 5 years ago without flotation cost and currently trading at 94. In such a case, market price is today is how much? 94. In such a case, what we say, cost of debt, interest into 1 minus tax, market price into 100. 12 into 1 minus 0.35 divided by 94, market price we have taken 8.26 percentage. So this is the cost of irredeemable debenture calculation, dear students. Okay. Thereafter, you have one more point is cost of redeemable debentures. Redeemable debentures. Redeemable debenture. So redeemable debenture means principal and interest both are paid back. Both are paid. Is called redeem. They will redeem it. They will identify that if you invest in my company, the interest and principal amount to be paid to you. That is called redeemable debentures. For redeemable debenture means where the company issues the debenture holders that at any cost interest and paid amount would be redeemed. This redeemable debenture can be estimated like this. Redeemable debentures. This redeemable debentures can be here. We can make it. Redemption should be done at lump sum. Redemption should be done at a lump sum. When redemption done at lump sum, if the coupon rate of interest is constant, coupon rate of interest is same or constant, then we will use what method? We will use shortcut method. We will use shortcut method, which is also called approximate method, where shortcut method would be calculated like this. Where shortcut method, cost of debt equal to interest into 1 minus tax plus redeemable value minus net proceeds all divided by n number of years divided by RV plus NP divided by 2 into 100. So this is the formula to be considered for or when redemption is done at a lump sum. Whereas coming to here, redemption done at installment. When redemption done at installment, we can go with what is that? IRR. But IRR can be done from whose point of view? Company's point of view and investor's point of view. Investor's point of view. Sir, I can't understand why when you calculate cost of debt, why you are taking investor IRR? Because we will identify that how much investor is supposed to make because of making investment in your company is indirectly nothing but you are paying that much of cost to him, that is the hidden reason for investors. But this could not happen when there is no flotation cost. Sorry, it happens only when there is no what cost? There is no flotation cost. Okay, that is flotation cost. When flotation cost exists, we have to go with what is that? IRR. So this is the procedure, dear students. Cost of debentures. Once again, you see, what is the cost of debt? Estimation of cost of debt. Then the procedure this. For any method, you can go with redeemable debenture, can be done at lump sum, shortcut method, redeemable installment. Yes, dear students, good morning to one and all. So yesterday class we discussed the cost of redeemable debenture, cost of irredeemable debenture. Basing on that certain problems we are going to discuss. So Raghuram Limited is 12%, whereas irredeemable debenture 103, 3 rupees is a premium. Then the par value is 100, flotation cost is 2% on issue price. If the company pay corporate tax rate is 35%, calculate cost of debenture. Calculate cost of debenture. When cost of debt to be calculated, if it is irredeemable, what is the formula? Interest into 1 minus tax divided by net proceeds. So 100 rupees plus 3. 103 is the premium. Issue made at a premium. So 103 into 2%. If you deduct, you will get what? 103. 100.94 you will get it. Formula is interest into 1 minus tax divided by net proceeds. So 12 into 1 minus 0.35 divided by 100.94 into 100, 7.73. So if it is a market price, existing company is there, then you have to take what? Market price here. For that purpose, interest into 1 minus tax divided by market price. You see, newly issuing means then you have to take interest into 1 minus tax divided by net proceeds. If it is a market price means existing company means interest into 1 minus tax divided by market price. So dear students, so that is with respect to what is that? Cost of redeemable debenture. Once again, cost of debt. Irredeemable, redeemable. Okay. Irredeemable, interest into 1 minus tax divided by net proceeds or market price. Whereas redeemable, we have redemption should be done at lump sum and the redemption is done at installment. For redemption, we have a shortcut method. Installment, we have a IRR technique. IRR can be done from investor point of view or company point of view. When there is a flotation cost, you better to calculate it from company point of view. Next, we come to cost of preference. Okay, cost of preference. Cost of preference, which is considered to be, what is that? KP. Can we say cost of preference is KP? What is the cost of preference? That's we are going to discuss. Very simple. Whenever company need a capital, company issues preference shares and raises funds. So cost of preference is the minimum rate of return that a company must earn from its preference share capital to pay to preference shareholders. For the sake of running notes, you can go with this. What is the cost of preference, right? Cost of preference क्या होता है? Cost of preference. Cost of preference. It is the minimum rate of return. Rate of return that a company must earn. That a company must earn from its preference share capital. Okay, preference share capital. B, it is denoted as KP. Okay, it is denoted as KP. So another point, it is not a expense. It is not a expenses. It is an appropriation. Means whenever company able to generate a profit, then only cost of preference to be paid. And one more point is there is no tax advantage on it. Because in interest you will get the tax advantage, whereas in preference dividend you cannot. Why? Because the reason is simple. After making of interest, after payment of interest, you will find the profit. From the profit you have to pay preference dividend. Okay, that is the point. It is not an expense. It is not a charge. It is an appropriation. You cannot find what is that, a tax advantage on it. Generally, it is similar to cost of debt. One more point you should understand is cost of preference here. Cost of preference estimation is similar to estimation of cost of debt. This is the most important point. You can keep it in mind. Cost of preference estimation is similar to cost of debt, but 2 points makes different. One is the title of cost. Title of cost means in debenture, in debt you pay interest, but in preference you pay preference dividend. And whereas a tax impact on preference, there is a no tax advantage, no tax advantage, but on debt right, tax advantage is there. This advantage, these two things are different, remaining same. Coming to how do you calculate the cost of preference is similar to cost of preference. Cost of preference is estimation is as similar to cost of debt. Here you see cost of preference. How do you calculate cost of preference? First of all, cost of preference being two types. One is irredeemable. In irredeemable preference shares, the formula is just simple. KP equal to preference dividend divided by net proceeds or market price into 100. Okay, this is. Whereas redeemable, you have the two things. One is redemption done at lump sum. Redemption done at lump sum. In lump sum, what we say is we will use shortcut method or approximate method. Shortcut method. Keep it in point. Two, redemption should be done at lump sum. First one. Number two, coupon rate of preference dividend will remain same. In such a case, cost of preference equal to preference dividend plus redeemable value minus net proceeds, whole divided by n number of years divided by RV plus NP divided by 2 into 100. So this is the cost of preference in shortcut method. Whereas redemption is done at installment. When done at installment, then you have to choose from whose point of view? Investor's point of view, company point of view. Investor's point of view, whereas company's point of view. Okay, when there is a flotation cost, then we have to calculate from company point of view itself. So coming to cost of preference is the story. Cost of preference, once again, what is the cost of preference? So whenever company need a capital, company issues a preference shares and raises capital. So it is a due responsibility of the company to make a cost of preference. Good. Cost of preference estimation depends upon the nature of preference shares. It may be redeemable, it may be irredeemable. Irredeemable, preference dividend divided by net proceeds market price. Redeemable, means how you are redeeming, lump sum or installment. Lump sum, better to use a shortcut method. Find it out whether coupon rate remain constant or not. Another one is installment. Installment, you can go with what is that? IRR technique. IRR may be estimated from whose point of view? Here IRR you can follow. IRR may be calculated from investor point of view, company point of view. Calculation is similar, dear students. Okay, this cost of preference I will explain while solving weighted average cost problem. Then the last point is cost of equity. We will move with what is that? Another one is cost of equity. Cost of equity. What is the cost of equity? Read. Cost of equity is nothing but whenever company need a capital, company issues what? Equity share capital, and it is a due responsibility to pay cost to them, right? But estimation of cost of equity is really difficult. Reason is simple. I will tell you here. What is the cost of equity? Come to point here is what is the cost of equity? So cost of equity, it is the minimum minimum rate of return to be paid to equity shareholders. Okay, when you raises funds from equity shareholders, you have to pay cost to them. It is the minimum rate of return to be paid to equity shareholders, or you can say it is the expected rate by the equity shareholders. But here the point is, it is denoted as the company denotes it is a KE. It is denoted as, what is that? KE. Okay, right, KE. So here estimation of, I will tell you one point is estimation of cost of equity is difficult. Estimation of cost of equity is a difficult task. Why difficult task? I'm saying, you can say little bit risky. The reason is that estimation of cost of equity is difficult. Comparing to whom? Preference, comparing to debt. What is the reason? Because there is no coupon rate. There is no specific coupon rate. There is no specific coupon rate. For debenture holders, you have a specific coupon rate. For preference shareholders, there is a coupon rate. For debenture holders, there is no coupon rate. Then how do you say? And another point is, what is that? Expectations of equity shareholders varies. Debenture holders expectations remain same, either any of the company. Debenture holders makes investment, means he will wait and he will take the interest, right? But equity shareholder, preference shareholders, debenture holders, their expectations remain same. So they won't put finger into the business operation. When the company makes a profit, but they will take the interest or preference dividend, they will go. But equity shareholders is nothing but the owner of the company. That's why his expectation varies. Another point is, if you observe the risk, so risk from investor point of view, company point of view, conveys different types of diversible answers. For example, if you want to raise the funds from the company, so you have a preference on debenture. Which source you will prefer to raise? Better to, you will move with the equity. If someone asks you why you are going for equity, because you say that risk is very low. Risk is low means, what is your intention? There is no any fixed obligation to pay cost. That means if it is obligation, then what is the need to learn? What is that? Cost of equity. Here, cost of equity, we are learning that investor equity shareholder is also one of the fund providers. He is also one of the investor. So it is your due responsibility to pay. So FM says that since he is the owner of the company, no need to pay. And at the same time, same concept conveys that. So profit is reward of risk taking. Profit is reward of risk taking means what? So the person who takes more risk, he deserve to get what? More return. Basing on that point, what happened? You can understand equity shareholders, preference shareholders, debenture holders. Among these three members, who is the person who takes more risk? No doubt at all. That is the equity shareholders. When he takes more risk, he deserves to get more cost, right? Okay, it means that at one point of your time, it conveys that no need to pay cost. And another point of time, another point of conceptual view, if you check it, it conveys that you have to pay more cost. So now try to understand, if you are a financial manager, what do you do this? Will you pay cost? No cost. So since there is no coupon rate, equity shareholders expectations varies. From one point of view, it says that no need to pay cost. Another point, it says that you have to pay more cost. And another thing, the financial management objective is to maximize wealth of equity shareholders. When wealth should be maximized means you have to pay better cost to the equity shareholders, better dividend that attracts other people to make investment in your company. Because of all these things, right, there is a controversial concepts are there with respect to estimation of KE. Risk point of view, equity shareholders point of view is it conveys one meaning, and a firm or company point of view, it conveys another meaning. That's why there are several methods came to picture to find it out. One is estimation of cost of equity. So estimation of cost of equity, there are different methods. Method number one is on the basis of what? Here you try to understand. Okay, here no growth in dividend model. First, dividend based. Under this dividend based, you can have two things: no growth in dividend and growth in dividend. No growth in dividend, growth in dividend. Okay. Under this growth in dividend, again you have constant growth in dividend, constant growth in dividend. Another one is non-constant growth in dividend. Constant and non-constant. Okay, this is with respect to dividend. Thereafter, you have another model called EPS. Under the EPS, you have again two models. No growth in EPS, and another one is growth in EPS. That growth is, what is that? Constant. As per our syllabus, we have constant growth. Thereafter, realized yield approach. Realized yield approach. Thereafter, you have CAPM approach. So these are the methods you have various identity to estimate cost of equity. You see how many methods: dividend based, EPS based, realized yield based, and CAPM approach. So different types of approaches are there to estimate cost of equity. So before going to understand all this concept, first of all, you should understand how do you find it out EPS. First of all, you must know EPS. EPS, how do you get it? EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. You will get EPS, right? So when you understand growth, no growth means, thereafter another important point is EPS of the company will be splitted into two parts. One is no growth company may follow dividend payout ratio. Dividend payout ratio 40%. What do you mean of this dividend payout ratio? The company makes a payment 40% from its EPS. Thus, dividend payout ratio equal to dividend divided by EPS into 100. So if it is a 40% means from the earned profit, company makes 40% dividend. Then what about the remaining? Retaining ratio. Retaining ratio. So retaining ratio, how do you get it? Retaining ratio. So retaining ratio equal to retaining profit divided by retaining profit divided by EPS into 100. So this is 60%. Now try to understand, this is the EPS can be split into two parts. One is a dividend payout ratio, another one is a retaining ratio. Then thereafter you have to understand what is a growth rate. So growth rate is nothing but whatever the retained profit the company made, that retained profit company invest in outside. That means rate of return on reinvestment rate. With effect, a company able to generate a growth. So growth rate of the company will come only retaining ratio, okay, into rate of return on reinvestment. Okay, company able to generate growth rate. So this is the point, rate of return on reinvestment. So these are the different types of way. So now tell me, EPS of the company will split into two parts: dividend payout ratio, retaining ratio. Dividend payout ratio, dividend divided by EPS. Retaining ratio, retaining profit divided by EPS. Growth rate, how do you get it? Retaining profit, whatever the retaining profit you have, you will invest outside and you will get what the rate of return on retaining ratio into rate of return on reinvestment. You will get the growth rate. Now there are different types of models are there. The first model is no growth in dividend model. What is that? No growth in dividend model. No growth in dividend model. No growth in dividend model. Okay, what is a no growth in dividend model? In this model, no growth is there. No growth, it indicates what is the hidden reason for that. So company follows, what is it? In no growth model, you try to understand concerned company follows, what is it? 100% dividend payout ratio or 0% retaining ratio. Since company not able to follow, what is it? Not able to follow 100% retaining ratio, then no chance of growth. So growth happens, already we discussed, growth happens when there is a retaining. But in this model, company declares 100% dividend. So when company follows 100% dividend, in such a case, the KE of the company would be like this. Under this model, KE equal to EPS or DPS divided by net proceeds or market price. into formula. Okay, in this problem, since company follows 100% dividend payout ratio, EPS equal to DPS. Okay, at the same time, EPS DPS 1 equal to DPS 0 equal to DPS 1 equal to DPS 10 also you can say, because growth rate remain no growth rate. No growth rate means company follows 100% dividend payout ratio. With effect, EPS is not equal to DPS. DPS 0 is not equal to DPS 1. DPS 0 means dividend already paid. DPS 1 means dividend expected to be paid. Okay, this is the no growth. Thereafter, you have another model, constant growth in dividend model. What is that? Constant growth in dividend model. So another model is constant growth in dividend model. Constant growth in dividend model. So constant growth in dividend model. What is this constant growth in dividend model? In this model, company could not declare 100% earnings to equity shareholders. What happened? Here, company from the EPS, it will retain some percentage, it will reinvest. Retaining ratio, rate of return on reinvestment rate, growth rate, everything remain constant. So in this problem, what happened? Constant with respect of what? Company could not follow 100% dividend payout ratio, right? So that's why constant what? Constant of dividend payout ratio with effect a constant of retaining ratio. So when a retaining ratio is constant and the rate of return on reinvestment also constant, since constant retaining ratio invested at constant dividend payout ratio, then automatically you will get a constant growth rate. Okay, constant growth rate. So you try to understand, in constant growth rate, every year dividend increases with a given constant rate over the period. Okay, in this model, equity shareholders not only expects cash dividend but also appreciation in market price. Okay, according to this model, KE of the company equal to DPS1 divided by net proceeds or market price plus growth rate, where market price also can be calculated like this: DPS1 divided by net proceeds or market price. Okay, so dear students, here you should understand EPS is not equal to DPS. Okay, and one more point, DPS 0 means dividend paid last year. DPS 0 is not equal to DPS 1, where you can say DPS 1 equal to DPS 0 into 1 plus growth rate, because growth rate gets added to last year. It means that indirectly you can also say like this: DPS 10 equal to DPS 9 into 1 plus growth rate would be DPS 0. Okay, this is the model where company could not follow constant growth rate model, because here constant dividend payout ratio, constant retaining ratio, constant rate of return on reinvestment makes the company. That's the formula to be estimated for this is, either they may ask you two formed KE, they may ask you DPS1 also they will ask you. So this is with respect to constant growth in dividend model. And thereafter you have, what is that? EPS based. What is that? EPS based. So EPS based model. EPS based model. EPS based cost of equity. In this model, the company believes that how much cost is paid, it does not matter, right? How much EPS we made, because today or tomorrow, or we not pay this amount, whatever the EPS we made it, that EPS would be distributed to whom? Equity shareholders. That is absolutely fact, right? So that is the reason, instead of considering dividend, they will consider what is that? EPS. So in this model, KE of the company is nothing but earnings made by the company, whether declare or not to declare. So in this model, KE equal to EPS divided by net proceeds or market price into 100 when there is no growth in EPS. When there is a growth in EPS is there, in such a case, KE equal to EPS divided by net proceeds or market price plus growth in EPS model to be considered. This model indirectly conveys that the cost of equity is not based on the dividend to be paid, but whereas the cost of equity of the company is estimated basing on what is that EPS made, because you are a owner of the company. Either if I make payment, not to make payment does not influence anything, because if I pay 10%, remaining 90% is there with me, right? This amount today or tomorrow I'm going to hand over to you. So that is the philosophy for this model, EPS based. Thereafter, we have realized yield approach. Realized yield approach. Okay. Thereafter, realized yield approach. Realized yield model or approach, you can say. Realized yield approach. So according to this approach, okay, KE of the company is depends upon what is that return made by the company. So in this model, right, in this model, KE of the company is nothing but, according to this model, KE of the company, KE of the company is nothing but yield made by the investor. Okay, because if you investor holds or investor invest in our company, he makes a profit, right? How much profit he makes, how much yield he makes, company believes that, but this is the cost I paid. So this is, here you have to find it out in this model, cost of, in order to find it out, cost of equity, in order to find it out, cost of equity, what do you say? KE equal to yield of the investor. So KE equal to yield. Yield being classified into two types. If you hold for 1 year, right? 1 year holding, 1 year holding. So you have to find it out the two things. One is a dividend yield, how much he made it yield from dividend yield, where dividend yield equal to DPS1 divided by market price into 100, right? This is the dividend yield. Thereafter, if at all market price appreciation is there, then calculate capital gain yield. So capital gain yield equal to DP market price MP1, what the price you sold it, MP1 minus MP0, you price purchased it within the 1 year, divided by MP0 into 100 equal to, what is that? Capital gain yield. Thus KE equal to dividend yield plus capital gain yield. So KE equal to dividend yield plus capital gain yield, both would be the company's identity. Okay, cost of equity. Got it point? According to this approach, cost of equity is nothing but yield made by the investor. Okay. Thereafter, if you hold more than 1 year, right? Holding share more than 1 year and making earnings, means better to go with IRR. IRR from investor's point of view. So you have to go with the whose point of view? Investors point of view, because how much investors makes earnings, that is nothing but KE of the company. Okay. So since dear students, this is everything, whatever the information I'm giving, it serves as a Brahmastra for you. Once you know this knowledge, right? Conceptual knowledge, you can handle the problem, I will assure you. Because this is not the just I'm showing a material. I can show the material, I will tell it. But thing is, I'm writing it. It is everything I'm writing. So once you are good at this, you can handle any problem in study material, RTP, MTP, past exam. But you must know all these things. Just to try to listen once again. Listen this video once again and come to conclusion that why growth happens, what is the retaining ratio, what is the yield. Yield means return. Then our job is to estimation of cost of equity. What would be the reason for that? Okay, why after dividend, why we go on for EPS based? think like this. Practically try to think like this, right? When a problem with 4 lines, the problem which stands as a person in front of you with the 4 lines, you are not able to solve, right? The person who carries a 400 crores with a bag and he will expect to solve your problem, then he expects to solve his problem. Then how do you solve it? So unless until we cannot have the conceptual knowledge, right? You cannot solve any problem. Okay, that is a realized real. And thereafter we have one more approach is CAPM approach, capital asset pricing model. What is that? Capital asset pricing model. CAPM approach in estimation of cost of equity. CAPM approach. The point number one, CAPM approach. This model was proposed by what is that Sharpe in the year. So this model was proposed by Sharpe in the year 1961. He identifies that cost of equity of the company, cost of equity of the company depends upon risk element of the company, risk element of the company. So here, what is the means of risk? So risk means uncertainty of return, uncertainty of return. Okay. So according to this model, right, KE of the company is nothing but like this. Okay, KE equal to RF, risk-free rate, plus beta into RM minus RF. So this is the point for this one is, okay, KE equal to RF plus beta into RM minus RF. Risk RF means what? Risk-free rate. What is this? Risk-free rate. We can say it is a risk-free rate. Here, risk-free rate. Okay, what is a beta? This is called a systematic risk measurable. Systematic risk, you know that beta may be in 3 ways: greater than 1, less than 1, equal to 1. So if the beta is more greater than 1, it is a high risky one. Less than 1, low risky one. Equal to 1, so it's a normal risk. Okay. RM means return on market portfolio. Return on market portfolio. RM includes RF minus risk premium plus RF. So KE of the company is nothing but RF you have to give. Since from RM you deduct RF, you will get the RP here. This risk premium depends upon the beta. High beta means you should give, what is that? More risk. It means that what this CAPM approach is identifies that profit is reward of risk taking. Okay. A company has to pay more cost to whom? Equity shareholders, if it is a high risky one. If the company's risk is very, very low, then no need to pay huge risk, right? These are the some of the important points to estimate cost of equity, dear students. One is the dividend. We complete cost of equity I explained, and thereafter I go on with here we discussed with the cost of capital, where we discussed the cost of equity, and before that we calculated cost of preference. Here cost of preference we discussed, and cost of debt also we discussed. Here cost of debt, cost of preference. Then coming to in cost of equity. In cost of equity, we discussed what is the no growth in dividend model and constant growth in dividend model, and thereafter EPS based equity, realized yield approach, and CAPM approach. With this, specific cost is completed. Now, basing on this, we have a certain problem to be identified. It's a very simple problems. You see here, we took it one problem from, yeah, directly we can take weighted average cost given. We will find it out the weighted average cost to be computed. How the weighted average cost is calculated, I will take the problem and I will explain it to you. Right. Coming to the next point is weighted average. Because you know, students, this is the marathon class, right? In cost of capital, by explaining one problem, it consumes entire time, because 9 chapters are there. We have to explain, means we have to understand the concepts. Okay, once you are good at concept, you can solve the problem. After going this entire video, you should be able to solve the problems in your study material or your concern material belongs to any of the institution. Okay, but coming to weighted average cost of capital, what is that? Weighted average. So estimation of weighted average cost of capital. Now, estimation of weighted average cost of capital, or AO. This is our topic now. So, estimation of weighted average cost of capital. So, company, after systematic estimation of various specific cost, the company ultimate job is to find it out overall cost of capital. Overall cost of capital, also called weighted average cost of capital. What is weighted average cost of capital? It is the point number one. It is the systematic summation of various specific costs, that is KE, KP, KD, KR, retained earnings. Okay, this is after systematic estimation of various specific cost. So we will systematically sum it up, right? How the corporate companies they used to sum it up, right? So here estimation of, here you have estimation of weighted average cost of capital. So how do you calculate estimation of weighted average cost of capital? In order to estimation of weighted average cost of capital, you may use two methods. You may go with, what is that? Two methods. One is product method. Product method. So in this product method, how do you calculate the weighted average cost? Means try to understand. Here you take like this. Here you see. First, what do you say? You will take the sources. What are the various sources in which the company raises funds? You identified. Then take the amount. How much amount to be the company supposed to raise? Okay. Then you can take specific cost. Specific cost. The specific cost may be KP, KD, or KR, or KP, KE, KP, KD. What you do is you can find it out the product. Product means multiply this both. Show here this value. And by multiplying this, what you will get? You will get the weighted average here. This is the amount. And coming to concept is, because of this much of cost you paid because of this. So weighted average cost of capital is summation of products divided by summation of amounts. Simply you can. So you say itna ko itna, utna ko itna ko kitna. So you can say simple logic behind this one is, so your product value you sum it up and amount you sum it up. For this much cost you are paying for, because of this, convert into percentage. You will get the weighted average cost of capital. Same this procedure they may use with x into x2, y is to summation, x means, like that. Different books they may convey, but ultimate point is same only. This is product method. Another one method you can go with what is it? Proportionate method. Proportionate method. In this proportionate method, what you are going to do is calculate its proportion or find it out its weights and multiply weights with a specific cost. For that purpose, simply I will tell you the shortcut, right? So what you do is, for weighted average cost of capital, so KO equal to, take the KE, right? And equity share capital divided by total capital employed. From equity share capital, if you divide it by the weighted average cost of, means total capital employed, you will get the proportion. Multiply with the specific cost. Then KP into preference share capital divided by total capital employed, plus KD into debt capital divided by total capital employed. You will get this. By summing up of this, you will get the answer, right? Both will conveys what is that? Same answer. Don't worry. Which method to be taken into the consideration? That is a choice. Okay, but in order to save time, better to move with what is that? Proportionate technique would be the best. So dear student, this is the point, right? Let's, you know that what is our various formulas? Cost of irredeemable debenture, cost of redeemable debenture, cost of irredeemable preference shares, cost of redeemable preference shares. Thereafter equity, under the equity no growth, constant growth rate, EPS based, realized yield approach, CAPM approach, right? CAPM approach, RF plus beta into RM minus RF. Realized yield, if you hold 1 year dividend yield, capital gain yield, sum it up, total yield equal to nothing but the KE. Like that, you read all the problems, then you can easily calculate. But the thing is, when you calculate this one, you should understand one more concept is marginal cost of capital. Marginal cost of capital. What is marginal cost of capital? This is an important topic. Marginal cost of capital. The word marginal indicates additional. Okay. After estimation of weighted average cost of capital, sometimes the company asks you that what would be the additional cost of capital. See, marginal cost of capital. Okay. Marginal cost of capital. It is the additional cost of capital estimated by the company when it raises additional funds. Okay, the points to kept in mind, right? When company rises, right, keep it in mind, additional funds. When company rises, what funds, dear student, tell me? When company rises, so when company rises additional funds, when company raises additional funds by issuing of debt, right, then automatically you have to, number one, calculate cost of newly raised debt. You have to calculate cost of newly raised debt. It's one point. And because of raising additional debt, right, because of raising this additional debt, right, it increases risk to whom? Equity shareholders. Existing risk to existing equity shareholders. Equity shareholders. When existing equity shareholders risk element increases, then dividend per share may increase, then growth rate may increase, then market price may decrease. If risk element is there, in such a case, what happen? You have to recalculate what is it? KE once again in order to calculate marginal cost of capital. That's an important point you kept in mind, right? Marginal cost of capital, it is the additional cost of capital when company raises additional funds. Okay, in additional funds estimation, you should able to concentrate on this concept, right? Additional funds, if additional funds are raised by debt, then calculate cost of newly raised funds in estimation of what is it? KO. So when additional funds you are raising and your job is to find it out the KO, overall cost of capital, then you have to concentrate newly raised fund you have to calculate. And number two, risk of whom? Existing equity shareholders also you must keep it in mind. That could be possible when a dividend may increase, growth rate may increase, market price may decrease. In such a case, recalculate KE and then you can use weighted average cost of capital. The methods are similar. Either you can use product method or what is that? Proportionate method. This is the marginal cost of capital. Thereafter, you have weighted average cost of capital basing on weighted average cost of capital basing on number one, A, book value, number two, market value. So weighted average cost of capital, this is the another concept. So weighted average cost of capital can be estimated basing on book value, basing on market value. So book value, market value, what is this? So book value is nothing but number of securities when it issued at the face value that would be taken into the book value. Whereas while calculating weighted average cost of capital, sometimes we may go with what value? Market value. So market value means today what is the market price is floating in the stock market. Basing on that, you can also calculate book value and market value. In calculation of book value, market value, values are changes, right? Values are changes. So while calculating weighted average cost of capital, book value, market value, right? The steps will remain same. Sources remain same, as well as amount varies. Why? Because number of securities into book value. You should understand, dear student, here book value equal to book value means what is a book value? Book value is nothing but number of securities into face value or book value. You can say book value, whereas market value, number of securities into market price as on today in stock market. So whether values you may take it, but one of the most important point to be kept in mind while calculating weighted average cost of capital, right? Only one point you should keep it in mind. That point is what would be the value with respect to what is that? With respect to book value, market value in estimation, cost of retained earnings. See, if there is no flotation cost, if in estimation, particularly KE, while calculating cost of equity, okay, cost of equity, you should understand retained earnings, cost of retained earnings, retained earnings. Dear students, you understand if the book value, market value is there, right? While estimating weighted average cost of capital, you see, estimation of weighted average cost of capital basing on market value, you should understand that if there is a flotation cost, right? Flotation cost is there, then the point to be identified like this. Flotation cost is there, then flotation cost exists. In such a case, KE is not equal to KR. In such a case, how much book value is there, right? In book value, how much the equity retained earnings is there in the same proportion in market value, you have to readjust because KE is not equal to KR. But in the problem, there is no flotation cost. In such a case, KE equal to KR. With effect, there is no need to consider KR retained earnings while calculating weighted average cost of capital. You can take directly. Okay, so I repeat once again, while calculating weighted average cost of capital basing on market value, if there is no flotation cost, KE equal to KR, then directly you can take total market value while estimating weighted average cost. But whereas if the flotation cost exists, in such a case, KE is not equal to KR in such a situation. So basing on book value composition of equity and retained earnings, market value also segregated, and basing on that you have to find it out this. Okay, so these are the points. I'll explain the problem in next class. Thank you. Right, dear students. So with this, we completed the various concepts, formulas, methods in estimation of cost of capital. You see, now we are going to move with the problems. Few problems we are going to take. From the examination point of view, there are the two models are very essential. One is weighted average cost of capital and marginal cost of capital, and at the same time weighted average cost of capital basing on book value and market value. You can find it out, but here I will kind of estimate because of since time is very limited. So for this purpose I am going to take a problem. Before going to this, let me check once again how to compute weighted average cost of capital. Dear students, cost of capital is the minimum rate of return that a company must earn by taking funds from the various fund providers, particularly equity shareholders, preference shareholders, and debenture holders. Yes or no, right? In order to compute the cost of capital, first our ultimate job is to finding of what is the cost of capital. 1 minute, here it is. Here cost of capital as marginal cost of capital we computed. Weighted average cost basing on book value and market value. So first what we have to do is we have to find it out various specific cost KD, KP, KE and KR. Now let's move into the few problems we solve here. The PK Limited has the following book value and capital structure. Equity share capital is 200 lakhs, whereas preference shares 6 lakhs, debenture 100 lakhs. Okay, total 360 lakhs. Dear students, let us understand clearly. The company raises funds from the various sources, particularly equity. For this purpose, you have to calculate KE. preference, you have to calculate KP. You raise the funds from debentures, you have to calculate KD, right? The equity shares of the company sold for 200 rupees. That is the market price is 200. It is expected that company will pay next year dividend is 10 per. Next year dividend, that is nothing but DPS1, right? Which is expected to grow. 5% is the growth rate. Tax rate is given, corporate tax rate 30%, right? And second point, what they're given is compute weighted average cost of capital or compute new weighted average cost of capital if company raises additionally 50 the debt by issuing to a 20 issuing 12% debentures. This would result in increasing expected equity dividend at 12.50 and leave the growth rate unchanged, and but the price of equity share will be 160. Right, now tell me, this is the problem is given here. The in this problem I'm going to discuss the two things. One is the cost of capital as well as marginal cost of capital. First of all, cost of capital, here the company raises funds from various sources, so you have to calculate KE. In order to calculate KE, that may be no growth in dividend, no growth in EPS, constant growth in EPS, constant growth in dividend, total yield approach, CAPM approach. You can follow different types of method, but in this problem, you have to find it out KE on the basis of constant growth rate model, because growth rate is given. That's why step number one, estimation of specific cost. Cost of equity, market price 200, growth 5%, DPS1 given directly 10. So KE equal to DPS1 divided by market price plus growth rate, 10 divided by 200 into 0.5. 10%. So KE is 10%. Cost of preference, preference dividend divided by net proceeds into 100. Preference dividend is 11.5. So net proceeds face value both remain same only, that is 11.5%. Cost of debt, interest into 1 minus tax net proceeds or market price 6.5%. Thus you have the data of KE, KP and KD. So you can calculate weighted average cost of capital. Weighted average cost of capital, KE into equity share capital divided by total capital employed plus preference share capital divided by total capital employed plus debt capital divided by total capital employed. So 200 divided by 360 into 10% plus 60 divided by 360, 11.5%, 100 into 100 divided by 360, 6.5%. Total is 9.27%. So this is the way to find it out, weighted average cost of capital. Now the point is, if the company raises additional funds by how much they said, dear students, listen carefully. Additionally, they raised 160. When company raises additional funds, then what the cost we supposed to calculate is called marginal cost of capital. So the marginal cost of capital comes to the picture only when company raises additional funds. But in this problem, in order to compute the marginal cost of capital, what to do? Step number one, you have to find it out what is that specific cost of each sources. Then you have to find it out weighted average cost. Here, when you are raising additional funds, means because of raising additional funds, there is a risk element to equity shareholders. With effect, market price decreases. With effect, growth remain unchanged. With effect, dividend also increases. So, dear students, considering this one, what you have to do, marginal cost of capital means, step number one, you have to calculate specific cost. Specific cost, what are they? Equity. Because of rising this debt, right? Rising debt, the company cost of equity elements changes. Now market price is 160, growth rate is 5%, DPS1 12 point. So KE equal to DPS1 divided by market price plus growth rate into 100, that is a 12.5%. Cost of preference, preference dividend divided by net proceeds or market price, 11.5%. Cost of debt old, that is a 6.5% as it is. Cost of new debt, you raised funds at 12% into 1 minus 0.35 divided by 100 equal to 7.8%. Now you can calculate marginal cost of capital, that is a new weighted average cost of capital. You can say it is a marginal cost of capital or new weighted average cost of capital. So where marginal cost of capital equal to 12.200 divided by 410, because of 410 previously 360 is there, again you raised 50. In such a case, what happened? 350 plus this additionally 410. So 200 divided by 410 into 12.75, 6.2%. 60 divided by 410 into 11.5, 1.8. 100 divided by 410, 6.5, 1.58. 50 divided by 410, 7.5, 0.98. By summing up of all the values, you will get marginal cost of capital 10.41%. So this is the very, very important model for calculation of margin. Coming to weighted average cost of capital, that nothing is a difference. Yesterday also we identified. To calculate weighted average cost of capital basing on book value, market value, only values changes. Values changes. Values into book value, values into book price or issue price, book value. Values into number of securities into, not value, sorry. Number of security into issue price, book value. Number of securities into market price, market value will get it. But only one point I remember, one point I told you yesterday, when flotation cost exists, then KE is not as same as a preference. KE is not equal to KR. In such a case, what to do? So as per basing on book value, equity as well as retained earnings, the same allocation or same proportion you have to make it with respect to market value also. That is the only point. Thereafter, most important problem in coming examination. Several times this model is asked. That's why I took this problem. This is the one more problem where in this problem you have to find it out a risk element of cost of debt, and at the same time estimation, debt equity ratio, several concept covers. Examination model is very suitable, and previous from past two attempts they couldn't ask this model. There is a chance to ask this. That's why my opinion is practice well this problem. Okay. Areas Limited wishes to raise additional finance of 10 lakhs. Okay. The 10 lakhs the company is supposed to raise 10 lakhs. It has a 2,10,000 in the form of retained earnings and investment following as details. So simply Areas Limited wants to 10 lakhs. Okay. They have how much of capital with them? 2,10,000 rupees in the form of retained earnings. Retained earnings are funds belongs to whom? Equity shareholders. Okay. Retained earnings or funds belongs to equity shareholders. So debt equity ratio 30%, 70%. Cost of debt is there. So cost of debt, if the company goes to raise funds by issuing debenture, it has to pay how much? Up to 1,80,000, they have to pay 10% before tax. Beyond 1,80,000, 16% before tax. Current earning per share is 4 rupees. Dividend payout ratio is a 50% of earnings. And expected growth rate dividend is 10%. Current market price per share is 44. Tax rate is 50%. This is the point is given. Debt equity ratio 30/70. What do you mean of this? Means the company has to raise the funds. Company has to, if the company raises the funds by issuing what? Issuing debenture, it has to pay 10%. But actually, we should not take 10%. Why? Because 50% tax advantage you are getting. You know the basic rules. How much interest we pay, from that interest to the extent of tax rate, we will get the tax advantage. I repeat, how much interest we pay, from that interest to the extent of tax rate, we will get what? A tax advantage. That's why here you have to take only 5%, because on 10% we used to get a 10% into 1 minus 0.50 means you have to take 5%. Here 16% into 1 minus tax means you have to take 8%, right? Whereas EPS is given 50% dividend means 4 into 50% dividend, you will get the 2 rupees DPS 0. Whereas growth rate is 10%, market price is 44. Basing on this, you are asked to following 1, 2, 3, 4. The pattern, determine the pattern of raising additional finance. How do you raise the finance, right? Very simple. The amount required is 10 lakhs. Okay. Amount required is 10 lakhs. Debt equity ratio is this. Then debt should be raised like this, right? 10 lakhs into 30%, 3 lakhs. Equity. Equity should be raised actually 7 lakhs, but the retained earnings are there 2,10,000. So equity to be raised is 4,90,000. Then estimation of post-tax average cost of debt. So here you see the company 1,80,000, they have to pay 5% means 9,000. 1,20,000, 8% means 9,600. Finally, for 3 lakhs, they have to pay 18,600. That means 18,600 divided by 3 lakhs into 100 means 6.2%. Okay. And estimation of cost of equity, you know that cost of equity, EPS into dividend payout ratio is the DPS. Growth rate is 10%, market price 44. With support of a constant growth rate model, where DPS 0 into 1 plus growth rate divided by market price plus growth rate into 100. 2 into growth rate is 1 or 10% divided by 44 plus 0 into 100 is 15%. So this is the pattern should be considered. Then what about the cost of retained earnings? Since there is no flotation cost, KE equal to KR. When there is a flotation cost is there, then you have to, I repeat again, when there is a flotation cost, in such a case, KR must be calculated by ignoring flotation cost in KE data. So in order to compute whatever the data given for estimation of KE, the same value you can take it. But the thing is, don't consider flotation cost. Why? Because when company wants to issue equity, then there is a flotation cost. But when the company wants to rise a retained earnings, maximum it won't find a flotation cost. Since in this problem there is no flotation cost, so KR equal to KE. Once you know all these things, then you can calculate what marginal cost of capital, where K equal to equity share capital divided by total capital employed, KR equal to retained earning divided by total capital employed, KD into debt capital divided by total capital employed. 15% 4.9 lakhs, 10 lakhs. 15% 2.1 lakh divided by 10 lakhs. 6.2% divided by 3 lakhs minus 10 lakhs. So if you estimate 12.36%. So these are the certain basic problems, dear students. Well, while going on discussing, we will find what is that several problems. Since the time element, this most important point, this one. Once again, the summary of cost of capital. I repeat, what is the cost of capital? Cost of capital is the minimum rate of return that a company must earn from its capital raised. There are four fund providers: equity, preference, debentures, and bank loan. Cost of debt. Cost of debt can be computed basing on irredeemability, basing on redeemable lump sum installment, right? Preference, irredeemable, redeemable lump sum installment. Thereafter, KE, no growth in dividend, no growth in EPS, constant growth in dividend, constant growth in EPS, realized rate approach, CAPM approach, right? These are the various methods you have, and even we can calculate KR. KR also estimated. KR is nothing but cost of retained earnings. When there is no flotation cost, there is no specific policy or method to be implemented because KR equal to KE. But the thing is, when the flotation cost is there, then you have to ignore, by ignoring flotation cost, you have to calculate KE, KR, that is the DPS1 divided by net proceeds plus growth rate formula, you may take it. And there is a one more alternative also is there to find it out, KR, investor expected rate into 1 minus brokerage, 1 minus personal tax. So 1 minus personal tax. This formula also can be used. Okay, these two problems and the specific cost, observe it, dear students. So cost of capital is very, very important examination point of view. Thank you. And the next chapter is capital structure. Capital structure. Dear students, capital structure. What is a capital structure? How we identify the capital structure? We are going to discuss now by taking the problem, right? Capital structure. Before going to solving this problem and having an idea, right? First of all, let me give you a brief clarity. Take a notebook, make a PowerPoints, right? It may be useful for you that, right? What is a capital structure? Capital structure. Dear students, whenever, point number one, here it is. Whenever company need a capital, see, whenever company need a capital, company plans to rise the funds, particularly these funds are long term funds, not short term funds. Okay, for example, you want to start a business with a need 100 crores, you cannot depend upon short term funds, you will depend upon long term funds. Okay, so capital rise funds, long term sources. The long term sources are, what are they? Generally you have equity, you have preference, and you have debentures, debt, right? From this long, these are the sources in which the company raises the funds. But the thing is, here the company has to raise these funds in such a way that, so that the objective of the company should be fulfilled. What is the objective of the company? Either market price should be increased, number two, EPS to be increased, or number three, overall cost of capital to be reduced. So you have to combine this three in such a way that market price should be increased, EPS should be increased, KO should be decreased. So that is the idea. Whenever company need a capital, you should not rise in your own way. There should be certain standard parameter, right? So what is the capital structure? Simply, what is the capital structure? It is the mix of long-term funds. Capital structure. अरे ये क्या गया रे? Here. Capital structure. Capital structure is the mix of long-term funds. Long-term funds, right? So the objective of this capital structure is optimum capital structure. So optimum capital structure. Company need a capital. If you rise in your own way, your objective cannot be fulfilled. For that purpose, you have to mix what proportion, what proportionate of equity, what proportionate of debt, what proportionate of preference. Well, sir, what is the wrong in this? Why should we go for proportion? Man, if you go with 100% equity, what happened? Satyam computer scam, you know that? Satyam computer scam was happened at the time. Ramalinga Rajgaru holding only little bit percentage. Okay, and Vijay Mallya, Coffee Day CEO, Reliance Company. You take this one, right? Reliance Company holds majority equity. Whereas if you have more major debt, right? If you raise funds 100% equity, what happens? Your ownership gets diluted. Since number of equity shares increases, EPS gets diluted. With effect, dividend gets diluted. With effect, the market price gets collapsed. Okay, then better to go with the debt set. When debt, if you go with means, you may be saved with a cost point of view, but whereas your risk will increase, irrespective of your performance, you have to pay interest. You have to pay cost. That means for each and every source have their own positives, their own negatives. So that's why, dear students, what we have to do means by analyzing risk, cost, control, comfortability, earning capacity, convertible capacity, cash generation capacity of the company, a company has to design an optimum capital structure. So optimum capital structure means it is the mix of long-term funds. It is the mix of long-term funds. Mix of long-term funds. Just now I told you. So company may make a highest market price. Maybe market price may be highest. EPS may be highest. KO may be decreased. So in order to select an optimum capital structure, right here, in order to select what is it? Optimum capital structure. Optimum capital structure. Company follows, right? Four approaches. Four approaches and four methods. Four approaches, four theories. They're not approaches, four analysis. Four analysis, four approaches it will follow. In order to maintain, okay, so it will take four analysis, four approaches. In order to select a capital structure best, right? It follows four analysis, four approaches. What are the four analysis, four approaches means? Number one, what is it? EBIT, EPS analysis. EBIT, EPS analysis. EBIT market price analysis. Indifference point analysis. And financial break-even point analysis. Financial break-even point analysis. So, dear students, these are the four analysis a company has to take. Okay, in order to select an optimum capital structure, the company makes what is that? Four analysis. Thereafter, four approaches. Approaches kya hai bhai? Number one, net income approach. Net income approach. Net operating income approach. traditional approach, and Modigliani approach. So these are the 4 approaches. So what is this? These two indicates means, dear students. Here you will make a observation. In this approaches, what happen? You can make, right? In this optimum capital structure, you have a 4 analysis, 4 approaches. EBIT, EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis. Coming to here, net income approach, net operating income approach, traditional approach, approach, various approaches, right? So here, how we use these analysis to pick it up or pick up best optimum capital structure, that's I'm going to tell you. The first of all, I'm going to tell you EBIT EPS analysis. What is that? EBIT EPS analysis. So first analysis, EBIT EPS analysis. Let's take in big letters. EBIT EPS EBIT EPS analysis. Okay. In this analysis, what is EBIT EPS analysis? I'm going to discuss with you. See, dear students, EBIT EPS analysis. According to this analysis, a company may estimate EPS in each of the financial plan. In which financial plan EPS is highest, that financial plan is selected. That would be considered as a optimum. Such a financial plan, such an analysis is called, what is it? EBIT EPS analysis. Very simple. It is the first analysis where the company estimates the EPS from the given EBIT. In which financial plan EPS is highest, that would be recommended as optimum capital structure. Right? In this analysis, what you have to do, in this analysis, you must be able to find it out. What is that? EBIT, EPS, EBIT, you have to find it out. So now let us take, how do you calculate EBIT? EBIT means sales, right? Take sales minus variable cost minus contribution, you will get it, minus fixed cost. If you deduct, you will get what? EBIT. Then how do you get the EPS from it? Very simple. Take EBIT minus deduct interest. What you will get? EBT into 1 minus tax. You can make it EAT minus preference dividend you paid, earning availability equity shareholders, divided by number of equity shares. Number of equity shares. You will get the EPS. There the matter ends. So in this analysis, we take EBIT and EPS. EBIT minus EBIT, how do you get? Sales. From the sales, deduct variable cost, you will get the contribution, less fixed cost, you will get the EBIT. Okay. From that EBIT, what you have to do is EPS, you have to find it out. What is the journey? EBIT less interest, EBT less tax, EAT, and minus preference dividend, you will get earning availability to equity shareholders, divided by number of equity shares, you will get the EPS. This is the first method. Okay. Let's prove a small problem. I will take the problem and I will discuss with you. The following data presented by respect to Quality Automobile Company. So here you see that the company has either prop, here it is. Okay. So in this problem, from earning before interest and tax is given, less interest before tax is given, less tax, you will get the EAT, number of equity shares, you will find the EPS. This won't be here, it is here. You see the best. I will take all the analysis with this problem, right? The first analysis is not in middle. I will take the all the problem in one analysis. This is called EBIT EPS analysis. Okay. EBIT EPS analysis is the first analysis. Thereafter, what happened? We will move to another analysis. Analysis number 2. What this analysis is? What this analysis is? EBIT market price So first one, what we calculated, EBIT EPS analysis. According to this analysis from EBIT, we will calculate EPS. Which financial plan gives you highest EPS, that we will recommend. Thereafter, we will go with what is that? EBIT market price analysis. What is this market price analysis? According to this analysis, what we do is we will find it out market price from each of the financial plan. Which financial plan has the highest market price, we will give preference to that financial plan. So that is the EBIT market price financial. Now you can say, so in this analysis, in this analysis, in this analysis, one must estimate market price in each of the financial plans. Each of the financial plans. Which financial plan? Which financial plan has highest market price? That would be considered to be considered as optimum capital structure. So in this analysis, one must estimate the market price in each of the financial plan. So in which financial plan has the highest market price, that would be considered to be, what is it? EBIT market price analysis. Okay, this is EBIT market price analysis. This is the analysis. In this analysis, what you have to do? Calculations. So how do you find it out? First of all, you have to calculate EPS, right? EPS, already I told the formula, EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. You will get EPS. Then you have to take the PE ratio. PE ratio. PE ratio is ratio which shows the relationship between market price and EPS, where market price divided by EPS. This is the PE ratio. Basing on the PE ratio, you can calculate market price. Market price equal to EPS into PE ratio. Now tell me, what is a market price? Market price, market price, PE ratio. First of all, in order to find it out market price, you must understand what is that PE ratio. PE ratio is the ratio which shows the relationship between market price and EPS. It indirectly conveys how many times, the number of times the market price is floating higher than EPS of the company is nothing but the PE ratio. For example, PE ratio of the company is 40. What it conveys? So it conveys that the PE, comparing to earnings of the company, market price is floating more than floating 40 times higher than EPS. If you go with the net, right, you can find it out the various stocks and securities. In live, I will tell you. I will take. Shall I take one? SBI. We will check it. SBI PE ratio. PE ratio of SBI given, right? SBI PE ratio is nothing but 14.42. What do you mean of this? SBI PE ratio is of 14.42. It indicates that currently the market price of the SBI is floating higher than 14 times is higher than comparing to its EPS. So that is the PE ratio. You can also go with several securities, several, not only SBI, MRF. You can take it MRF. You can take MRF. The MRF PE ratio is a given here. MRF PE ratio 60.34. I got 60 times is higher than this. So this is the dear student. So point is very simple here. So what we have to identify is PE ratio. Now got the point. Practicality also I am showing here. So PE ratio, EPS, PE ratio, market price. In each financial plan, you have to calculate PE ratio You have to identify market price, right? Calculate market price by taking PE ratio. Okay, in which financial plan is the highest market price, that plan should be considered to be optimum. Let us solve a small problem where the PE ratio market price, you see here. In this problem, I am going to consider EBIT EPS analysis as well as market price analysis also. The following data presented the Quality Automobile Limited. Profit before interest and tax is 52 lakhs. Less interest 12 lakhs. Interest is 12 lakhs means interest divided by 12%, you will get the amount of debt. Okay. Then profit before tax, income tax rate is 20 lakhs. Profit after tax is 20 lakhs. Number of equity share 8 lakhs. EPS is 2.5. PE ratio 10 times. Market price is 25. This is the data given to you, student. Now coming to the point, the company planning to start a new project require capital outlay of 40 lakhs. So try to understand, this is the existing company, because already they are paying interest means they would have raised a debt. Already they have number of equity shares means they have raised by equity. And now the company need capital worth of how much? Starting 40 lakhs. So you are informed that debt equity ratio. What is a debt equity ratio? Debt equity ratio, it is a ratio shows the relationship between debt amount in total capital employed. So debt divided by capital employed is nothing but debt equity ratio. Okay, higher than 35%, which pushes the PE ratio to 12.5. KE pushes the KE 12.5 means reducing the PE ratio 8 and rise the interest rate on additional amount borrowed is 14%. Find out the probable price of the share. Very simple model, simple problem they asked it. So currently the PE ratio is 10. Currently the company has a debt. The company has a proposal to raise additional 40 lakhs. This 40 lakhs company rises, it has a two alternatives. Either go with the debt, right? Here it is given. The additional funds are raised by loan. Additional funds are raised by issuing equity. And the retained earnings are how much? 12.5 crores. Okay, this is the point. Now let's make a small analysis we will make outside. Now the company, this is a company. Okay. The company is number of equity shares are there. Number of equity share there means they would have raised equity share. That means equity share capital is there. Thereafter, company making a payment of interest. It means that they would have raised funds by debt. And company is saying retained earnings 1.2 crores something they projected in value. Here it is 1.2 crores. That means the company already raised funds from equity, debt and retained earnings. Now the question is, company need additional funds. By raising this additional funds, company has a two plans. This is the point. Now additionally they need a 40 lakhs. This 40 lakhs the company may go with what is a two financial plan. Either they may go with the debt and they may go with the equity. But the point is, any of the plan they may choose it, but a debt equity ratio, if it is a more than 35%, then PE ratio currently is there 10, it may come to 8. If not, debt equity ratio is equal to 35% or less than 35%, then PE ratio would be 10. Basing on this information, you have to calculate a market price in each of the financial plan. Okay, to find it out this plan, first of all, we should understand what would be the rate of return the company able to generating now. Because you have a debt, you have a equity, you have a retained earnings. By even having all this money, you are investing in a company and making a profit means, what is your rate of return on capital employed? Sir, why should you need this one, sir? Yeah, because the reason is very simple. When I'm raising 40 lakhs and I'm going to raise a 40 lakhs, that 40 lakhs, what I do? I will invest in this business. So if I know currently what is the rate of return the company able to generate means, then only I will take an assumption that right, that additional funds also company able to generate the same return. Are you getting my point? Or otherwise, can I take an assumption like this? Even after raising 40 lakhs also, should the company makes the same return? No. So it could not possible, because of while investing 40 lakhs, you are unable to generate means it's really silly assumption that is. So what the point is, we assume that whatever the rate of return the presently the company is making from the given capital employed, In future also, in future capital or future or additional capital employed also, company able to generate same return. So that is my assumption, right? Basing on this, how do we have to find it out? Estimate what is the present capital employed, you calculate. You see it here, the present capital employed. Present equity is there, number of shares into 10, 80 lakhs. Debt, interest divided by rate, 1 lakh. Retained earnings, 1,20,000, 3 lakhs. So total capital employed of the company current scenario is how much? 3 lakhs. What is the present EBIT? 52 lakhs. What is the return on capital employed now? Return on capital employed, EBIT divided by total capital employed into 100. That means 52 lakhs divided by 300 lakhs into 100 is 17.33%. It means that currently company making return of that 17.33%. It means that if the company able to generate additional funds, right? So the same rate of return the company able to generate. It is a common. That is the reason proposed EBIT would be present capital employed 300 lakhs plus this is the 40 lakhs. Okay, here 40 lakhs. 300 plus 40 into 17.33 means 58 lakh 92,200 rupees. The company expected to generate in future. Okay, now that would be, while basing on this, we can calculate estimation of EPS in each of the financial plan. How many plans are there? Plan 1 and plan 2. First, if you have to take EBIT. EBIT already we showed a working note is 15 lakh, 58 lakh 92,200. 58 lakh 92,200. Interest in plan 1, 100% debt. In plan 2, 100% equity. But keep it in mind, the company is the existing one. Even if you raise additional funds by debt means you have to pay old interest, new interest. If you go with the 100% equity means you have to pay old interest because the company is an existing company. Right now, less interest. Interest old plus new. Old already given there and new 40 lakhs into 14% this time. So 17 lakh 60,000. Here 12 lakhs zero. Why it is zero, sir? Because it's a new, it's not. For additional funds you are raising by equity. In such a case, for newly raised funds, there is no need to pay interest, right? 12 lakhs. Okay. Then EBT, you will get it this one, right? Less tax rate is 50%. So 20 lakh 66,100, 23 lakh 46,000. Then EAT, 20 lakh 66,100, 23 lakh 46 because the 50% tax rate. Then you will get it EPS, number earning availability equity shareholders divided by number of equity shares. Number of equity shares. Sir, here you are raising plan 100% debt, sir. Why you take number of equity shares? My dear, old shares are there, That is the reason. Old shares, 8,000 shares as usually come. Whereas here, old shares, additionally you are raising 40 lakhs. Currently, market price is 25. So 40 divided by 25, you will get the 9 lakh 60,000 in total. Then EPS, earning availability equity shareholders divided by number of equity shares, 2.58, 2.44. Debt equity ratio, debt divided by total capital employed. If you calculate, it would be 41.18%, which is greater than 35%. In such a case, PE ratio, take it at 8. But whereas here is 29.12. Here, debt divided by additional capital is 0 divided by 340. So that would be 100 divided by 340 into 100 means 10. Next, market price. Market price equal to EPS into PE ratio. Market price into PE ratio 20.64, 20.64. Now decision. Since market price is highest in option 2, so it is beneficial, advisable to raise the additional funds by issuing of what? Debt. So it is assumed that company able to generate same return on what is that capital employed on additional funds also, that is a 17.33. 17.33. So this is the point, dear students, right? So simply what we have calculated from the EBIT, we identified from the EBIT, we calculated EPS. Okay. And by calculating debt equity ratio, we identified how much would be the PE ratio to be taken into consideration, and EPS into PE ratio. By multiplying both, you got market price. Which financial plan market price is highest, that should be considered, right? EPS formula, earning availability equity shareholders divided by number of equity shares. PE ratio formula, market price divided by EPS. Debt equity ratio formula, debt divided by capital employed. What debt equity ratio conveys? How much percentage of debt is there in your capital employed? As debt increases, company risk increases. As risk increases, equity shareholder PE ratio start to decrease. That's why keep it in mind. I will tell you a small logic. When you raise a debt, since interest is least one, it makes EPS is highest, because comparing to equity or preference dividend, debt cost is least. That's why there is a chance to get high EPS. But whereas if you raise additional funds by issuing of debt, right? And if you expect a market price because of increasing debt, risk element of equity shareholders increases, that may push down your PE ratio. Okay, PE ratio indirectly your market price also decreases. This is the two analysis: EBIT, EPS analysis, EBIT market price analysis. Now we will move to another two more analysis, that is indifference point analysis. Another one is a financial break-even point analysis. Thereafter, I will explain all these things. Now, indifference point analysis. What is indifference point analysis? Okay, what is indifference point analysis? That is a most important point to be considered. Indifference point analysis. Indifference point analysis. Indifference point indicates that there is no difference. Indifference point analysis. It is the analysis which explains that it is the level of EBIT at which EPS remains same between the two financial plans. So indifference point analysis means it is the level of EBIT. Dear friends, very simple logic you see it. When you are raising a funds, you want to raise the funds. You have two proposals. Plan A, plan B is there. Plan A 100% equity. Plan B 50% equity, 50% debt. Then first of all, you will have a thought that in which financial plan would be the best. So the indifference point, what it explains means, my dear brother, my dear student, if you are able to generate this given level of EBIT, at that level of EBIT, both the plan will submit same EPS. When both the plan will give you same EPS, then there is no need to worry about which financial plan would be the best. But really, if you want to choose which plan would be the best, means try to understand whatever the indifference level EBIT you calculated, you hold it, and you compare with what would be the expected EBIT the company is supposed to make. If the company able to make more than indifference level of EBIT, then we can come to conclusion that company has a risk bearing capacity. Company able to earn fixed financial commitment of the company. In such a case, given two financial plan, which financial plan has high risk one, better to take it. Here risk means having fixed financial cost, maybe debt or maybe preference. So what we can say that if you are able to earn more than indifference level of EBIT, then you are generating more than coupon rates of concern associated funds, maybe debt interest, maybe preference, right? That would be preference dividend. So that is the indifference. If the company not able to generate EBIT more than indifference level EBIT, then better to don't take risk, go with which financial plan has least risk. So that is the point of indifference point. I will give you some information. What is indifference point? So indifference point or indifference level of EBIT. It is the level of EBIT at which EPS remains same in between two financial plans. Okay, from this point, what is indifference? It is the level of EBIT which EPS is remains same between two financial plans. It not happens one financial plan, it happens between two financial plans. So that is the indifference level of EBIT. Okay, next, how to compute indifference point analysis? How to compute indifferent point or indifference level of EBIT, right? What is the indifference point is? Indifference point is you have to take plan 1, You have to take plan 2. Well, sir, by chance 3 plans are given in such a case. Plan 1, plan 2. 3 means plan 1, plan 3, or plan 2, plan 3. Like that, right? Indifference point. See, the hidden idea for this one is EPS of the two financial plan remains same. This is our idea. EPS here, both remain same only. For that purpose, what we say is indifference level of EBIT. How we compute here it is the level of EBIT. What we say EPS should come, right? So EPS, how do you calculate? EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares equal to EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. Sir, formula seems to be same. Formula seems to be same, but amount may varies, Here the plan is 100% equity. Here 50% equity and 50% debt. In such a case, here 100% equity means what won't come? Preference dividend won't come, interest won't come. Okay, tax may come. But here everything is there. 50% equity, 50% equity, let us take 20% debt and 30% preference means you have interest, you have a preference dividend, you have a number of equity shares, everything. So this is the formula. By resolving this one, you have to find it out. For that purpose, we will estimate that this would be X value. Here also EBIT, we will take it as a X value. By resolving this equation, we will find indifferent point or level of EBIT. Okay, level of EBIT. Let us take a 50,000 K. Let us take 50,000. What this 50,000 Indian? By resolving this X or indifferent point or level of EBIT, what you get? What we can say that it is the level of EBIT if the company, how much capital company may need it, if the company able to rise by issuing debt, by issuing equity, if the company able to generate just 50,000, then no matter of selection of given financial plan, which plan would be the best? Why? Because at this 50,000, both financial plan will gives you same EPS. And EPS is same, then both plan are considered to be same only. But the point is, if then okay, sir, but actually we have to select, you're saying 50,000 that, but we need to find it out which plan would be the best. For that purpose, we can say one thing. If the company able to generate more than 50,000, then better to choose risky plan. That is which one? Plan 2 better. Because it is 100% equity. It is a debt preference is that company able to generate more than its cost. But if the company not able to generate more than 50,000, better to go with the equity. Sir, equity means their EPS is low, sir. If you think like that. See, my dear student, I go to the shop, right? I will find a shirt, right? I want to buy a shirt. Shirt color is good, fabric is good, price is good, everything is good, but it's not my size. What should I do? Sir, go with the alteration means, buy. When you are not at all buying again, you are going for alternative means. Alteration means it's not a good. Thing is, it won't suits to you. For example, today my birthday, I give to you as I will give a cake to a person who is suffering from sugar. Indirectly, I am not celebrating my birthday. Indirectly, I am giving a some poison to concerned party, right? That harms him in a very worst way. So, what the point of indifference point is, students? It is the level of EBIT at which EPS remains same between two financial plans. Estimate first. Thereafter, identify that whether the company has a capacity to generate more than that, then better to choose risky one. If not, go with the equity, right? So, dear students, so yesterday we discussed about indifference point. So, today we're going to discuss financial break-even point. What is that? Financial break-even point. Already in previous class, I told you that in order to select a capital structure, an optimum capital structure, what you have to do is, do you remember? Capital structure. Capital structure is a mix of long-term funds. Our ultimate objective is to, when company need a capital, we will raise this capital from various long-term sources. see to that because of our financing decision, the company has to increase its wealth. When wealth has to be increased means, number one, earning per share should be increased, market price may be increased, or else overall cost has to be decreased. In order to catch that point, right, we make a four analysis and four approaches. Four analysis, EBIT, EPS analysis, just I completed. In this analysis, we compute EPS from the given EBIT. Which financial plan gives you highest EPS? That would be considered to be an optimum. Thereafter, we discussed EBIT market price analysis. In this analysis, what we believe is in which financial plan market price is highest, we recommend that would be an optimum. In order to calculate the market price, what we do, we will multiply EPS with a PE ratio. What is a PE ratio? It is the ratio which shows the relationship between EPS and market price. Okay. Thereafter, financial break-even point. Thereafter, indifference point. This is also we discussed yesterday. So, indifference point, it is the level of EBIT at which EPS remains same between two financial plans. It is the level of EBIT at which EPS remains same between two financial plan is called indifference level of EBIT. If the company able to generate more EBIT comparing to indifference point EBIT, then it is advisable to choose a risky financial plan. If the company not able to generate EBIT more than indifference level of EBIT, then advisable to go with a low risky financial plan, preferably 100% equity. That's we discussed, right? Thereafter, in this session, we're going to discuss one more analysis, financial break-even point analysis. What is it? Financial break-even point analysis. Financial break-even point analysis. Financial break-even point analysis, right? Financial break-even point analysis is one of the analysis, dear students. In this analysis, what the corporate company do is it will estimate level of EBIT at which EPS remain zero. Means in this analysis, what the corporate company they used to estimate that what would be the EBIT the company must earn in order to handle its fixed financial commitments. Okay, so that is the financial break-even point. It comes to conclusion that if the company able to make EBIT more than the financial break-even EBIT, then only they will get the money in their pocket. Otherwise, no. Let's see what is the financial break-even point exactly it indicates. Financial break-even point. It is the level of EBIT at which EPS of the company is zero. This is the first point. Another point is at this level, EBIT of the company must equals to its fixed financial commitments. Fixed financial commitments. So indirectly what it conveys is financial break-even point at which EBIT of the company must be equal to the company must pay its interest if it company goes with 100% equity and plus preference dividend divided by 1 minus tax. Because preference dividend, how much you have to pay preference dividend? To the extent of preference dividend, if you make a profit, you cannot survive in the market. Why? Because of, for example, let us take 100 rupees, 100 crores is the preference dividend you have to pay. Let us imagine you earned 100 crores. From the 100 crores EBIT, you have to pay interest. Let us assume no interest. Then that turns to EBT. From that EBT, you have to pay tax. Then you will get, what is it? EAT. From the EAT, you have to pay the preference dividend. So, whatever the profit you made it, from that you have to pay preference dividend. So, rest amount flows to whom? equity shareholders. That's why EBIT 100 crores, 50% tax goes means only you have 50, whereas you have to pay EBIT 100. So it would be very difficult for you to make a payment of preference dividend if you make same level of EBIT in the presence of tax. That's why your commitment is to preference dividend divided by 1 minus tax. So this is the financial break-even point, students. Have you got my point? Financial break-even point. What is the financial break-even point? It is the level of EBIT at which EPS will remain same between two financial. It is the level of EBIT at which EPS is 0. So don't go to that one. That is a mid-difference level of EBIT. Got the point? Now I'm going to solve all this analysis, right? Previously, I solved a problem, EBIT EPS analysis. Now we are going to take a problem from indifference point. Let us take. Well, we are going to solve the problem number 2. In this problem, I am going to explain what is the EBIT EPS analysis, how to identify indifference point analysis, as well as financial breaking point also. See, Ganapati Limited considering 3 financial plans. The key information is as follows. Total investment to be raised 2 lakhs. Plans of financing A, 100% equity. Thereafter, you have B, 50% equity, 50% debt. C, 50% equity, 50% preference. Try to understand, dear students, when you go with the debt, right, you have to pay interest. You have to pay. It is your commitment. When you come to preference dividend, you have to pay preference dividend. This is your commitment. Now, cost of debt is 8%. Cost of preference 8%. Tax rate is 50%. Equity share face value is 100 rupees each. Will be issued at a premium. Okay, equity share. Expected EBIT is 80,000 rupees. Now, earning per share, that is nothing but indirectly from the EBIT as given. From the EBIT, you have to find it out EPS. That is called EBIT EPS. As per EBIT EPS, which financial plan is to be considered? Used to calculate those financial plan or that finance. You have to calculate EPS in each of the financial plan. Which financial plan has the highest EPS, that should be recommended. Thereafter, financial break-even point. Financial break-even point, it indicates it is the level of EBIT at which EPS will remain. EPS remains 0. And thereafter, indicate any of the financial plan dominates EBIT range among the given plans. It means that you have to calculate indifference level of EBIT among the given plan. First, we will calculate EBIT EPS. Computation of EPS in each of the financial plans. Equity, first plan, plan A, plan B, plan C. Plan A is what? Plan A is 100% equity. Plan B, 50% equity, 50% debt. This is not equity plus debt. This is equity plus preference, not 100% preference. Okay, that is small modification. You can understand. Now EBIT, they made it 80,000, 80,000, 80,000 less interest. First plan, you won't find any interest. The reason is very simple, because it goes with the equity. Coming to second plan, there is a chance to go with what is that? Equity plus debt is the debt. To the extent of debt, you have to pay interest. Already they said that the capital requirement of the company is how much? 2 lakhs. From the 2 lakhs, the B plan is debt to 50%. 50% means 2 lakhs into 1 lakh. 1 lakh into 8% rate of interest is. That is nothing but here 1 lakh into 2 lakhs into 50% into 8% would get 80,000. In the plan B, the plan C is nil because it is a preference. Then you, after deducting EBIT less interest, you got the EBT. Then you will get the tax at 50%. 50% you got the EAT. Then less you have to deduct the preference dividend. First plan won't come because you raised the equity. Second plan won't come, equity plus debt, right? Third plan, preference dividend you have to pay. How much it is? Total you are raising 2 lakhs. Out of that 50% is 1 lakh into 8%, 8,000. Next, from EAT, if you deduct preference dividend, you will get the earning availability to equity share 40,000, 40,000, 36,000, whereas 40,000, 8,000, 32,000. Then earning availability equity shares divided by number of equity shares. Number of equity shares 40,000 divided by 10,000 4 rupees. 36,000 divided by 5,000 7.2. 32,000 divided by 5,000 6.4. Then this is the identity. If you want to choose which plan would be the best, then better to go with the financial plan which has highest EPS. That is a plan B, where company go with a debt plus what is that, equity and debt. That plan would be the best. This is the EBIT EPS analysis, right? EBIT EPS analysis. How we find it out, right? We calculated what is that EPS from EBIT minus interest EBT less tax EAT divided by number of equity shares. We got the EPS. So which financial plan has given highest EPS, that we recommended, right? Thereafter, you have financial break-even point, right? Financial break-even point. Financial break-even point means it is the level of EBIT at which EPS will remain to same. So financial break-even point, level of EBIT at which EPS is remains zero, not same. I used word same, sorry, zero. In plan 1, no, because in plan 1, nil. Reason is no preference share capital, no debt. That is the financial break-even point is zero. Whereas in plan B, you are moving with the debt, you have to pay interest. In plan C, you have to pay 16,000 rupees. The reason is very simple, because 88,000 rupees preference dividend you have to pay, and tax, if you consider 8,000 divided by 1 minus tax 50% means 16,000 preference dividend you have to pay. So this is the financial break-even point. Next, dominating, which financial plan dominates, means indirectly they are asking you to find it out in difference point between the plan A and B, B and C, and A and C. So indifference point level, what is the formula? EBIT minus interest into 1 minus tax divided by 1 minus tax minus preference dividend divided by number of equity shares. Like that, plan A and plan B you will take. Now, coming to here, first you take the plan 1, plan A and B. Here plan A moves with 100% equity, plan B with 50% equity, 50% debt. Plan A, X minus interest is 0. Why? Because it goes 100% equity, right? That is the reason interest is 0. 1 minus tax divided by 10,000 shares. In plan B, X minus 50,000 debt is there. That's my 8,000. X minus 8,000 into 1 minus tax 50% divided by 5,000. 5,000 into 5 twos. In such a case, what happened? 0.5x. If you multiply this 2 with this 0.5x, right? And if you multiply this 0.5x minus 4,000, 0.4, and if you multiply this with this 2, right, it will become 2 into 0.5x means x, and 4,000 into 2, 8,000 you will get it. X means 8,000, x equal to 8,000 divided by 0.5. So x equal to 8,000 divided by 0.5, that equal to 16,000. It means that what this 16,000 it indicates. If you are able to make 16,000 rupees of EBIT, right, any of the plan would be the better. Any of the plan would be the better, either plan A, plan B. But if you can able to earn more than 16,000, better to go with the plan B, which consists of debt. Why? Because you supposed to, you are earning, if you are, when you are making more than 16,000 means you are earning more than coupon rate to be paid. In such a case, certainly it would be best, right? Coming to B and C, come to B and C. B indicates 50% equity, 50% debt actually. Whereas C is nothing but 50% equity plus 50% preference. So here, if you come to the calculation point of view, calculation point of view, x my x, if you make it x minus interest to be paid 8,000 into 1 minus tax minus preference dividend 5,000. So x minus 0, 0.5 minus 8,000. So 1,000, 1,000 gets cancelled. In such a case, x equal to x, right? That 1000 gets cancelled means automatically into x gets cancelled. It means that there is no indifference point between plan B and C. So indifference point arises between two financial plan, but it does not mean that every two financial plan must have what? Indifference point, right? Next, another one is coming to indifference point A and C. A and C. A indicates 100% equity. C indicates 50% equity plus 50% preference. Now, x minus 0 because 0 because 100% equity, right? That is a x interest equal to 0 into 1 minus tax 0.50 preference dividend divided by 10,000. Now, x minus 0 into 0.50 minus 8,000. Here 5,000 ones, 5,000 twos. 0.5x divided by 2 equal to 0.5x minus 8,000. If you resolve this one, right, then you will get x equal to 32,000. So 32,000, it indicates what? The 32,000 is the indifference point between A and C. It means that if the company able to generate more than 32,000, right, in such a case, better to go with the C. But whereas if the company not able to generate more than 32,000 or at least less than 32,000, better to go with which one? Equity. So this is the identity. It means that there is an indifference point between A and B, A and C, but not B and C. Okay, this is the way to find it out, indifference point analysis also, dear students. So with this discussion, I successfully completed four analysis. One is the EBIT APS analysis, EBIT market price analysis, indifference point analysis, as well as financial break-even point analysis. By making all this analysis, one can identify an optimum capital structure. Okay. Next, to move to approaches. We will move to approaches. The next one is the next one is the next one is approaches. See, approaches technically called theories. Technically called theories. So that is called a capital structure theories. Also, you can identify, right? Let us move into approaches or capital structure theories. Capital structure theories. Right. Now we are going to discuss the capital structure theories. A theory is nothing but statement of fact based on certain assumption and conditions. These theories guide us to select an optimum capital structure. So where it is very essential for the company to raise the funds in an optimum level, in a best level. So for that purpose, we have different types of theories. Let us make what is a theory. So here we will make an observation that a theory is the statement of fact. A theory means a statement of fact based on certain assumptions and conditions. You see, every theory is based on certain assumptions and a certain condition. Unless until you cannot follow these assumptions and conditions, you cannot identify a capital structure theories well, right? Any theory. And another one is these theories guide us to identify or select an optimum capital structure. This theories identified guide us to select an optimum capital structure. Optimum capital structure. They will support us to find it out an optimum capital structure. Right here, this theories is based on certain assumptions. You have to understand all the theories are based on certain assumptions. So first assumptions of the theories. You have to go with the assumptions of theories. Assumptions. There are only two sources of funds. There are only two sources of funds. One is equity, another one is a debt. But there is no preference. Okay. And another one is cost of debt is less than cost of equity. So the debt which you supposed to rise in the market is always less than cost of equity. Next, risk element of, that means business risk remain constant. Remains the same. You may say that, for example, you are raising funds by either debt or equity. It does not mean that what happened, your value will remain same, right? Your value will remain same. When you are doing business, a business has its own risk, right? Because of your debt equity mix, the business risk are never affected. But you might have the financial risk. Because when you're raising a debt means you have to pay interest. It does not mean that business risk reduces. No, business risk remain same. Another one is there is a capital, there is a EBIT. There is a EBIT. You can say it means that when you are raising funds, you are doing business. Will you get a loss? When you are getting loss means then we won't raise the funds, right? So we have an assumption that while raising a funds, we do business and we won't get loss. We will get what? Profit. We will get EBIT. The environment would be favorable to us. That's our basic idea. So if you take an assumption that, sir, what might happen if the company able to generate a loss, in such a case, what to do? No, we won't take an assumption. We take an assumption that we will raise the funds and we do business. We will make a profit, but we never make a loss. Then there is a capital employed remain constant. Capital employed remain constant. It means that you need 100 crores. In the 100 crores, you may raise a debt equity in different combination, but thing is, the total capital employed remain constant. If you increase the debt, you reduce the preference. If you increase the preference, you can reduce the debt. It means that the debt equity combination may changes, but the total capital employed will remain constant. Okay. So these are the certain basic assumptions. There are only two sources of funds, debt and equity. KD is less than KE. Business risk remain constant. There is a EBIT, capital employed remain constant, and there is no tax. There is no tax. Means when these theories were projected at the time, the tax rate was not there. That is the reason these assumptions are taken. I already told you that what is a capital structure theory. Each theory is depends upon different types of assumptions. Basing on these assumptions, we have to identify, and there are different types of approaches or theories. Okay, what are the approaches or theories means? Already we discussed uh, types of theories. Already I told you what are they. Number one, net income approach. Net income approach. B, net operating income approach. Traditional approach, and Modigliani Miller approach. These are the theories. So the theories here, theories assumptions, and the theories types we discussed, right? Now we will take the first one is net income approach. What is that? Net income approach. Net income approach. See, net income approach. This approach was proposed by. This model was proposed by David Durant. Net income theory was proposed by David Duran, right? According to this theory, what it conveys indirectly, I'm giving a brief way, right? According to this approach, according to this approach, debt equity mix, a a company a company may reduce its overall cost of capital and increases its market value of firm by employing least cost fund called debt. Right. What this David Duran net income theory conveys to you? David Duran net income theory conveys this theory is very favorable to debt. This theory argues that a company may reduce its KO and increase its market value by employing least cost fund called a debt. So he initially speaks that if your objective is to maximize EPS or maximize value of firm means try to rise a debt. Why? Because when you rise a debt, debt is cheaper than equity. With effect, KO starts to reduce. When KO starts to reduce, market value of firm will increase. So every company ultimate objective is to maximize their wealth. Maximizing wealth means market value of firm to be increased. Market value of firm to be increased means KO has to be decreased. KO has to decrease means least cost fund should be employed. Least cost fund is which one? Equity. Because there is only two sources of funds. One is the debt, another one is equity. Preference is not there. You cannot raise equity because the equity cost is high. When the equity cost is high means highest cost oriented fund. How do you raise, man? That is his idea. So he believes that debt is always best because of least cost. Right? Okay. There is a point that this theory argues that is there any risk to equity shareholders? Assumptions you can take it. Assumptions. What about the risk assumptions? Assumptions. What the assumptions we can take? A. KD and KE remains constant. KD and KE remain constant. Because of this, there is no risk element to whom? Equity shareholders. And there is a point KD is less than KE. So this idea is that a company raises more debt, right? Since it is the cheapest. Since it is the cheapest. So because of debt, right? KO starts to decrease. And KO starts to decrease, then market value of firm is increases. So that is the idea for this one, right? Now coming to here, this theory, if you observe the diagrammatic representation, I will explain here what Mr. Modiglani Miller wants to convey. So here there is a equity and debt. Let us make it observation. Here it is. Okay. Hmm. Here a company is there. This is called equity, and this is a debt is available. Okay. Let us make an observation that here this is a equity. That is nothing but KE, cost of equity curve. So KE is, let us make it 20%. KP, which is available at a 10%. This is a KD. This is x-axis. Here, capital gearing. Capital gearing. What is his point is, when company starts to rise more debt, right? As a more debt gradually increases with effect of here KE equal to KO also. Both would be there here. KE equal to KO when company moves with 100% equity. When company moves with 100% equity, KE equal to KO. Once the company rises a debt, gradually, what happens? This this KO, this KO gradually from decreases, and at one point of time it may reaches to KD. So this is called KO. as debt increases, since there is no risk to whom? Equity shareholder, because of employing least cost fund in company, KO gradually decreases. When KO decreases, market value of firm increases. So that would be the idea about this one. This is the net income theory. In net income theory, the calculation point of view, we have to prove that market value will increase. When market value will increase means because of debt, right? So KO has to decreases or market value firm increases. So the point is, first of all, what you do is you have to calculate the market value of debt. Market value of debt equal to interest divided by KD. Thereafter, calculate market value of equity. Market value of equity equal to earning availability equity shareholder divided by KE. Then you calculate market value of firm. Market value of firm equal to A plus B. That is market value of debt plus market value of equity. Then you can calculate the KO. KO equal to EBIT divided by market value of firm. By calculating, by implementing this strategy, right? Implementing this strategy, you can easily prove that your market value of firm, what happened, increases. Let us take here the assumption is like that, like this. A company moves, right? It has a 50% of equity and 50% of debt. In such a case, what would be the KO and what would be the market value? If the company reduces its equity and increases its debt condition, right? Debt, it is a equity because of increasing debt percentage here, right? Debt percentage, with effect what happen, KO starts to decreases and market value of firm increases. This time if the equity increases, right? Equity increases and debt decreases. In such a case, what happen? Debt increases. In such a case, KO increases, thus market value of firm decreases. So it is not the favorable. This is the idea with respect to David Durant net income theory. Got it? Now we will prove one problem from this model. Let us take Rupa Limited. Rupa Limited is Rupa Limited. EBIT is 50,000. The company has 10%. 20 lakhs debenture and its equity capitalization rate is 16%. Now, equity capitalization KE is given 16%. You are required to calculate market value of equity, market value of firm. Very simple. Market value of equity, market value of firm, and overall cost of capital. What would be the impact value of firm? Equity wants to raise 10 lakh by issuing 10% debenture. Will your answer be different if the firm redeems the debenture 10 lakhs out of its proceeds fresh equity? In such a case, what we do? See, market value of equity and firm. First of all, market value of equity, earning availability equity shareholders divided by KE. So 3 lakhs divided by 16%, 18 lakh 20,000. Okay, that earning availability equity shareholders, how do you got it? EBIT minus interest. You will get the earning availability equity shareholders. Actually, it is EBT, no tax. That's why it would be earning availability to equity shareholders. Already debt, you know that, right? So market value of firm equal to market value of equity, market value of debt. 18 lakh 75,000 and 20 lakhs. So 38 lakh 75,000 is the market value of firm. Overall cost of capital, EBIT divided by market value of firm. 5 lakhs divided by 38 lakh 75,000 would be 12.9%. Right? Now the question they asked is, will your answer be different? What would be the impact of the firm if the company wants to raise a 10 lakh issuing 10% debenture? If company raises 10 lakh by debenture, debt increases. When debt increases, in that place equity goes out. When equity goes out, high cost oriented funds is moving out, and with effect what happen, debt increases. Debt increases, least cost fund increases, with effect KO starts to decrease and market value of firm will increase. That I am going to prove here, right? So now you see the 10% debt, previously 20, now 10, 30 lakhs. EBIT 5 lakhs, 30 lakhs and interest means same rate. So 3 lakhs. EI earning availability 2 lakhs. KE 16%. So here market value of equity equal to earning availability equity shareholders divided by KE. you'll get the 12 lakh 50,000 and the debt is 30 lakhs and market value of firm is 42 lakh 50,000. Whereas KO equal to EBIT divided by market value of firm is 11.75%. Try to understand these students. Previously, the KO would be KO is how much? 12.9%. Now it came to 11.76%. The firm and at the same time market value of firm previously 38 lakh 75,000. Now 42 lakh 50,000. 42 lakh 50,000. What is observation? As debt increases, market value of firm increased, overall cost of capital decreased. If the company moves reverse to that, right? The next bit what they asked is, will your answer be different in part C if the firm redeems the debenture 10 lakh out of the proceeds to the fresh equity shares? In such a case, what happens? You are raising more debt. The impact would be like this. So, from revised debt, 20 lakhs is debt already you have, right? From that 10 lakhs, you paid only 10 lakhs left. Interest equal to 10 lakhs into 10%, 1 lakh. EBIT minus interest equal to earning availability to equity shareholders. 5 lakhs minus 1 lakh equal to 4 lakhs. Value of equity, 4 lakh divided by 16%, 25 lakhs. Value of debt is 10 lakhs. Value of firm equal to 25 lakhs plus 10, 35 lakhs. KO equal to EBIT divided by market value of firm. 5 lakhs divided by 35 lakhs into 100, 14.29%. Now, comparing to previous, right now, KO has, what happened? Increased. So, conclusion, as debt increases, market value of firm decreased, KO increased. It's not favorable. So, the point is from this entire explanation and problem verification, since debt is cheapest, the best. Since debt is cheapest, thus it is the best because there is no risk to whom? Even equity shareholders also. So this is the point. This theory is based on assumption that there is no risk element to whom? Equity shareholders and the debenture holders. It means that if you raise more debt, there is a no, coupon rate remain constant. If you raise more equity, also coupon rate remain constant. It does not make influence. Okay, this is the problem, dear students, with respect to net income theory. Coming to net operating income theory. See, net operating income theory. Net operating income theory. Net operating income theory. This theory also suggested by David Durant. According to this theory, a company debt equity mix of the company does not change KO and market value of firm. Both will remain same because the advantage of debt would be exactly set off with risk element of whom? Equity shareholders. So that is the reason this theory is called irrelevance theory. This theory works against of net income theory. So this theory argues that there is a risk element to equity shareholders. This theory won't believe the assumptions given by David Durant. First theory, this given by same person only. That is a surprise. But if theory believes that if equity shareholders might have experienced risk because of debt, the impact would be like this. So that is the his point, right? Now I will give you simple points to remember for this theory is like this, right? See, according to net operating income approach, okay, debt equity, debt equity mix of the company does not change KO and market value of firm. Debt equity mix of the company does not change KO and market value of firm because the advantage of debt exactly set off with risk element of equity shareholders with effect KO and market value of firm remains Same. So according to net operating income, debt equity mix of the company does not change KO and market value of firm. Reason is simple, because of advantage of debt would be exactly set off with the risk element of equity shareholders. Debt is not a best, debt is not a worst, debt is just a finance. That's enough. Don't worry for debt. It's not a risky, it's not. For example, here there is a assumptions. In this model, what are the assumptions? There is a risk to only equity shareholder, but there is no risk to debenture holders. And another one is common assumption, KD is less than KE. So this theory argues that. At the same time, I will show you the diagrammatic representation. This would be, and here you have, if a company KE equal to KO, when company moves 100% equity. Okay, but now such a situation, right? Let us imagine there is a KD. This is a KE. This is available at 20%. It is in 10%. In such a case, what happens? Here, just now I told you it is called a capital gearing. Capital gearing means nothing but you are raising a debt, right? That is X and Y. Now the point is, when you increase your debt, right? When you increase your debt, what happens? As debt increases, risk element of equity shareholders, what happens? Increases. Equity element of equity shareholders increases. As you are increasing debt, it increases. Again, you increase the debt, again it increases. Again, you increase the debt, again it increases. Like that. This is nothing but the KE. So what happened? Initially, KE equal to KO. At one point of time, it become a KO, because KO will remain constant. The advantage of debt would be exactly set off with the risk element of equity shareholder. Thus, KO remain constant irrespective of your financial mix. So KO remain constant with effect either you increase the debt or decrease the debt. It does not make any sense. So that is the his point, dear students. Because in this model, what we are going to prove is calculation point of view. Debt is KD remains constant, right? You can find it out. What is that? Market value of debt. Market value of debt equal to interest divided by KD, right? This is the general formula, right? Here, only point is nothing but as debt increases, KE increases. So you have to find it out KE. If you want to find it out, KE means you have to find it out earning availability equity shareholders divided by market value of firm. Market value of firm, you have to find it out. For this purpose, you can write like this: earning availability equity shareholders. How do you get it? EBIT. How do you get it? EBIT minus interest. Okay. Thereafter, market value of firm. How do you get it? Market value of firm, KE equal to, not market value of firm, market value of equity. Market value of equity equal to market value of firm minus market value of debt. Okay. Here, market value of debt already you calculated. Now, what you have to find it out? Market value of firm. Market value of firm will remain EBIT divided by KO. EBIT divided by KO. So by taking EBIT divided by KO, you will find the market value of firm. From the market value of firm, if you deduct market value of debt, you will get the market value of equity. Earning availability, market value, earning availability equity shows divided by market value of equity, KE will increase. So advantage of debt and disadvantage of equity will get what? Set off with effect KO remain constant. Thus, this theory argues debt is not a best, debt is not a worst, debt is just, right? That is the point. Coming to here, we have a problem. Problem number Amita Limited, not Amisha Limited. Operating income is 5 lakhs. The firm cost of debt is 10%. Currently, the company employ 15 lakhs of debt. Overall cost of capital KO is given 15%. Now, total value of firm. How do you find it out? EBIT divided by KO. You will get the market value of firm. cost of equity, if you want to find it out, earning availability equity shareholders divided by market value of equity. From the EBIT, if you deduct interest, you will get the earning availability equity shareholders. From the market value of firm, if you deduct debt, you will get the market value of equity. Earning availability equity shareholders divided by market value of equity, if you take it right, you will get the cost of equity. What would be the impact of market value of firm if debt rises? Nothing is happens. Debt rises means nothing happens to KO, nothing happens to market value of firm, but KE increases. Okay, what about if debt decreases? Nothing happens to market value of firm, nothing happens to KO, but KE decreases. That is the point, right? For this purpose, we have calculated net operating income. Present, when debt increases, debt decreases. Net operating income, right? Less interest we have to deduct. Present here, debt increases means interest also increases. Debt decreases means interest decreases 75,000. Next, earning availability to equity shareholders. So, value of firm EBIT divided by KO is 15. In such a case, 5 lakh divided by 15. Everywhere market value of firm will remain same. Then you took the market value of firm. Market value of firm minus market value of debt, you will get the market value of equity. So KE means earning availability to equity shareholders divided by market value of firm. If you take it 19.09%, when debt is limited amount, in such a case KE is 19.08. When debt increases, it went to 25.38%. When debt decreases, it came to 16.48%, but KO remained constant. The same theory I explained. The debt equity mix of the company does not change market value of firm and KO. Here you see market value of firm remain constant. Market value of firm. Either debt increases, decreases, it does not make any sense. It does not make any sense. But whereas the overall cost of capital also will remain constant. But as debt increases, only impact on one thing is KE. As debt increases, KE also increases. As debt decreases, KE also decreases. So this is the net operating income theory. The surprising fact is net income theory, net operating income theory, both are reflected by, are projected by David Durant. Thank you. Well, good morning, dear students. From first class, we discussed the net income theory, net operating income theory with respect to capital structure. So, capital structure is a mix of long-term funds, equity, preference, debenture, okay, and any other long-term sources. The ultimate objective of cost of capital structure is to designing the proper debt equity mix so that the market value of the company should be maximized. So that is our ultimate objective, and we discussed the various concepts. EBIT, EPS analysis, we discussed EBIT, market price analysis. We made it a different types of analysis. I will show you kidhar hamara analysis. You see, this is the, once again, within 1 minute, we will recoup. Capital structure, we discussed what is a capital structure, long-term funds, optimum capital structure, analysis and approaches, EBIT, EPS analysis, EBIT market price analysis, thereafter indifference point analysis, thereafter financial break-even point analysis, thereafter we came capital structure theories, and we discussed about assumptions and types of theories. We discussed under net income theory. Net income theory, its assumptions and its diagrammatic representation and a few calculation, and we solve the problem. Thereafter, net operating income theory, what the concept is, net operating income theory, then we discussed assumptions, then diagrammatic representation, thereafter calculation point. And now we are going to discuss one more theory, is traditional theories. Net income theory. This theory was suggested by David Durant. According to him, debt equity mix of the company, a company may increase. Net income theory, a company may increase its market value by reducing its overall cost of capital, right? And that is called net income theory, suggested by David Durant. Net operating income theory also suggested by David Durant. But where in net operating income theory, David Durant argument is debt equity mix of the company does not change, value of firm, overall cost of capital, both remain same, because the advantage of debt would be exactly set off with risk element of equity shareholder. Okay. Now we are going to move to what is a traditional theory, traditional approach. Traditional approach also very, very important one. So what is the traditional theory and how we used to analyze in this, right? We are going to discuss. So there are two theories successfully we completed. One is net income theory, another one is net operating income theory. So here we are going to discuss the traditional theory, right? What is exactly this theory it indicates, right? Uh, let us check. So traditional theory. See, traditional theory. According to this theory, a company may reduce its overall cost of capital. A company may reduce its overall cost of capital, increases its market value of firm up to certain level. Thereafter, certainly there is a risk to equity shareholders. With effect, KE starts to increases. There is a risk element to debenture holders. So KD starts to increases. At what point of time? Because of increasing KD plus KE, overall cost of capital increases. With effect to market value of firm decreases. So debt is the best up to certain level. Thereafter, it will turns worst. That is the point of this theory. So according to this theory, a company may reduce its cost of capital and increase its market value of firm by employing least cost fund called debt. So a company may reduce its overall cost of capital and increase its market value of firm by employing least cost fund called debt, but up to certain level. Debt up to certain level. Up to certain level. Thereafter, what happens? Up to certain level. Thereafter, because of risk of equity shareholders and debenture holders, KE, KE and KD starts to start to increase with effect market value of firm decreases. Okay. So a company may reduce its overall cost of capital and increases its market value of firm by employing least cost fund called debt up to certain level. Thereafter, because of thereafter, right? Because thereafter means up to certain level of debt. Thereafter, rising of debt it may. Thereafter, rising of debt here. What would be rising of debt creates rising of debt creates risk to equity shareholders and debenture holders with effect KO and KD starts to increase with effect market value of firm decreases. You see, try to understand. A firm may reduce its overall cost of capital and increase its market value of firm by employing least cost fund called what debt. So a company initially may reduce its overall cost of capital, increase its market value of firm by employing least cost of fund called debt, but up to certain level. Thereafter, rising of additional debt, okay, additional debt creates risk to equity shareholders and debenture holders. With effect, KE and KD starts to increase. With effect, market value of firm decreases. With effect, KO increases and market value of firm decreases. So what the point is increases? Debt is what it conveys. Debt is best up to certain level. Thereafter, it will become costliest, riskiest, finally turns worst. So don't employ too much of debt. So better to rise debt up to certain level in a good manner. Okay. Thereafter, don't rise the debt even though it is the cheapest. This is the concept of debt, right? Let us come to what is the assumptions of this theory. This theory indicates assumptions. Assumptions indicates KD is less than KE. First point is KD is less than KE. There is no risk to whom equity shareholder. So KD is less than KE. And B, there is a risk to equity shareholders and debenture holders. There is a risk to equity shareholders and debenture holders. This is the concept of traditional theory, okay, and assumptions of traditional theory, right? Coming to diagrammatic representation, okay, how this, so diagram, how this theory conveys. Let us take in this problem, there is a company, there is a company moves with the equity, there is a company goes with a debt. Let us take here is KE equal to KO when company moves 100% equity. There is a KD. KE is available at a 20%, KD is at 10%. Now the company what they do is company makes what is that capital gearing. So capital gearing, that is nothing but you are rising a debt. So what this concept conveys that if you rise debt, right? So if you rise debt and you will redeem equity, what happens? So once you start to increase the debt, right? With effect of rising a debt, there is a small miracles happens here. That is nothing but the KO which is there in the company. Okay. The KE which is there in KO starts to decrease gradually because of debt impact. Okay. But up to certain level. So up to certain level of debt increases because up to certain level there is no risk to whom? Even equity shareholders also. The risk of equity shareholders also will remain constant. But thereafter, if you start to rise debt, right? If you start to rise debt, what happen? If you rise to right, there is a risk element to equity shareholders. With effect, what happen? The KE which moves up to here, they will starts to increase. And the KD, you are rising, right? Up to certain level, it would remain constant up to here. Thereafter, it will starts to increase. Then up to certain level, KO also remain constant. When KE increases, KD increases, right? Then immediately what happens? KO also increases. So what the point is, this would be the concept. Okay, means it would be good up to certain level. Okay, thereafter if you rise the same funds, okay, these students, you should understand this is the KE, this is KD, this is KO. Okay, so that's why finally what you have to understand is debt is best up to certain level where there is a risk element to debenture holders remain constant and equity shareholders remain constant up to with because of this effect, right? KO starts to decrease, but when debt is available at a least cost, you feel very favorable about the debt. When while going on raising a debt, what happens? Automatically, what happens? KD increases. It is not a good phenomena. So company has to raise the funds to the extent up to there is no any negative impact on what KE as well as KD. So this is the idea about what is that diagrammatic representation of a traditional theory. In this theory, what we are going to prove here is what formulas. Nothing is going to be special. Why? Because this theory considers what is it? Net income and net operating income theory. That is the reason you can calculate. You have to identify the two things. KE, you have to prove that KE increases. That's why KE equal to earning availability to equity shareholder divided by market value of equity. You have to find it out. Whereas KD also increases. So KD equal to interest divided by market value of debt is nothing but KD. And with effect, KO starts to decrease. KO you have to find it out means, so EBIT divided by market value of firm, you can calculate, or else KE into equity share capital divided by total capital employed plus KD into debt capital divided by total capital employed. With this formula also you can identify. And finally, market value increases. So market value of firm equal to, so you can go with the EBIT divided by KO, one alternative, or you can find it out market value of debt plus market value of equity. So these are the formulas you must aware of. KE, earning availability equity shareholders divided by market value of equity. So KD, interest divided by market value of debt. KO, EBIT divided by market value of firm. RNEKE into equity share capital divided by total capital employed into KD into debt capital divided by capital employed. Market value of firm equal to EBIT divided by KO, or market value of debt plus market value of equity. You can also understand market value of equity equal to earning availability equity shareholders divided by KE, whereas market value of debt equal to interest divided by KD. So this is the point, various formulas, requirement, because this consists of both the theories, net income theory as well as net operating income theory, you have to consider. Let us take one problem from this model, okay, where in this model we believe that in which option KO is least, that should be preferred. Right. Determine the optimum capital structure of the company in following information. Option 1, how many options we have? So 1, 2, 3, 4, 5, 6, 7. So cost of debt 11, 11, 11.6, 12, 13, 15, 18. This is the cost of debt, KD. Whereas cost of equity 13, 13, 14, 15, 16, 18, 20. What about the percentage of debt? Percentage of debt means immediately we can say percentage of equity. Percentage of this is 0 means it is 100%. This is 10% means this is 90. This is 20, it is 80. This is a 30, it is a 70%. This is a 40, it is a 60%. It is a 50, it is a 50%. It is a 60, it is a 60%. Okay. Now we can calculate the weighted average cost of capital. You try to understand. In first option, KE is 11%. KD. KE is 13%. Weighted average cost of capital, you have to find it out. Since debt is 0 means 100% equity, 13%. Whereas second option, 11%, 13%. Weighted average cost, 10% here and 13. So 11 into 0.10 plus 0.90 into 13. You will have 12.86 percentage. Okay. Thereafter, 13%, if you say second is finished. Third one, 11.6%, 14. 0.20, 0.80. You multiply debt into this and this. If you sum it up this one, you will find it out the calculator. Correct time. 11.6 into 0.20 equal to 2.32. Okay. 2.32, then 14 into 0.80, 11.2. If you sum it up both, 2.32 plus 11.2, 24 point, this is 2 point, this 13 point. Coming to here, 12%, 15%, 0.3, 0 point. Now what to do here it is 0.2, this one 0 point, 15%, 0.3, so 14.10, 13%, 16%, 0.40, 0.60, 13, 0.40, 16, 0.60, 5.2 plus 9.6, 14.60, 15, 0.5, 18, 0.5, 16.5, 15 into 0.50, 7.5, 18 into 0.50, 9%, right? 9 plus 5, 7.5 plus 9, 16.5%. 18 into 0.60, 10.8. 20 into 0.40, 8. This is 18.8%. So, by observing all the cost, what you have to understand here it is. So, weighted average cost of capital 13, 12.8, 13.52, 14.8, 16.5, 18.5. Now, by observing all these things, you can understand one thing is in which combination KO is least, that is the combination 2. Because in this problem, if you go with this, so in which combination it is the least? Combination 2. So what is the conclusion you can draw? Overall cost of capital is lowest at debt and equity is 0.1 and 0.90. Here it is. You see, in the total estimation, we can say simply, when debt is 10%, equity is 90%, KO of the company is 12.20, so which is the least one. So it is advisable to raise the company required funds at a 10% debt and 90% equity. This is a debt, this would be equity. Okay, so this is the theory of theory. And point about last one point is I would like to say the traditional theory. This theory was suggested by who? Do you know that? Who is the person who suggested? Isro Solomon. His name is Isro Solomon. This theory is a hybrid theory because it consists of equity characteristics, debt characteristics. By merging this both, he developed this theory. So this is the wonderful theory because it consists of some assumptions where we should not able to adjust or believe in net income and net operating income theory. So with this, we completed traditional theory. I repeat once again, traditional theory. According to this theory, debt equity mix of the company can reduce its KO, increase its market value up to certain level. Thereafter, because of risk element of equity shareholders, KE increases. Because of debt holder, KD increases. Because of increasing KE, KD, KO also increases. With effect, market value gets collapsed. Thus, debt is best up to certain level. Thereafter, it will become costliest, riskiest, finally turns worst. Okay, that is. Next theory. The next theory, what we learn is Modigliani-Miller. First term indicates Modigliani. Another one is here, it indicates Miller. Modigliani-Miller model. See, Modigliani-Miller theory. It is a not relevance theory, it is a irrelevance theory. This theory conveys that. This theory conveys that. It never speaks about debt is best. It never speaks about equity is the best. What it conveys, it practically proves net operating income approach with concept called what is that? Arbitrage. So Modigliani-Miller approach is relevance to net operating income approach. It made an attempt to prove net operating income approach. What the net operating income approach? See, this theory Modigliani and Miller theory. It is irrelevant model. There are two theories which argues that depth Modigliani-Miller means in order to decide an optimum capital structure, there are two theories already we discussed. One is relevance, another one is relevance. Irrelevance theories argues that uh, optimum capital structure can make increase the market value of firm. That is relevance theories. Irrelevance theories argues that there is no such a theory, there is no such a combination because every capital structure is an optimum. That is the irrelevance model. So Modigliani-Miller model is the irrelevant model. It practically proved which theory? Net operating income approach, right? It practically proved net operating income approach. So because a net operating income approach is a behavioral concept, it ignores behavior. It considers, it is a conceptual. What is that? Conceptual. Conceptual, it indicates that because of debt, there is a risk element to equity shareholders. The advantage of debt would be exactly set off with the risk element of equity shareholders. With effect, KO remain constant and market value of firm will remain constant. That is the argument of net operating income theory. Modigliani-Miller theory speaks about the behavior of investor. Behavior of investor aspect. This aspect is considered. Okay, what do you mean of this? Here it indicates that in market value of firm, both two relevant firms, right? Relevant firms do the business as per debt equity mix of the company. Both the company's market values may get what fluctuated. When both the company's market value gets fluctuated, then investor behavior changes. Okay, investor behavior changes, and he will undertake what is that arbitrage. Okay, arbitrage process means buying a security at a low price and holding it and selling it in another market at high price in order to make profit or in order to make income. That process is arbitrage. Because of undertaking arbitrage by investor, so the market value of two relevant firms which are not equal, they will said to be equal or said to be same. Said to be same. That concept he practically proved. It means that let us practically analyze. There is a two firms, firm A, firm A, firm B. Okay, firm A. This firm A moves with 100% equity. This firm moves with a 50% equity, 50% debt. So this means this is a levered, unlevered firm. This is levered firm. What is a levered, unlevered firm? Levered firm, it indicates there is a debt. Unlevered firm indicates there is no risk because there is no debt. Now, what the argument is, this net operating income approach argument is, debt to equity mix of the company does not change KO. KO remain constant. Here also KO remain constant. But here KE is low, here KE is high. Because of rising, this KE increases because the company employs debt. This cost is least one. Because of least cost, KO has to reduce because of least cost. But what happened? The advantage of debt exactly set off with the risk element of equity shareholders. So KO of the both the company will remain same. When KO of the company same, then market value of firm also remain same. Is the argument of net operating income theory. But this theory arguments that whereas Modigliani-Miller argument is like this: when two companies are there, similar companies, right? There is a similar companies. This is the 100% equity. This is the 50% debt, 50% equity. So because of some debt equity mix and market impact, market values may get what is it? Fluctuated. Market values may be fluctuated. In such a case, if the market value of one company share price is today is a 250, let us take here 200, its price also 200 as per net operating income approach. Some reasons, because of some reasons, if this 200 price came to 20 rupees, in such a case, investor of the company, investor, what he will do is, what he will undertake is, So investor of the company, he will start that, is there any benefit for me by moving my investment from unlevered to levered, or if the market fluctuates levered to unlevered, right? Because this is the highest market value firm. Morning or in the similar time, they are both are same. Because of some reason, this market value of this company came down. Now, with effect, what happened? The investor who is there in a highest levered firm, by selling his shares, and he will start to move to unlevered firm, and he will purchase levered company firms are lowest market value firm. With effect, lowest market value of firm increases because you are buying. Here, selling takes place. With effect, market value of firm decreases. At one point of time, both the firms will reach, what is it? Equilibrium. This is the argument of Modigliani-Miller argument. In this model, you have to calculate market value of firms according to Modigliani-Miller. That is the most important point is. Hmm. So here is estimation of market value of firms according to MM. So estimation of market value of firm according to MM is very, very, very important. So that's I am going to explain now how it has to be analyzed, how it has to be estimated. Market value of firms estimation. Okay, in this model, right? Coming to market value of estimation, there are two firms according to MM. You try to understand how it to be computed. So first step number one, according to MM, market value of the firms. There are two firms, levered one, unlevered. There are two companies, levered one. First, what to do is step number one. So market value of unlevered company you have to do. Market value of unlevered company is a this is a completely 100% equity oriented company. In such a case, what you do is, so market value of unlevered company equal to market value of equity equal to market value of the firm in the presence of tax. In such a case, what you do is market value of equity equal to earning availability to equity shareholders. Equity equal to, so how do you find it out? Earning availability to, ये क्या रे? Earning availability to equity shareholder divided by market value of equity. So earning availability equity shareholders, market value of equity you have to find it out, means earning availability to equity shareholders divided by you will find the market value of equity, that is the unlevered firm. Whereas step number two, market value of levered firm you have to find it out, means levered firm or levered company. Market value of equity equal to market value of, that is levered one. Here market value of equity or market value of unlevered firm. Here market value of levered firm. Market value of levered firm is equal to market value of unlevered firm plus market value of debt. Market value of debt on market value of tax benefits. So dear students, market value of market value of when according to you have to find it out, means it's the most important point in the presence of tax. In the presence of tax, if you want to find it out, market value of the only one thing you have to keep it in mind, that estimation of market value of firm according to in the presence of tax means first you have to calculate market value of unlevered firm. Market value of unlevered firm equal to EBIT, interest zero because unlevered, into 1 minus tax. Tax should be considered because in the presence of tax we are doing. So market value of unlevered firm equal to earning availability equity shareholders divided by market value KE. Okay, market value of equity you have to take KE. Whereas market value of levered firm you have to consider means market value of uh, levered firm, market value of not equity, here it is. This is market value of unlevered. This is unlevered word would be right. Unlevered market value of levered firm. Market value of levered firm, if you want to find it out, means market value of unlevered firm plus market value of tax benefit. So market value of tax benefit could be estimated. Market value of tax benefit can be estimated like this: debt into tax rate. Debt into tax rate. So this is the market value of firm according to Modigliani Miller. Keep it in mind whenever tax is there. Net operating income approach with tax is nothing but theory. Theory without tax is similar to net operating income theory. One of the short approach you have to keep it in mind. Now we can solve a problem. Here you see. There is a good problem. It is Blue Limited is all equity finance company considering purchasing of 275 lakhs of equity shares and replace with a 15% debenture in same amount. Means already it is moving with equity and it wants to replace with a debt. The current market value of company is 1,750 lakhs with a cost of capital of 20%. The company's earning before interest and tax are expected to remain constant in future. Okay. Company also has the policy of distributing entire earning as a dividend. There is no retained earnings. Assuming corporate tax rate is 30%, your 30% tax rate is there means theory. So you are required to calculate the impact of following on the account of change in capital structure according to Modigliani Miller approach. 1 minute. Once again, think what is the Modigliani Miller? Modigliani Miller relevant theory. Modigliani Miller, what it practically proves net operating income theory. Net operating income theory argues that market value of two firms will remain same because of set-off effect. But Modigliani Miller argues that market value of firms remain same because of arbitrage impact. Okay, arbitrage impact. So Modigliani Miller firm, if you want to find it out, market value of unlevered firm, levered firm. Market value of unlevered firm means the company which moves with 100% equity, where earning availability equity shareholders divided by KE, you will get the market value of unlevered firm. Market value of levered, you want to find it out, means market value of levered is nothing but market value of unlevered firm plus tax shield on debt. Tax shield on debt is nothing but debt into tax rate. Okay, this is in this firm the company moves with the 100% levered actually all equity company, unlevered company. Now it wants to convert into unlevered to levered. In the presence of tax, what you can calculate? First one, they asked market value of firm. Now try to understand the company is a 100% unlevered company. Now it is going to become what is that levered company. In such a case, it is going to get the tax advantage. Simply what you do is take market value of unlevered firm and add to market value of tax shield to it, then you will get the tax advantage. So market value of unlevered firm according to in the presence of tax, take market value of unlevered firm. Market value of unlevered firm already they have given, that is a 275, no, here it is 1,750. So 1,750 and you can calculate market value of tax shield on debt. For the market value of tax shield on debt, what I said, debt into tax rate, debt into tax rate. So total amount of debt to be raised is how much they have proposal to raise 275 lakhs. So 275 lakhs into 30%, 82.5. So 1,750 plus 82.5 equal to 1,832.5 lakhs. This is the market value of levered firm. Next, what you have to do is, next you have to calculate cost of equity. Then your purpose is to find it out cost of equity. Cost of equity, when company raises a debt, automatically KE increases generally. So KE equal to earning availability equity shareholders divided by market value of equity. So here the point is, here you have to find it out. Earning availability to equity shareholders, how do you find it out? In previous problem, they have given the KE, right? KE is how much here? They given it is replaced with the same cost of equity. Blue equity company, the shares of the replaced with the 10% debentures, and the company earning before interest and expected to remain constant. Also policy, assuming tax rate 30%, right? You have to consider EBIT is given. Now what you do is earning availability EBIT in this problem. Yes, coming to next one, you have to calculate cost of equity. But actually the second bit is overall cost of capital they given. But thing is, once you want to calculate the overall cost of capital, concentrate on cost of equity. Okay. Cost of equity, how do you calculate? Cost of equity is nothing but earning availability equity shareholder divided by market value of equity. If market value of equity to be computed, then what to do is, already market value of firm is given in the problem. From the market value of firm, you deduct market value of debt, then you will get the market value of equity. Okay. So, K, if you want to find it out, just now I told you that earning availability equity shareholder divided by market value of equity, right? Market value of equity, how do you get it? Market value of firm minus market value of debt. Then earning availability equity shareholders, how do you get it? That's the most important point. But in the problem, before debt, the company has EBIT. After debt, the company has a EBIT. Debt equity mix of the company does not change. Market value of debt equity mix of the company does not change. EBIT, because EBIT depends upon the total capital employed. But EPS may be influenced because of capital structure. So that's the reason why the logic you have to find it out is, first of all, you have to identify basing on given KO is given, right? KO. Since company moves 100% equity, I repeat again, since company moves 100% equity, KE equal to KO. That's why what you do, KE equal to earning availability equity shareholders, market value of equity when the company moves with 100% equity, right? Here KO or earning availability equity shareholders, you can take it since company is unlevered firm. So KO equal to EBIT minus interest. Interest is not there, tax is there because company moves 100% equity. In such a case, so EBIT into 1 minus tax, okay, that is nothing but earning availability equity shareholders divided by KE, that is market value of equity 170. If you cross multiply both, right? Both, you will get it a EBIT into 1 minus tax 350. Thus, EBIT would be 500 lakhs. Okay. So, EBIT, it means that, dear students, EBIT basing on KE, earning availability equity shareholders divided by market value of equity, right? KE is given 20%. So, earning availability equity shareholders divided by market value of equity, they are given 1750. Thus, earning availability equity shareholders equal to 1750 into 20%. Thus, EBIT equal to earning availability equity shareholders divided by 1 minus tax rate. 1 minus tax rate, then it will convert into EBIT. Okay. From the EBIT, what you do? Direct interest. Now, EBIT will remain same. Before debt, after debt, it remains same. Now, EBIT, direct interest, you will get the EBT less tax. So, earning availability equity shareholders 321.125. Now, just now I told you how do you calculate the cost of equity. Cost of equity equal to earning availability to equity shareholders divided by market value of equity. Earning availability, just now you calculated 321.1251 divided by market value of firm 1832.5 minus market value of debt is 500. Thus you will get it. So 1550. Okay, market value of not debt. This is not this. Debt amount is 275. Sorry, 275. That means market value of firm is 1832. 1832.5 minus the company is considering repurchasing of 275. That equal to here 155, actually it's wrong, 150, 1555, 7.5. Then here 321.125 divided by 321.125 divided by 1557.51 into 100, that equal to 20.61. Here the values are a little bit changed. Please adjust this one. No? That is, next you got the KE is 20.62. Now you can calculate the KO. KO is nothing but weighted average cost of capital. Now KO can be calculated either proportionate method or product method. You can find it out. But here KO equal to EBIT into 1 minus tax divided by market value of firm. They took it into 19.5%. KO EBIT, if it is deducted interest, deducted interest, not interest, tax, right? EBIT may be considered EBIT, but after tax you want to consider means you deduct it. So EBIT into 1 minus tax divided by market value of firm, you will get it. Or else you can go with the cost of capital format, right? Equity share capital divided by total capital employed. KE into equity share capital divided by total capital employed plus KD into debt to capital divided by total capital employed. So basing on that format also, you can calculate, the answer would remain same. So this is with respect to, in this model, I would like to say only one thing is, what is the impact on tax when while calculating market value of firm according to Modigliani Miller. So dear students, this is capital structure identities. In this entire calculation part, right, I discussed with you various concepts. Estimation of market value of firm according to Modigliani Miller, right? And market value of firm, we discussed about all these concepts, net income, net operating income. So we discussed what is a capital structure, what is the optimum capital structure, right? So you try to understand capital structure, capital structure. This theory is capital structure planning. Actually, the full name, if you ask me, what is a capital structure concept is, capital structure, the full name is capital structure planning. It means that whenever company need a capital, it has to make an advanced planning that how this given fund should be raised from various sources. And when they have to raise these funds, see to that the company's objective should be fulfilled. That is most important concept, right? That's coming to the point is, in order to achieve this optimum capital structure, we have different types of analysis, we have different types of approaches. Different types of analysis, different types of approaches, net income theory, net operating income theory, traditional theory, theory. These are the four approaches. Coming to here, you will have EBIT, EPS analysis, EBIT, market price analysis, indifference point analysis, financial break-even point analysis. Okay, right. The coming to the next concept is, we are moving with the leverages. So leverages. So today we are going to discuss the topic, the new chapter, leverages. Well, leverages. See, dear students, the leverages is a extension part of the two financing decisions you have taken, frankly speaking. Whenever company need a capital, it will estimate what are the sources in which the capital to be raised. That is the first step. Thereafter, company raises the funds, and in order to reduce the cost, it may design an optimum capital structure where sometimes the company may go with what high proportionate of debt. But the thing is, when company raises huge debt, then we have to study what would be the impact on the earnings of the company, or what would be the risk element of the company. We have to identify. That could be learned in leverages. See, actually, the leverages is nothing but, this is a word actually extracted from finance, not finance, physics. See, leverage means anything which can lift what is that heavy objective is considered to be leverages. For example, you are digging water. So you may use the wheel in order to dig the water. Then that is leverages. When your vehicle got punctured, right? And you want to replace the tire, what do? You have to lift the car. But manually it could not possible. But do you know the jockey, right? Small one. With this jockey also, with a small instrument, can lift the car, and you can replace the tire then. Okay, this is called leverages actually. And the point is, Means finally what I would like to say is it's a small thing but which can make the biggest efforts. Chota hai lekin zyada efforts karega. That is called leverages. So here leverages in financing point of view, we will identify, we will study. So what is the risk associated with the company having fixed financial commitments? So how much commitments the company has, what is the risk it's supposed to face, that we are going to discuss in this chapter, right? First of all, leverages. Okay. Leverages represents risk associated with the company having fixed financial commitments. Having fixed financial commitments. So leverage represents risk associated with the company having fixed financial commitments. It means that when a company performs its business operation, let us take this the company, it is performing its business operations. Okay, now try to understand. It may take the financing decision. In financing aspect, the company might have issued, what is it? Raised funds, either debt or preference. Okay. In such a case, for debt, it has to pay interest. For preference dividend, it has to pay preference dividend. Both are, what is it, fixed. Both are fixed. It means that company makes profit or company makes profit, no profit. It does not relevant to the fund providers. They will stand in front of you, they will come to your house and they will argue that yes, pay dividend, man. That is a risk associated with the company having fixed financial commitment. While operating a business, right? Operating business, you have to incur various costs. That may be variable cost, fixed cost. That variable cost is the cost which varies. Okay, but variable cost also called controllable cost. Why? Because a company can comfortably control its cost by reducing a number of units production, by increasing number of units production, right? One can control the variable cost. But what about the fixed cost? Tell me, dear students, what about the fixed cost? So fixed cost are those costs. Irrespective of your level of activities, the fixed cost will remain same. Either you do business, if you not do business, the fixed cost will remain same. When huge fixed cost company has, then there is a risk also. Why? Because the fixed cost must be paid irrespective of your level of activities. Now try to understand, when company has such a commitments with respect to financing decision, it raised a debt and preference. With respect to operating functions, it has a fixed cost. Because of debt and preference and fixed cost, what would be the risk associated with the company? We are going to study in leverages. So what happens if the sales gets fluctuated? What happens at least 1% sales changes because of fixed cost? What would be the impact on its operating profit? What would be the impact on its shareholders' income? That we will make a study in leverages. So simply leverages represents risk associated with the company having fixed financial commitments, particularly fixed cost, debt and preference. Okay, but it speaks that what happens if 1% change in given variable with impact to others. For example, if sales changes, what would be the impact on EBIT because of fixed cost? If EBIT changes, what would be the impact on EPS because of its financing cost? So like that, we will make impact, means the change. Then basing on that, we will identify how much risk is there in the company. And basing on that, we will modify sometimes our financing decision. Because if the huge fixed cost is there, is it essential to raise funds by issuing debt? Oh, no, it's a risk element. Okay. When fixed cost is low, better to go with the debt, not the debt. If the debt is high, then don't run the company with a huge fixed cost. Because of huge fixed cost sometimes creates biggest risk. So that is the leverages we are going to identify. Here, leverages, already got the point, leverages is a risk associated with the company, right? Leverage is also called, it is also considered double-edged sword. It is considered to be double-edged sword. So double-edged sword, I may say that because of having the leverage, right, it is not only a risk but also return to the company. Let us understand, if sales increases, this commitments, this either debt, interest on debt or preference dividend to be paid on preference will remain constant. Even fixed cost also constant. Because of this, the company able to generate huge return, because as a revenue increases, cost remain constant, it may turns huge profit. In such a case, leverage turns to profit only, right? Benefit only. So leverages is maybe risk return basing on the performance of the company. If the company performance increases in better way, in such a case, right, it is good. If the company performance is not up to the mark, then that is a risk element, right? Then it is called double-edged sword. Both, for example, leverage means if you take a sword, right, if you want to kill opponent, right, if you kill like this, he may die, right? But by seeing his death, by seeing your heroism, right, if you hold the sword on your shoulder, right, saying that I killed, means that may cut your shoulder also. That's why keep it in mind. It is a double-edged sword. It may kill others. Sometimes if you are not careful with that, it may cut your shoulder. Okay, that is right. Types of leverages. Got the point? Leverages is a risk associated with the company having fixed financial commitments, right? What are the fixed financial commitments? Because of your financing decision, interest, preference dividend. Because of your operating business, you have a fixed cost. Having both will create leverage. Leverage means risk? Absolutely not. Sometimes it may turns return also, but depends upon your performance. Okay, right. How many types of leverages? Before going to measure the leverages, we are going to discuss types of leverages. Types of leverages. So types of leverages, if you come to the types of leverages, you have three types of leverages. One is operating leverage, financial leverage, combined leverage. So there are three types of leverage: operating leverage, financial leverage, and combined leverage. Now we are going to discuss, analyze, and measure, and we will come to conclusion. Next, the first point is, what is that? Operating leverage. So first you should understand what is operating leverage. So operating leverage. So operating leverage is the leverage which arises because of its fixed cost. See, here I will give you some running notes for you. So this is the leverage. Operating leverage arises because of what cost? Fixed cost. What is the fixed cost? This cost remain constant irrespective of sales made. What is a fixed cost? Fixed costs are those costs which remain constant irrespective of sales made or performance of the company. Fixed costs remain constant always, right? So operating leverage is represents this leverage. Operating leverage arises because of what is it? Fixed cost. Fixed cost means this the cost will remain constant irrespective of activities or performance or sales made by the company, right? This leverage, it shows the relationship between sales and EBIT. This leverage shows the relationship between sales and EBIT. It means that the impact is from the sales, generally we deduct what is that variable cost. Then you will get the contribution. From the contribution, we deduct what is that fixed cost. Fixed cost. So what we will get it is sales minus variable cost equal to contribution. From the contribution, if you deduct fixed cost, then we will get what is that? Then we will get EBIT. So this shows the relationship between sales and EBIT. It shows less, here also less. It shows the relationship between EBIT because of fixed cost. So what it conveys that, so how much percentage of impact on, right? That means it conveys that percentage of operating leverage. This is the operating leverage. First, we will understand what operating leverage. Now, so sales minus variable cost contribution less fixed cost. Now try to understand. Sales may increase or sales may decrease. Sales may increase, sales may decrease. When sales increases, variable cost increases. Contribution also increases, but fixed cost will remain constant. With effect, what happen? EBIT has great impact in positive way. But at the same time, if sales decreases, variable cost decreases, contribution also decreases, but fixed cost will remain constant. With effect, EBIT has positive impact. Here you may celebrate, right? Because of having fixed cost, you will celebrate a dance, right? Because of positive. But here what happened? You have to start to cry. Why? Because there is a negative impact, right, on the company. So that is leverage. Okay, operating leverage. It shows the relationship between EBIT and sales. Okay, it is if the sales increases, fixed cost remain constant. That's why it gives a very, very positive. That's why I used the word, right, double-edged sword. What? Double-edged sword. You see, your sales increases because of fixed cost, you will celebrate. There is no risk. But whereas if sales decreases, then there is a biggest impact, right? So how to calculate operating leverage, right? Operating leverage. Next to coming to the point is estimation of operating leverage. How the corporate companies estimate operating leverage. Okay. Dear students, come to here. Operating leverage may be estimated basing on the data given to you. When you see 1 year data is given, right? Only 1 year data. 1 year data is given. How do you calculate is operating leverage equal to, okay, contribution divided by EBIT. Answer always conveys in times. When 2 years data is given, percentage is given. In such a case, 2 years data is given. Then what happened? You can also consider, right, operating leverage equal to percentage of change in EBIT divided by percentage of change in sales. So percentage of change in EBIT equal to percentage of change in sales. So this would be the operating leverage. Operating leverage, how do you calculate? So first of all, before doing this, right, you must understand how to calculate contribution from sales. That's already I proved it. Sales minus variable cost, contribution, fixed cost, right? Operating leverage conveys in always in what is it? Times. So what it conveys finally? Operating leverage conveys what it conveys, right? Observation at any cost. Okay, what it conveys at any cost. 1% of change in sales leads to how much are given percentage. Operating leverage calculated that how much percentage of EBIT changes. So 1% of change in sales leads to how much percentage of EBIT changes. That is which leverage conveys means operating leverage conveys. Operating leverage formula, dear students, contribution divided by EBIT. 2 years data is given. Percentage of change in EBIT divided by percentage of change in sales. Will it conveys in amount? No, it conveys in percentage. Right. Coming to here, is there any problem for operating leverage? I developed this problem. Operating leverage. Okay, then we will come to here. In this problem, you see operating leverage, you can calculate. First of all, we solve operating leverage. Only operating leverage. Then I will come to financial leverage. Operating leverage. Operating leverage, if you want to find it out, what do you do? First of all, contribution. Sales. Operating leverage shows it is a 1 year data, right? 1 year data, if you want to find it out, sales minus variable cost, you will get the contribution less fixed cost. You will have a EBIT. So every 1 year data is given. So contribution divided by EBIT, you have to find it out. What is the sales? 24 lakhs. Variable cost is 50%. Variable cost 50% means from 24 lakhs, 50% is the variable cost. That means 12 lakhs. After deducting, you will get the contribution of 12. Less fixed cost 10 lakhs. So EBIT would be 2 lakhs. Let us check the solution. Sales 24 lakhs. Variable cost 50% means 12 lakhs. Contribution, you got the 12 lakhs. Next, fixed cost is given 10 lakhs. Less fixed cost. You got the EBIT. Up to here, we want to need the operating leverage. Now tell me, what is operating leverage formula? Just now I told you, operating leverage equal to percentage of change in EBIT, contribution divided by EBIT. Even you can also use, but 2 years data is not given, so that's why contribution divided by EBIT can be solved. Okay, coming to here, contribution divided by EBIT, operating leverage, contribution divided by EBIT. How much the contribution? Contribution is 12 lakhs. 12 lakhs. How much EBIT? EBIT is 2 lakhs. 12 lakh divided by 2 lakhs. How much? 6 times. 6 times. What do you mean by 6 times? At any cost, 1% change in sales leads to 6% change in EBIT. It means that if sales increases by 10%, in such a case, will EBIT increases 60%? Tell me, will it EBIT increase 60%? Absolutely, yes, man. You want to any doubt? Do you have any doubt? You want clarification? Then I will prove it. Let us take if the sales increases by 10%. 10% means try to understand. So 24 lakhs into 110 percentage, right? 110 percentage. That means 26 point, I will prove here. 10% it is increasing means 26.4 lakhs because 10%. For 1%, 6 means for 10, it should be 60% we have to prove. I will prove. So 24, 26 into here variable 50% is the variable cost. That means 13.2. After deducting, you will get the 13.2 as a contribution. Less 13.2, fixed cost is 2. If you deduct 2 fixed cost, no, fixed cost is 10, right? Fixed cost 10. So 10 fixed cost if you deduct, 10 lakhs if you deduct, from 13.2 minus 10, how much you will get it? 3.2. 3.2. Previously 2, now 13.2. What is the percentage of increase in EBIT? Percentage of change in EBIT equal to, how do you get it? 3.2 lakhs minus 2 lakhs divided by 2 lakhs into 100. That means 3.2 minus 2 divided by 2 into 100. 60%. Okay. So, have we confirmed now? So, because operating leverage, we calculated 6 and came to conclusion that if sales able to increase 10%, then EBIT also increases 60%. Well, sir, it's a great, right? But what is impact on if sales decreases? Same impact. If sales decreases, EBIT gets collapsed 60%. That's why be aware of operating leverage because you have more fixed cost, right? Coming to second bit. Second bit we will discuss next leverage. Got the point, ma? Operating leverage. This is the operating leverage. Contribution divided by EBIT. What is the formula? And what is impact? And even practically I proved also. Next coming to financial leverage. Financial leverage. See, financial leverage, this is the leverage. I repeat, point number 1. Financial leverage is the risk associated with the company generates or operates because of decisions taken by the company. Particularly what decisions? Financing decision taken by the company. This leverage also called avoidable. Why? Because when the company raises funds by issuing of debt, by issuing of preference, then only such a leverage arises. If the company raises the funds by issuing of equity, then no contradiction here. Why? Because there is no any risk if you raise funds by issuing of equity because he will become a owner of the company. When he will become a owner of the company, there is no any fixed obligations on the shoulder of the company. Right? So fine, it arises because of financing decision. But there that too, when company raises funds by equity, sorry, debt and preference. When company rises with equity, it never happens. So we can discuss certain concept. Financial leverage. It is the risk associated with the company. Point number 1. It is the associated with the company having fixed financial commitment. That is debt and preference dividend. It shows the relationship between EBIT and EPS, or you can say shareholders income. Okay, shareholders income. This leverage also avoidable. This leverage also avoidable. Okay, thus financial leverage can be estimated. Okay, how it should be estimation. So estimation of how the corporate company. That's first I explain what is a financial leverage. Then how the corporate companies estimate what is it financial leverage. How the corporate companies estimate financial leverage. This financial leverage estimation depends upon what is that the pattern of input taken, right? When 1 year data is given, 1 year data is available. In such a case, how do you calculate financial leverage equal to EBIT divided by EBT? EBIT divided by EBT. When more number means 2 years data is given, means the first year and second year given, then you can also use the another one is financial leverage equal to percentage of change in EPS divided by percentage of change in EBT. Okay. So for financial leverage is a percentage of change in EPS divided by percentage of change in EBT. This can be considered. How do you calculate EBIT from EPS? So what's the do is, so it shows the relationship between in between EBIT and EBT. EBIT and EBT. So let us take from how do you calculate EBIT? From EBIT you have to deduct interest. Then you will get what EBT. So from that EBT you have to deduct what is that tax. So you will get what is that EAT. From EAT you have to deduct the preference dividend. You will get earning availability to equity shareholders. Okay, and divided by with the number of equity shares. But if 1 year data is given, EBIT divided by EBT because it shows the relationship between uh, EBIT and EBT. So this is the way. Now shall we solve the problem now? Here is coming to second part. Calculate a financial leverage. Financial leverage, how do you calculate? Financial leverage, it has borrowed a 10 lakh 10% and the equity share capital of 10 lakhs 100 rupees each. So consider tax rate. So now the company considering that it has a debt amount of how much 10 lakhs. Paying 10% means 1 lakh. So now you can calculate how they have done, right? From EBIT they deducted interest, they got the EBT. So financial leverage equal to EBIT divided by EBT. EBIT 2 lakhs, financial GBT is 1 lakh. So how much it is? 2 lakhs. What is the logic behind this? For every at any cost 1% change in sales leads to, that is operating leverage. Here at any cost 1% change in EBIT leads to 2% change in EBT. 2% change in EBT. So that is the financial leverage. Then we will move to combined leverage. Once after discussing of all the leverages, we will solve certain additional problems. So now you can take it, what is that? Combined leverage. So combined leverage. Combined leverage is a third leverage. So combined leverage is the title itself, it speaks about a combined leverage, or it is also called a total leverage. What it explains? It explains that percentage of change in EPS because of percentage of change in EBI sales. So it takes all the leverages, all the commitments into the consideration. Point number one. In this point, what do you do? Right. Combined leverage. It is also called total leverage. Next, this leverage considers A, interest. B, if preference dividend is there, it considers preference dividend. C, it considers fixed cost. Fixed cost. And it shows the relationship between, it shows the relationship in between, it shows the relationship between, what is it, sales and EPS. EPS here, I would like to say shareholders income. It shows the relationship between shareholders income. So now let's have an idea about all the leverages once again. See, let us make it, dear students. Try to understand. It may be useful if you consider like this. See, here sales are there, right? Because of change in sales, what is the impact on EBIT? Impact on EBIT. This could be considered because of what cost? Fixed cost. The leverage which explains is called operating leverage. Got the point? Because of change in sales, the impact on EBIT because of fixed cost is nothing but what leverage? Operating leverage. Okay. Now, because of change in EBIT, what would be the impact on EBT? Or I may say that it is a EBT, EPS, or shareholders income. So this leverage, okay, this would be considered to be because of what is that? Interest, because of preference dividend. Okay. This leverage shows, this is what leverage? Financial leverage. Okay. Now the consideration, because of change in sales, what would be the impact on directly shareholders income by considering fixed cost, by considering interest, by considering preference dividend, okay, by considering fixed cost, by considering this one is collectively called, what is that? Combined leverage. Sales impact on EPS is nothing but combined. Okay. So coming, this is the total impact on operating leverage, financial leverage, and combined leverage. Then how do you calculation of combined leverage? How do you calculate the combined leverage? So estimation of combined leverage. How do you calculate combined leverage? For this purpose, I told you the two ways. One is 1 year data is given. One-year data is given. In such a case, what do you do is, how do you calculate combined leverage equal to, combined leverage equal to, you see, it is a combination of operating leverage into financial leverage. It means, sir, can you say in vivid way? Let us take operating leverage, contribution divided by EBT, EBIT, financial leverage, EBIT divided by EBT. In such a case, EBIT gets cancelled. So you can also write like this: operating leverage into financial leverage equal to contribution divided by EBT. Okay. Coming to financial leverage, when 2 years data is given, in such a case, financial leverage equal to percentage of change in EPS percentage of change in sales. Okay, now take the problem. We have to find it out. The third one is combined leverage. Combined leverage formula: contribution divided by EBT, or operating leverage into financial leverage. Operating leverage we completed here. Financial leverage is completed. Combined leverage: contribution divided by EBT. 12 divided by 2. This is 12 times. What is the 12 times? At any cost, 1% change in 1% change in sales leads to how much would be the impact on EPS is called, what is that? Operating leverage. In brief, it is a content, dear students. Operating leverage, financial leverage, combined leverage. Once again, leverage represents, in this class, what we discussed is, what are the topics we discussed? Leverages. Here. In this session, once again, I discussed leverage. I explained what is the leverage impact is. Then we discussed what is the interaction, how it affects. Okay. Then we discussed the types of leverages. Then we discussed operating leverage. Thereafter, in operating leverage, I discussed a concept and I discussed with the estimation of operating leverage and financial leverage. Then estimation of financial leverage. Then we come to combined leverage. Then we identified what is the impact of all the leverages. Then we come to estimation of combined leverage, right? And with the support, we solve the problem. In next class, we will take few more problems. Okay, make it note. It would be very, very useful for you, right? Yes. Hello, dear students. So yesterday we discussed about leverages. What is the concept of leverage? We discussed types of leverages. I discussed with you: operating leverage, financial leverage. What is operating leverage and how estimation of operating leverage, and financial leverage estimation, and combined leverage and its estimation. Then I told you what is the relationship between how operating leverage, financial leverage, combined leverage influences, right? Then today we are going to discuss the certain problems basing on this chapter, right? The problem already in first model problem we discussed yesterday, RAM limited, right? RAM limited, but once again I recoup. RAM limited details. The RAM limited details are as follows: sales 24 lakhs, variable cost 50%, fixed cost 10 lakhs. It borrows 10 lakhs at 10% and its equity share capital is 10 lakhs. Consider tax rate is 50%. You have to find it out. What is that? Operating leverage, combined leverage, financial leverage, return on investment. Return on investment is nothing but return on investment equal to EBIT divided by capital employed. Sometimes from the EBIT you may also deduct interest also. If sales increases by 6 lakhs, then what will be the new EBIT? And how do we find sales if not given asset turnover ratio? If sales are not given and ATR means asset turnover ratio is 2.4 times. Okay. Now coming to income statement, if you want to calculate the leverages, first you have to find it out. Income statement: sales 24 lakhs less variable cost is given 12 lakhs contribution. Yesterday we discussed all these things. Contribution less fixed cost, you will get the EBIT, less interest, you will get the EBT. Now you have to find it out. Operating leverage. Operating leverage equal to contribution divided by EBIT. Contribution, operating leverage equal to contribution divided by EBIT 6 times. Observation: at any cost, 1% change in sales leads to 6% change in EBIT. This is an operating leverage. Financial leverage: EBIT divided by EBT. EBIT indicates 2 lakhs divided by 1 lakhs equal to 2 times. So financial leverage equal to EBIT divided by EBT 2 times. Combined leverage: contribution divided by EBT. 12 lakhs divided by 1 lakh, that is nothing but 12 times. Next, coming to return on investment. Return on investment, just now I told you, return on investment is nothing but if you make investment, what is the return you supposed to get it from the capital employed. Sometimes what happens, from the return on investment you will deduct the tax. Sometimes without tax out also you may consider it. So EBIT divided by capital employed. Here capital employed is debt and equity. So total 5%. And now they asked us estimation of new EBIT if sales increases by 6 lakhs. So if sales increases by 6 lakhs means, try to understand, currently sales increases by 6 lakhs means current sales are how much? 30 lakhs. So 6 lakhs it increases means it becomes 30 lakhs. So 24 lakhs current sales, it increases by 6 lakhs means it would be 30 lakhs. Less variable cost you can deduct. Variable cost is 50%. Then you will get the contribution. Less fixed cost, if you deduct EBIT, you will get the 2 lakhs and 5 lakhs. So now proposed EBIT. This would be the EBIT would be Proposed EBIT would be 5 lakhs, but if you want to convey the new innovative is difference between these two would be 3 lakhs. Right, ma? So that is next. What is asset turnover ratio? See, asset turnover ratio is a ratio which shows the relationship between total assets and the turnover. It means that if you make investment on assets, so how many times the company able to generate its sales would be called asset turnover ratio. Asset turnover ratio represents in times. Now, asset turnover ratio equal to turnover divided by total assets. Here, turnover divided by total assets means turnover is given there 2.4. If you want to find it out, turnover equal to total assets into 2.4 equal to 48 lakhs. Okay. Do you know what is asset turnover ratio? It is the ratio which shows the relationship between asset turnover. It indirectly conveys that if you make investment on assets, so how many times? Assets means total assets. How many times you are generating sales comes under the category of asset turnover ratio. Next, following are the selected financial information of A Limited as well as B Limited. There is a second problem we are going to discuss. In this problem, what happened? In first model, they will give you income statement. We have to calculate leverages. In second model, they have given some data. We have to construct what is that income statement. The following are the selected financial information A Limited, B Limited. Variable cost ratio 60%. Variable cost ratio 60% means contribution ratio would be 40%. Whereas interest is 2 lakhs, operating leverage is 5, financial leverage is 3, tax rate is 30%. So from this basic on this information, you have to instruct a income statement. Dear students, in this problem you try to understand. Interest is given 20,000. Financial leverage is given 3 times. So financial leverage equal to EBIT divided by EBT, right? So if you can, with the support of financial leverage as well as interest, you can trace it out EBIT easily. How? Financial leverage equal to EBIT minus interest divided by EBT, right? Sorry, EBIT, financial leverage equal to EBIT divided by EBT. Can you write like this? EBIT minus EBIT minus interest equal to financial leverage. Hello? Then if you multiply financial leverage with interest by resolving, you can get the EBIT. It means that estimation of EBIT basing on financial leverage can be estimated. For this purpose, we have EBIT can be calculated. Without like this, simply you can follow the techniques, right? EBIT, here you see. So financial leverage equal to 3 times. Interest is this. Interest equal to EBIT equal to this. So financial leverage equal to EBIT divided by EBIT minus interest amount is given 20,000. 20,000 equal to financial leverage is 3. In such a case, if you bring this one, EBIT equal to 3 EBIT minus 6 lakhs. Okay, then 2 EBIT equal to 6 lakhs, right? Now, from 3, if you deduct this one, right, 2 EBIT, thus EBIT equal to 6 lakhs divided by 3, not 6 lakh, this is a 60,000, right? 20,000 actually. 20,000 means 60,000 you will get it. 60,000 divided by 2, you will get what is that? 30,000. Okay, in same logic here also they considered this. Here you see financial leverage 3 times, interest is 2/3, interest 20, EBIT would be 30. So instead of this, you can calculate. Once you got the EBIT, you can easily find it out. What is it? EBIT, you got it. From the EBIT, you got it. So EBIT minus interest. Interest already has 20,000. You will get the EBT 60,000, right? You see here I will solve it. The problem number. See, first one is estimation of EBIT basing on financial leverage. Okay, right. Financial leverage equal to EBIT divided by EBT. Can I write like this? EBIT divided by EBIT minus interest. that equal to 2.4, I think so. Financial leverage is 3. Financial leverage 3. Thus, EBIT equal to 3 EBIT minus interest is 20,000 means 60,000. Thus, if it crosses 2 EBIT equal to 60,000, thus EBIT equal to 60,000 divided by 2, that equal to 30,000. So once you got the EBIT, then what you have to do? Step number 2, estimation of contribution basing on operating leverage. Thus, operating leverage equal to contribution, okay, divided by EBIT, right? Contribution divided by EBIT. So, operating leverage also given in OSMA. Operating leverage is 5. Operating leverage is 5. Operating leverage is 5. Operating leverage is 5. So, 5. Thus, contribution equal to EBIT, that is 30,000 into 5, 1,50,000. 1,50,000 is the contribution, right? Once this both are completed, you can prepare income statement. Income statement, that is what they asked actually. From the selected information, AB limited variable cost ratio, income tax, nothing but the tax rate to be considered, that is. So now income from the following selected financial information year ended 31st March. You are required to find it out. Only EBIT they asked. There is no need to find it out all these things. Financial leverage, operating leverage. EBIT, we find it out, right? Coming to only that is the part, just I went beyond contribution also I calculated, but just they asked EBIT. Coming to the next problem is here, problem number 3. Problem number 3, the following details of the company on 31st March 2022, operating leverage is given, combined leverage is given, and fixed cost excluding interest is 3.4 lakhs is given. Sales, how much? 50 lakhs. 8% debentures, 100 rupees each, 30.25 lakhs. Equity share capital, 34 lakhs. Income tax rate is 30%. Calculate financial leverage, PV ratio, earning per share, find out return on investment. Does it have favorable financial leverage if the company belongs to an industry whose asset turnover ratio is 1.5? Does it have high or low asset turnover? At what level of sales the earning before interest EBT of the company will be equal to 0? These are each and every topic is given. By solving this problem, we are going to wind up the leverage chapter. Right? What is the concept? Financial leverage they asked. Dear student, operating leverage is given, combined leverage is given. Can't you calculate financial leverage? So operating leverage into financial leverage equal to combined leverage means combined leverage divided by operating leverage equal to financial leverage. Yeah, combined leverage. Operating leverage, financial leverage equal to our combined leverage. So financial leverage equal to combined leverage divided by operating leverage. You will get what? Combined leverage, right? Second one. PV ratio. What is a PV ratio? PV ratio, also called contribution ratio. Contribution ratio conveys that how much of contribution is there in the given sales made. Contribution ratio formula, contribution divided by contribution, PV ratio is nothing but contribution divided by sales. In the given situation, how much would be the contribution made by the company? In this problem, sales are given, right? Sales are given. If you are able to find it out contribution, you can easily find it out what? Contribution ratio. Contribution ratio formula, contribution divided by sales. Sales are given. You have to find it out contribution. For this purpose, the strategy is operating leverage is given. Operating leverage equal to contribution divided by EBIT. So just now we calculated what is that? Financial leverage is there. So basing on the contribution, you can, with the support of operating leverage, with the support of fixed cost, you can find it out because fixed cost is given here. In this problem, how do you find it out? Operating leverage equal to contribution divided by contribution minus fixed cost. Whereas 2 contribution minus fixed cost equal to EBIT only, instead of writing EBIT, why don't you write like this? Contribution minus fixed cost. Then 2 equal to contribution divided by 3,40,000. So contribution equal to 2 into C minus 3,40,000. That is C equal to 2C minus 6,80,000. Then contribution equal to 6,80,000. So this is the way to find it out, the contribution, where operating leverage 2 equal to contribution divided by contribution minus 3,40,000. 2 into contribution minus 3,40,000. Contribution equal to 2C into 6,80,000. Contribution 6,80,000. Next, PV ratio basing on one's contribution, contribution divided by sales into 100. So 13.6%. So contribution ratio, contribution divided by sales into 100. Next, they have given what is the earning per share. Earning per share means already you know that EBIT from EBIT minus interest. So how do you calculate EPS? EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares equal to EPS. In this problem, you see sales minus variable cost equal to contribution less fixed cost equal to EBIT minus interest equal to EBT into 1 minus tax is nothing but PAT divided by number of equity shares. If you make it, you will get what? Earning per share, right? Here the problem is taken 50 lakh minus 43 lakh 20,000 minus 30 lakh 40,000 minus 2 lakh 42,000 into 70%, 68,600. Whereas EPS, if you estimate that, it would be 0.202. Whereas return on investment or return on capital employed. Return on investment, return on capital employed, what is conveys? How much investment you made it with respect of investment, how much income you are generating. That is called return on capital employed. So EBIT divided by capital employed. EBIT you got it 3,40,000. The total capital you employed, that is nothing but 64 lakh 25,000. 64 lakh 25,000 is the total capital employed. Here it is. Equity debenture is 30 lakh 25,000. Equity share capital is 30. So 64 lakh 25,000 you used to get it. Right. Then you have to calculate what is it. And another point they asked is, if the company belongs to, find the return on investment, return on capital employed. Return on investment equal to EBIT divided by capital employed. That is return on investment. The next question they asked, does it have favorable financial leverage? These students keep it in mind. Whenever we raise the funds by issuing a debt, right, we are supposed to pay interest. The point is how much interest you will pay. From that you will also get tax advantage. Let us take interest is how much it is, 8%. Keep it in mind. 8% is the interest. But fact is that from the 8% you are supposed to get 30% tax rate. It means that from 8, if you deduct 30% tax rate, 8 into 70% only, it would be chargeable. So 5.6% is the your net interest to be paid. But whereas return on capital employed, what is the amount you got it? Return on capital employed is the 5.29%. 5.29%. Now it indicates that even if you take tax consideration also, even if you consider tax also, your return on investment is less than cost to be paid. In such a case, will you feel is it good to take the finance in the form of debt? No, absolutely not. Without taking tax means you have to pay 8% actually. By chance, you assume that the tax rate. But you see, in government, in future, government policies, relationships may vary from company to company, year to year. In such a case, If you ignore tax, 8% is the interest to be paid, whereas return on capital employed is just uh, here it is return on capital 5.28%. So it means that the company is not moving perfectly, right? Next, asset turnover ratio. What the question is asked, asset turnover ratio. If the company belongs to an industry whose asset turnover ratio is 1.5, whether it has high or low. Let me tell you, what is asset turnover ratio? First problem itself I told you. Asset turnover ratio is nothing but it is a ratio through which we can assess what is the performance of the company. Asset turnover ratio speaks number of times the EBI, the turnover is company is making from the given investment made on assets. So asset turnover ratio equal to turnover divided by total assets. Here, if you observe, if the company belongs to an industry, if you consider it, then it would be what is that? It would be capital employed, total assets. Here you see asset turnover ratio. Asset turnover ratio equal to sales divided by total assets. Sales 50 lakhs divided by total assets 34 lakh 30 lakh 25,000 0.78. So it means that 0.78 is the asset turnover ratio. But whereas industry's asset turnover ratio is 1.5, means it has a low asset turnover ratio. It is not good to the company to make investment on this. Okay. Next, level of sales at which EBT becomes a zero. What is that? Level of sales at which EBT becomes zero. See, level of sales EBT and becomes zero means you should estimate the EBT, where your sales would be zero means you have to calculate from down. For example, EBT would be zero means in the entire sales you don't know, variable cost you don't know, contribution you don't know, less fixed cost. Fixed cost you know. From that fixed cost, if you deduct a fixed cost, you will get the EBIT. From the interest, you will get interest is fixed. EBIT interest, you will get the EBT. EBT zero means it should be equal to interest. Thereafter, EBT fixed cost by calculating from top to down to bottom, right? Or down to up to top, right? Bottom to top, okay. Bottom to top, you can find it out. This can be easily calculated like this. Fixed cost plus interest, desired profit divided by PV ratio. That means 42,79,412. If you are able to make sales at which your EBT would be zero. So, dear students, so this is the calculation with respect to leverages. While going on calculating, we will get many problems, but leverages, first of all, you should have an idea by keeping this concept in mind, right? Work it out, and certainly it will support you. Leverages, three types: operating leverage, contribution divided by EBIT, financial leverage, EBIT divided by EBT, combined leverage, contribution divided by EBT, asset turnover ratio, turnover divided by total assets. Okay, return on capital employed, EBIT divided by capital employed. Thereafter, what is it? PV ratio, contribution divided by sales. So while calculating financial leverage, can you able to find it out EBIT? Of course, sir. EBIT divided by EBT. From EBT minus the interest, you will deduct EBT. And must also know, we learned how to calculate contribution with support of operating leverage. Okay, operating leverage based, you can also calculate contribution with support of EBIT. So by working all these things, you can solve any problem from leverage chapter. Thank you. Hi dear students, now we are going to take one more new chapter that is called investment decision. Hi dear students, now, hi dear students, now we are going to take investment decision. So investment decision is very, very important for the public exam. It is very, very essential chapter. You must have 100% command over this chapter, then only you can get better score. Let us take a capital budgeting. You try to understand these students. This is a Palm Island. In this island, biggest investment required. The corporate companies, by filling ocean, they constructed such a biggest investment. You try to understand if you are a financial manager, right? If you are a financial manager, if such a huge investment you are going to make, right? Then what is your strategy? How by filling this ocean and constructing such a biggest gigantic project, it need a huge investment. How the corporate companies they do, how the corporate companies they will make estimation. That's is the my topic today. So try to understand similar to that Tata groups is when Air India, recently Tata Group is purchased Air India company, but even though they know that they are running under losses, Tata Air India, but still they made analysis and they purchased it. What is the hidden reason? And recently Twitter was purchased by Elon Musk. So how he had made a plan to make that one. That is everything which done with how they could done it with subject of capital budgeting. See, if you observe the whatever the data I submitted to you, it is not a small one, right? It is a huge investment it includes. Whenever company makes a huge investment proposal, so what their plan of action, dear student? Tell me, what their plan of action? They will certainly, absolutely, they make a huge investment. In such a case, will they go for decision by making 1 rupee task? Yeah, 1 rupee task. Will they do? No, they won't do the 1 rupee task. But the thing is, they will make investment on assets. They will make systematic evaluation. For the systematic evaluation, the technique what they are going to learn is called, what is it? Capital budgeting or investment decision. That is the topic today, right? Capital budgeting. Capital budgeting, if you ask me, dear students, it is the evaluation of long-term investment planning. You see it here. Capital budgeting is the process of evaluating and selecting, what is that, long-term investment projects. Okay, here it is. Long-term. So capital budgeting is a process of evaluating and selecting of, what is it, long-term investment planning. So here it is also called capital expenditure planning. Try to understand. It is also called capital expenditure planning. It enables the financial manager how to invest, how much to invest, how and whether it is worthwhile to invest or not. Everything we can learn with the capital budgeting. Example for purchase of land and machinery, construction of factory and building, and the commencement of new business. Everything comes under capital budgeting. Sir, is it essential to learn the capital budgeting? Is damn important, because importance of capital budgeting decision means it includes substantial expenditure. Okay, because the investor who's supposed to make investment on fixed asset includes substantial expenditure. It influences a long period, because once you make investment on the project, right? Once you make investment on the project, if it is investment is very very small, right? Investment is very very small. No need of plan of action. We can comfortably make investment. But the thing is, if investment is huge, in such a case, you must be very very careful. So capital budgeting knowledge is essential for the financial manager, because the client who is supposed to come to his office in order to make investment on fixed assets includes substantial expenditure, and it is a long time period. It is irreversibility and at the same time it is a complex decision. Investment decision is not a simplex, it is a complex. Right now the point is, what are the various methods of estimation of capital budgeting? You have different types of method: traditional methods, non-discounting methods. In this traditional method, we used to calculate payback period, we used to calculate accounting rate of return, and we used to only two things comes under traditional payback period. Coming to in modern techniques, you will have net present value, you will have internal rate of return, you will have profitability index, and you will have discounted payback period. Discounted payback period. One of the point is traditional payback period ignores time value of money. Modern method considers what is the time value of money. So we are going to learn all this method, and basing on all this method, we are going to solve the problem. Okay. The first one is, we are going to, in order to evaluate any of the project, first of all, you understand the following elements should be considered. One is, what is your cash outflow you supposed to make. Thereafter, what is your cash inflow you supposed to make. Thereafter, you have to consider what is the tax impact. And finally, you have to consider your time value of money impact. So cash outflow, cash inflow, life, tax, present value factor, present value of vanity factor, everything to be considered. Generally, these cash flows, if you observe, these students, beginning we will make investment, and first year, second year, third year, and fourth year, for every year ending, we used to get operating cash inflow, operating cash inflow, operating cash inflow. At the end of fourth year, you will get a one more cash inflow called terminal cash inflow, and beginning you will make cash outflow. Now you will compare the total cash inflow with the cash outflow. If the cash inflows is higher than cash outflow, then project should be accepted. So how to compute the initial cash outflow, right? For the initial cash outflow, try to understand cost of machine you have to consider, plus installation charges. There is a problem in our study material with respect to installation charges, and working capital to be added, subsidy to be deducted, and net sale proceeds from old asset if at all is there. you have to deduct that one. Okay, then you will get the initial cash outflow. This is the way to find it out, initial cash outflow of the project. For example, you see this petrol outlet is a fixed asset, but petrol is a working capital. So if you want to do such a business, you need fixed asset come working capital, right? So one of the characteristics of working capital is how much investment made on a working capital that would be recovered at the end of the period. Okay, because the fixed asset gets what is it? Depreciation, and it may disappear one point of time, but current assets what happen? Circulates and remains same. Okay, that is the working capital. Working capital treatment is add to initial investment and recover it from your terminal cash inflow. Now, how do corporate companies estimate operating cash inflow? That is also you should understand. Just now you calculated how to find it out. What is it? Initial cash outflow. Then you have to find it out. What is it? Cash operating cash inflow. Take sales revenue. Take only cash sales. Less variable cost. You will get the contribution. Less fixed cost. You will get the profit before depreciation and tax. Less depreciation. You will get the PBT. Less tax. You will get the PAT. PAT also called accounting profit. Add depreciation to it, you will get what? CFAT. CFAT is nothing but cash profit. So this is the way you have to find it out, operating cash inflow. Then you have to calculate terminal cash inflow. Terminal means whenever you are using an asset, you purchased an asset, you hold it for given period and you used it. From that asset, you generated revenue also. But once your project is going to be closed, in such a case, what happened? You supposed to scrap this asset. When you scrap the fixed asset, whatever the return you will get, it is called what is a terminal cash inflow. So gross sales revenue, next written down value, you compute written down value. Written down value is nothing but cost minus accumulated depreciation. From the gross sales revenue, if you deduct written down value, you will get the capital gain or loss. Then you will get the tax or tax shield. So at 50%, then net sale proceeds. Net sale proceeds add recovery of working capital. So gross sale proceeds, written down value, compare capital gain. From the capital gain or capital loss, you will get it. You will get the tax shield. If either tax or tax shield, then you have to pay what is the net sale proceeds and add recovery of working capital. You will find terminal cash inflow. Right? This is the method. Various methods. Tomorrow we'll start payback period. Thank you. Hi dear students. So let's move into the payback period. What is a payback period? Payback period is a time period in which invested cash outflow can be recovered from its cash inflow. The payback period is one of the traditional method. It ignores time value of money. Examination point of view, the weightage from this area is very low because it is very easy concept. Right? How the cost of payback period is estimated. Let's make it. You are an investor, right? Here is your investor. I'm coming down here. You are an investor, right? You make investment in this project. So cash outflow goes from here to there, and you may generate the cash inflow over the period of a long period, right? And how long you have to wait to recover your investment comes under the area of what? Payback period. So payback period is nothing but it is a time period in which invested cash outflow can be recovered from its cash inflow. How long you have to wait to recover your investment is called payback period. In order to calculate the payback period, steps to estimate is step number one, estimation of payback period. To calculate, first you have to estimate cash outflow. Cash outflow means whatever the investment you made it. Step number two, you have to estimate operating cash inflow. Then you have to calculate payback period. What is the step number one? Step number one, estimation of cash outflow. Step number two, estimation of cash inflow. Cash inflow means operating cash inflow, terminal cash inflow. Thereafter, you have what is that? Estimation of payback period. This payback period estimation includes two methods. Method number one is when cash inflows are every year equal. In such a case, annual cash inflow divided by number of years. Okay, when cash inflows are equal, every year equal means annual cash inflow means initial investment divided by annual cash inflow, you can take it. When cash inflows are every year is not equal, unequal, in such a case, covered year plus balance divided by next year, CFAD. Very simple example I will give you. Here you see every year cash inflow is same, right? So 5 lakhs, 5 lakhs, 5 lakhs. In such a case, payback period equal to initial investment divided by annual cash inflow. Whereas when cash inflow every year equal, when cash inflow unequal, in such a case, here it is 10 lakhs divided by 10,000 divided by 5,000 is nothing but what is that? Payback period is 2 years. At the same time, what happened? You can estimate what is this? Every year cash inflow is unequal. In such a case, what do you do? Covered year plus balance divided by next year CFAT. So I repeat once again, how to calculate? Here it is. Here the problem, every year initial investment is 10,000. Initial investment 10,000, and pen is not working here. 10,000 divided by 5,000, 2 years. When cash inflow is every year equal, in such a case, you have to make a cumulative covered year plus balance divided by next year's CFAT. You have to find it out. How to calculate payback period? Decision making of payback period. When payback period is less than standard payback period, project should be accepted. When payback period is more than standard payback period, project should be rejected. When payback period is equal to when payback period is equal to standard payback period, either accept or reject the project. When coming to mutually exclusive, then you have to understand whether the project is mutually independent, mutually exclusive. If the mutually independent means accept all the project if the payback period is less than standard payback period. Mutually exclusive means accept the project which has least payback period, right? So all past exams they are given this area. Maximum the questions we may expect: what is the payback period? What is the standard payback period? Does the payback period consider time value of money? How do you evaluate investment decision basing on payback period? How do you compute the cash flows with the support of when you want to calculate the payback period? These are the most important points from this chapter, this area. So payback period is nothing but it is the time period in which invested cash outflow can be recovered from our cash inflow. This method. Thereafter, accounting rate of return. Accounting rate of return is nothing but it is the average annual rate of return. Average annual rate. Let us come to here. It is just now we make it here. What is the payback period? Payback period. Just now I told you what is the payback period. Tell me. So it is the time period or length of time duration in which invested cash outflows are recovered from its cash inflows. That is a payback period. So one of the limitations of it ignores time value of money. Merits. What you can say merits? Easy to calculate, easy to estimate, and easy to understand. Easy to estimate, easy to understand. Okay. So this is the payback period, right? Calculation of payback period. How do you calculate the payback period? Right. Estimation of payback period. A. Equal cash inflow. When equal cash inflows are there. In such a case, payback period equal to initial investment divided by annual cash inflows. Okay. For example, you invested for 10,000. Every year, how much? 5,000. Okay. Just now I told you one of the PPT here. When every year, what is that? Equal to cash inflow you receive. Every year, you invested, how much it is? You invested in this problem, you invested every year 10,000. 10,000 invested. Every year, 5,000 means you are getting, means try to understand how much the cash inflow you supposed to get it. Here it is 10,000. Every year, 5,000 means nothing but 2 years. Okay. When cash inflows are unequal, when cash inflows are unequal, in such a case, payback period could be estimated. Covered year plus balance divided by next year CFAT. Covered year plus balance divided by next year CFAT can be estimated with support of payback period. Okay. So this is the payback period. Now it is a payback period and how the payback period should be estimated, right? And the decision making with respect to payback period would be like this, right? When payback period, every year cash inflows are equal. You see, how do you calculate this? When every year cash inflows are, what is that? Equal. In such a case, cash inflows are every year equal. Single project, just now I calculated. When payback period is less than standard payback period, accept the project. Payback period is more than payback period is more than standard payback period, reject the project. Payback period equal to project, either accept or reject. Mutually exclusive means accept all the project whose payback period is less than standard payback period. Accept all the project whose payback period is more than. Accept all the project which has the least payback period. Mutually exclusive means we want to find it out the best. So this is the calculation, payback period, estimation, and decision making. Coming to accounting rate of return. Next one, we will take accounting rate of return. These are the two traditional methods. So I will solve the problem by taking one example. Okay. Next one is accounting rate of return. Accounting rate of return. Accounting rate of return. See, accounting rate of return is the average annual yield. It is the average annual yield or yield. Okay, yield or profit earned from the project, which is expressed in rate or percentage. Rate or in percentage. So that is the accounting rate of return. So how to estimate the accounting rate of return, right? Then you should understand is estimation of ARR. First of all, you understand, right? What is accounting rate of return? Try to understand. If you made it investment in a project, right? Today you made it investment in the project. So every year you do the business, right? Every year do the business. But the investment, what you made it on project, right? The investment you raise it from outside. So you're supposed to pay to the cost every year ending. The person who provided fund to you, he will come and he will claim the interest. Now the thing is, this accounting rate of return technique, what it identifies that whether the investment what we made on the project could it able to generate the profit through which I can repay my loan or loan's interest. So that is the ultimate objective, right? Accounting rate of return means it is a profit after tax is considered to be accounting rate of return. Accounting profit. So accounting rate of return is the nothing but it is the average annual yield made or earned from the given project, which is expressed in rate. ARR of the project is 20%. What do you mean of this? Every year company able to generate 20%. What is the logic for this? If you are able to generate 20% means comfortably you can make payment of interest worth of how much? 20%. That's why you can have a capacity to raise the funds at what is that? 20%. So that would be the accounting rate of return. How do you calculate ARR? This ARR can be estimated in different ways. Number one, here it is, a ARR estimation. Estimation of ARR. Just now, estimation of ARR on the first one is on total investment basis. total investment basis. On total investment, what you can try? ARR equal to average profit divided by total investment. So here average profit equal to sum of number of years profit. You can say sum of number of years profit divided by number of years is nothing but average profit. You can write here average profit equal to sum of number of years profit divided by number of years. Then you have to take the total investment. This is the first method on total investment basis. Thereafter, you have a second method. The second method is number 2, ARR on average investment basis. Where average investment basis means what is the formula? Here it is. I made it a few calculations series. See, estimation of ARR. Let us take here. ARR, just now I told you, accounting, it is an average annual yield. How to compute the ARR? So ARR can be calculated by estimating investment, and you have to calculate accounting profit, and basing on ARR can be computed. Here estimation of ARR on a total investment basis. Yes, ARR equal to average profit divided by total investment. Average profit equal to sum of total number of years profit divided by number of years. Thereafter, average investment basis, where ARR equal to average profit divided by average investment. Where average investment, how do you calculate? Half of initial investment minus salvage value plus working capital. Okay, that would be the formula to compute this one, right? Another one is annual investment basis. Annual investment basis means ARR equal to average annual rate of return. Annual rate of return equal to annual profit divided by investment in the beginning of the year. This is the third method. In this method, what happened? First method, second method, third method, once you observe all the methods, and first method, total investment base, where we believe that the investment every year remains same, but it could not possible. Why? Because investment you are making, when you use the asset every year, asset gets what? Depreciation. Whereas second one is on average profit, average investment basis. Average investment means half of initial investment minus salvage value plus minus salvage value, half of initial investment minus salvage value plus working capital. This is another method, right? Third, final method is annual investment basis, where in this method we will take the total investment made by the company. Total investment made by the company we will take, right? These are the methods. How do you take the decision making? You see, ARR, if the estimation decision making, if you want to take on the basis of ARR, ARR must be greater than cost of capital, then project should be accepted. ARR is less than cost of capital, then project should be rejected. ARR equal to cost of capital, either accept or reject. Whereas multiple projects means mutually independent. Mutually independent means accept all the project if ARR is greater than cost of capital. Mutually exclusive, accept all the project if ARR is least highest ARR project should be accepted. So this is ARR ignores time value of money. ARR considers accounting profit. Since accounting profit has a limitations of, it ignores what is that? It considers both cash sales as well as non-cash sales. First one, as well as it considers what is that? Both cash sales, non-cash sales. It considers as well as cash transactions as well as non-cash transactions also it considers. Because of this, it absolutely fails to project a true true cash position of the company. That is the error. Okay, this method ignores time value of money. It is not so popular method because it has another alternative technique called IRR. These two techniques, either payback period ARR, comes under the traditional method. Now we will move to the NPV. It's a wonderful technique. Examination point of view, we can expect NPV. So what is NPV? NPV is nothing but it's a value or benefit derived from the project as on the day of investment. So net present value, what it conveys? NPV it represents, for example, if you make investment in the project, it's your outflow and you are going to get the cash inflow. So the situation you are going to think is how much wealth I can generate as on the day of investment. As on the day of investment, I'm not talking about the profit, I'm talking about the investment. So how much would be the wealth I supposed to generate because of making investment? I used to compute this one. This is payback period. NPV is nothing but it is the value or benefit derived from the project as on the day of investment. It speaks about, it conveys directly that because of making investment, right? So what is the wealth I supposed to generate? It's not a profit, dear students. From the sales, if you deduct the cost, then you will get the profit. But along with the profit, you are deducting your investment also. So in such a case, after deducting everything, whatever the value you got, it is called, what is that? Net present value. So how do you compute this NPV? So to estimation of NPV you need to find it out. PV of cash inflow, PV of cash outflow. So PV of cash inflow, inflows again classified into two types. One is operating cash inflow, another one is terminal cash inflow. Whereas thereafter PV of cash outflow. PV of cash outflow, it speaks that, right? It is an outflow made by the company. So estimation of NPV equal to PV of operating cash inflow plus PV of terminal cash inflow minus PV of cash outflow. You will get the NPV, right? How to consider this one? To calculate the NPV, you have to you must have the knowledge on various concepts: time value of money, variable cost, fixed cost, depreciation, tax treatment. Sir, no, all these cash flows you have to, then only you can able to calculate this NPV. Now, coming to once you calculate NPV, right, how the decision to be taken into consideration. Decision making basing on NPV. Once you calculate the NPV, if the project is single, in such a case, what you say? Accept the project if NPV is positive. If it is a negative, accept the project if NPV is negative. NPV is greater than 0 or positive, accept. NPV is negative, reject the project. NPV equal to, then either accept or reject the project. Then multiple projects, mutually independent, mutually exclusive. So mutually independent means accept the project if NPV, not here it is NPV, wrong, it's a spelling mistake. NPV greater than 1. Mutually exclusive means accept the project which has highest NPV, right? The key points to remember in this point, these are the very, very important points I observed. You have to keep it in public exam in order to, what is that? Decision making basing on cash inflows, not accounting profit. This NPV considers, what is it? Key points, that is, it takes cash inflow but not accounting profit. Treatment of working capital. In calculation of NPV, working capital treatment, what you have to do is beginning you will add it, right? You will add the cash outflow beginning, and at the same time you recover your terminal cash inflow at the end. And the treatment of subsidy, whenever you commence the project, right, subsidy would be provided. This subsidy should be deducted from your cash outflow. Subsidy from it deducted from the cash outflow. Then tax and tax shield. Whenever company makes a profit, you have to pay tax. Whenever company makes loss, then you will take an assumption that company eligible to get what? Tax shield. Sunk cost. See, the project which commenced before, the cost which incurred before commencement of the project is called sunk cost. Don't take such a sunk cost. Okay. Thereafter, variable cost ratio. Variable cost ratio, while calculating CFAT from the sales, you have to find it out variable cost. For that purpose, you can use the variable cost ratio. Variable cost ratio, it is a ratio which shows the relationship between sales and variable cost. Variable sales and variable cost. Variable cost ratio 60% means, then another ratio, contribution ratio, would be 40%. Contribution ratio, another formula called PV ratio. Thereafter, opportunity cost benefit, opportunity cost loss. Because of undertaking project, right? Sometimes we may get the benefit. We discussed one hospital problem where hospital CT scan machine. So hospital takes a rent of, hospital wants to buy CT scan machine. In such a case, it forgoes the commission. That is an opportunity cost loss. If at all, because of making investment, if it generates any income, then it is called opportunity cost benefit. Next, treatment of depreciation. Treatment of depreciation in the presence of tax. See, whenever there is a taxes, that depreciation must be considered. Why? Because depreciation is a non-cash expenses. In order to reduce the tax burden, we will consider depreciation and treatment of depreciation in the absence of tax. When there is no tax, no depreciation. Multiple assets are purchased at a different time period. When assets are purchased at a different time period, what you have to do is you have to bring all the assets into present. For that purpose, you must use the present value factors. So next, initial payment and additional payment for the asset. Sometime asset may be acquired by making a multiple investments. Beginning, you can make an outflow, and during the period also you can make an investment. In such a case, you can bring into present. Set off the loss. Set off the loss means, suppose you make a loss this concern year, you are eligible to get a tax shield. But sometimes instead of getting tax shield, what concern year in future, you may get the benefit in the form of tax saving. In such a case, whatever the loss you made it a concern year, don't take any tax advantage on this. Why? Because your loss is going to be set off in future. That would be the advantage. That's why set off loss. When set off loss is there, the loss we are going to get tax shield on in future, tax advantage in future. That's why in current year, you should not get the tax advantage. Next, the present value factor, present value. When every year cash inflow equal, present value annuity factor you take. When every year cash inflow is unequal, take present value factor. How do you bring equal cash inflow which arises in the middle of the year? For that purpose, concern year's factor value must be added. Next, types of economies. There is a problem we discussed in Allied Cooker Company. Economies. Economies means large scale benefits. So when this economies may be in the form of investment, in the form of cost. Okay. Well, while you take a multiple combination, in such a case, individually, how much cost you supposed to incur. In a group, if you incur less than this, then it is a benefit. That is a cost to economies. Whereas if you are able to sell asset individually, how much cost it is going to incur in future by going with a different combination. If you can sell the asset in a huge manner, right? In such a case, whatever the additional benefit you supposed to get, it is called, what is that, marketing economy. It means that very simple. I am going to sell this product 10 rupees, this product 25 rupees, 10 plus 25, 10 plus 15, 25, this 10, this 25, 35 rupees. But if I go with a combination, if I able to sell both at 50 rupees, then such a benefits called economies of marketing. So these are the points of all study material entire problem, because by studying the study material systematically, I identified this concept with respect to NPV. You make a note and analyze it. Now, basing on this, in NPV, we are going to solve few problems. You see, Cello Limited, problem number 1, we are going to do. So, Cello Limited is going to buying a machine which would have useful life of 5 years. The cost of machine 1,25,000, right? Scrap value 30,000. 80% of the cost is payable at the start of the project, 20% at the end of the first year. What do you do? 1,25,000 into 80%, you are going to pay now. 1,20,000 80% means 1 lakh. That is, you are going to pay now, and remaining 25,000 you are going to pay at the end of the first year. So you have to bring into present. The machine would produce 50,000 units, and a new product with the estimated selling price is 3 rupees. Direct cost also called variable cost. From 3 rupees, 1 rupee 75 paise is the direct cost, means remaining is the contribution. So annual fixed cost including depreciation calculated on straight line basis would be 40,000 per annum. In first year and the second year, special sales promotional expenditure not included in the above cost would be incurred, amounting to 10,000, 15,000 respectively. Calculate NPV for the investment appraisal, assuming the company's cost of capital is 10%. In this problem, we can understand that there is no tax. What is the treatment of depreciation? There is the expenses ignored by the company. What is your treatment? So for this purpose, you see, estimation of initial investment beginning 1,25,000 into 80%, 1 lakh. Additional investment made at the end of the first year, 1,25,000 into 20% into 0.909, 22,725. Next, estimation of PV of operating cash inflow. So here 1, 2, 3 to 5 you can take it. Here 5. Sales unit I have taken 50,000, 50,000. Contribution per unit, selling price minus variable cost. Okay. Then I got the contribution. By multiplying both, I got the total contribution less fixed cost. By deducting fixed cost, I got the sales promotional less sales promotional expenses also I have to deduct. How should I get the fixed cost? Fixed cost is, I know that how to can't estimate the fixed cost. Fixed cost including depreciation 40,000, less depreciation 90,000. So cash fixed cost is 21,000. Cash fixed cost is 21,000. So this 21,000 to be deducted from here. First year, second year, third year, less sales promotional expenses. Next you will get the PBDT, PBT, CFAT. So first year present value factor, second year present value factor, third year you are going to present value factor 3, 4, 5. By summing up of all the values, you will get it. Now by bringing, but if you bring into present, it would be 1,35,806. You will get it, right? Now NPV, terminal cash inflow, gross sale proceeds, net sale proceeds, terminal cash inflow is 30,000, because asset is going to get, we are going to scrap this asset at the end for 30,000 only. That 30,000 you brought here present, and since it is a single cash inflow, to bring into present we use present to value factor. So 0.621. Then PV of terminal cash inflow would be 18,630. NPV if you compute 1,35,000 NPV formula, PV of cash inflow plus PV of terminal cash inflow minus cash outflow. So 1,35,806 plus 18,630 minus 1,22,725 equal to 31,711. Okay, 711. So this is NPV, right? In this problem, what is the highlight we learned, these students? Very simple. The concept is, if no tax, no depreciation. If any expenses is ignored, you must consider. Okay. So in this problem, he ignored sales and variable expenses, we considered, and he ignored depreciation. He ignored tax. That's why we ignored depreciation. That is a problem. Okay. Right. Coming to the next problem, we're going to solve. Here it is. Where we will say, let us take here one problem. I exclusively prepared this problem. Is our mastermind material problem only. See, this is the problem. Okay. XYZ Limited is planning to introduce new product with a project life of 8 years. Initial equipment cost will be 3.5 crores. Okay, understand. Initial equipment is 3.5 crores. Additional equipment cost is 25 lakhs. Additional equipment is 25 lakhs purchased at the end of third year from the cash inflow of that year. Okay. And at the end of eighth year, the original equipment will have no resale value, but the additional equipment would be sold for 2,50,000. Try to understand. Initially, you purchased asset by spending 3 crores, and additional equipment is 25 lakhs. 3.5 crores one additional equipment. But for the additional equipment, you could not put from money from your pocket. You raised it you are going to acquire it from the cash inflow made, that too in third year, right? Then the working capital required is 40 lakhs. Okay, the units produced first year, second year, third, 4, 5, 6, 7, 8, like this: 72,000, 1,80,000, 2,60,000 in third year, 4 to 5, 2,70,000, 6 to 8, 1,80,000. And the sales price 2,40,000 per unit expected, and variable expenses will amounted to 60% of the sales revenue. Fixed operating cost excluding depreciation will amount to 36 lakhs per year. The loss of any year will be set off from the profit of subsequent 2 years. Selling price is how much? 240 expected, and variable expenses cost would be 60%. Dear students, variable cost ratio is how much? 60% means contribution ratio 40%. And fixed operating cost excluding depreciation is 36 lakhs. Loss of any year will be set off from the profit of subsequent 2 years only. The company is subject to 30% tax rate, and the considered 12% cost of capital, appropriate tax cost of capital of the project. Company follows a straight line method of depreciation. You are required to calculate NPV of the project, advise the management. What is the impact on depreciation if subsidy is provided? 50,000 given in the beginning. That is the point given. So it means that you have a two assets, but one asset you purchasing from the cash inflow. If you have a loss, you are not going to get it any tax shield, because the next year you are going to get the tax advantage. Okay, this is the problem. For this, I made to save your time. What is the highlight of the problem, right? Special economic zone you are going to start, right? Investment for multiple assets at a different time period, right? Investment made from the earned cash inflows, right? And set off the losses. If here you get the loss, then next year it is going to compensate, right? Tax and tax shield, right? What is the subsidy? It's a treatment in the estimation of cash flows, right? Project commencement with multiple assets at a different time period, right? Set off loss in future profit, right? Variable cost ratio, contribution ratio, working capital. You see, why I have taken this problem? By solving this problem, I can directly guide you 11 concepts how we have to identify it. First one, you see, evaluation of the project basing on NPV. PV of cash outflow. Cost of initial equipment 175, less working capital is 20, total initial equipment 125, and less subsidy for the project if the subsidy is given. Subsidy is not given, then it is okay, right? Okay. Here the solution also subsidy as per first part B we will get it. Here you see this directly we have taken this problem. Here initial cash outflow, cost of equipment 350 lakhs, working capital is 40. Working capital in this problem also we have taken 40. Hi dear students, yesterday we discussed the problem. Then what is the XYZ limited problem? Once again, XYZ limited problem is this. It commences project with the two machines and working capital, but additional machine is going to be purchased from not from initial investment, from the cash inflow generated from the project. Okay, and problem is given in number of units and variable cost ratio is given and operating a fixed cost fixed operating cost is given, and any loss which happens that is going to be deducted, that is going to be set off in the further profit, and it is not going to get in any tax shield on the concern year. These are the points you have to keep it in mind, right? Tax is there, tax is there means then depreciation you must consider. Okay, let's come into the problem. The point is, first of all, step number one, what is the PV of cash outflow? When you are going to calculate NPV, you have to find it out the PV of cash outflow initially. The cost of new equipment is 350 lakhs, whereas add working capital is 40 lakhs. If you sum it up, 390 lakhs, you will get it. Bali sir, I have small doubt. Additional equipment you purchased, keep it in mind. Additional equipment is purchased from the cash inflow generated from the project. It won't come here. That is comes from the third year cash inflow, right? This is the first step. Number one is finished. Since tax rate is there, means you have to calculate depreciation. Coming to step number two, depreciation. Cost minus scrap divided by life. Initial equipment 350 lakhs divided by 8, scrap value is 0. So 43.75. Additional equipment, you purchased 25 lakhs, scrap value 2.5 divided by 5, so 4.5 lakhs. So depreciation you got it. Next, move to PV of operating cash inflow. Operating cash inflow, how do you get it? Here 1, 2, 3, 4, 5, 6, 8. Okay. Then what is the sales you have to take? Sales revenue you will get it. How do you sales revenue you will get it? Sales units into selling price. Or else directly you can also calculate what is that with the contribution per unit also. But here the sales revenue given, from the sales revenue they deducted variable cost, they deducted fixed cost. Generally they used to get the PBDT. After deducting depreciation, they will get the PBT. PBT first year got the loss. First year got the loss. We know that the loss what you are going to get it concern year, you are not going to get the tax shield on it. But this profit would be, this loss would be further forwarded to next year. Next year, how much profit you made it, it is not a taxable. Why? Because this year loss also to be deducted from concern year profit. That this profit, this loss may be forwarded for hardly 2 years, dear students. First year, second year, 2 years it is going to be forwarded. And if at all any loss is there which is not able to recover within the 2 years, means answer. You should not consider that one. Okay, because that's ultimate responsibilities within the 2 years. Yeah. So here PAT is given, no tax advantage. That's why PAT add back to depreciation, you will get the CFAT 33.12 first year. Second year, sales revenue, variable cost, fixed cost, PBDT. Along with this PBT depreciation, if you deduct, you will get the PBT. From the PBT, last year loss also you must deduct it. Okay. Then you can you have to find it out what is that PV of operating cash inflow. Here generally they calculated cash inflow and third year they deducted it. So directly also you can find it out, no problem. So PAT, add back to depreciation, you will get the CFAT. Third year, sales, variable cost, fixed cost, you will get the contribution generally from sales minus variable cost contribution less fixed cost. Thereafter depreciation, so PBT less tax, PAT add back to depreciation. You will get the third year CFAT. And 4 to 5 similar to 170.715. 6 to 8 you got the Sales, variable cost, fixed cost, depreciation. This would be profit before tax, less tax, PAT, add back to depreciation 110 lakhs. Now, in order to bring the present, what they've done is here, separately they calculated. Initially, you are investing 390 lakhs. So, first year, you got the 33.12. Second year, 63.29. Third year, 162.3. Third one. But in third year, what happened? You can directly make a compensation. It means that third year you got 162.645 is the CFAT, but from the CFAT you are going to acquire an asset worth of by spending 25 lakhs. So that's why here they deducted, but directly you can also calculate like this. How 162 point 162.5645 162.645 minus 25. So additional equipment they purchased it. Next thereafter 4, 5, 6, 7, 8. 8 they given, right? Why don't you do this one? You can also go with the annuity also, right? And by bringing a present, and at the end of the third year, last year, you are going to recover your working capital. Now, by considering all these things, you can get what is that NPV, where NPV equal to PV of cash inflow minus PV of cash outflow, right? This is the way you can solve the problem. Or else, a similar model problem, the same model problem, I designed it. You can also follow this technique instead of, means problem is same only, but your approach is different little bit, amounts values. Here you can also calculate like this. See, project basing on cash outflow, PV of cash outflow you can calculate. Thereafter depreciation you can calculate. Thereafter working note contribution per unit you can calculate. Thereafter you see 1 2, here you see 1 2 3 4, 4 to 5, 6 to 8. Sales volume less contribution, total by direct multiplying both, you will get the total contribution less fixed cost, PBDT less depreciation, less brought forward loss, then PBT less tax, PAT add back to depreciation, and add brought forward to loss, because you know that should be add back again, less investment on assets. Like this also you can solve it because of operating cash flow. If you think, sir, it is a very comprehensive, means you can also follow like this, and PV of terminal cash inflow, and finally NPV. This is the format. Once again, this format also very, very important. Just you can check this one once again. But meanwhile, the information which is given in our study material is like this. So that's why we followed here. Okay. Then PV of terminal cash inflow, NPV, working capital, everything within a single table they covered here. So that would be the identity, dear students. Right? What is the highlight of this problem? Already I told you, subsidy, multiple assets, set of losses, depreciation. Okay, all these things comes under this category. Very, very important problem. So that is the problem number, which one? 11, XYZ Limited. Then what is that? You can go with the next concept is, what is that? Capital rationing. After this, the important point to be considered is a profitability index. Okay, we're going to discuss the profitability index. NPV finished, thereafter profitability index. What is a profitability index? Let me tell you. Profitability index, what do you say? It is the outcome of rupee invested. It is the outcome of rupee invested. So what it explains, if you invest 1 rupee in a project, for 1 rupee, what is the return you supposed to get it? This profitability index conveys that if what is the worth of a project to generate return for the rupee invested. So profitability index indicates one. Index one profitability means if you made 1 rupee investment, right? And what is your outcome is nothing but profitability index. It shows the efficiency of a project, how it effectively utilizing to every rupee in order to generate return is called profitability index. It is also called benefit cost ratio. It is also called it is also called benefit cost ratio. Okay, how do you calculate the profitability index? Very simple. Profitability index equal to PV of, here you can say, estimation of profitability index. Here we calculated what is the profitability index. Here estimation of profitability index. How do you calculate profit estimation of profitability index? See, profitability index equal to PV of operating cash inflow plus PV of terminal cash inflow minus, or minus is NPV, divided by PV of cash outflow is nothing but profitability index. It indicates 1.869. Suppose, what do you mean of this? If you made investment of 1 rupee in this project, with reference to 1 rupee, the company able to generate 1.869. Okay, 1.869. So this is profitability index, right? Why profitability index is essential means, dear friends, keep it in mind, dear students. Whenever funds are limited with you, right? When funds are limited, you should not spend the funds how you like it. Okay, when you are spending money, you have to consider what is the funds are limited. Then you have to know the order of preference of investment, because once adequate sufficient funds are there, then no need, just NPV is okay, we can undertake the project. But once funds are unlimited, means in such a case, you have to concentrate a lot on each and every rupee, and then you must adopt a discipline in investing these funds on more financially viable project. Okay. For this purpose, profitability index supports us to undertake capital rationing. Now, I will take you one more problem. Simple problem is, how do you calculate NPV and profitability index? Fact is this: when NPV is asked, what is the NPV? PV of cash inflow minus PV of cash outflow. Then profitability index, PV of cash inflow divided by PV of cash outflow. So that would be the reason they will ask you profitability index problem. So Navjeevan Limited is a problem which is from study material. Navjeevan Hospital is considering purchase of machine medical projections radiography, which is priced in 200 lakhs. The life of the machine is 8 years and salvage value would be 18,000. The annual operating cost would be 22,500 and expected sales revenue would be 1,20,000. And presently the machine hospital is giving outsourcing. For that, they are getting 36,000 rupees in the form of commission after net of taxes. It means that Navjeevan Hospital wants to buy a machine, but currently it don't have a machine, and whomever the client, they comes to them, right? And for the sake of testing, they are referring to other institutions. When they refer other institutions, and they will get what? Commission. Okay, commission they will get. Here the question arises here is, in such a thing means 1,20,000 revenue generating, 22,000 cost it incurring. In such a situation, is it really worthwhile to the company to make investment? For this purpose, what you have to do means, you have to evaluate basing on NPV and profitability index. Coming to the problem is very, very simple. In this problem, what you need, step one, what is your PV of cash outflow? You calculate. Cost of the machine is directly given. How much? 2 lakhs. 2 lakhs is given. Now you have to find it out. PV of operating cash inflow. Operating cash inflow, you supposed to find it out. Operating cash inflow, if you estimate sales revenue, you got it 1,20,000 less operating cost you deducted. So after revenue you deducted, you will get the PBDT less depreciation you can deduct. So you will find the PBT less tax PAT, add back to depreciation, you will get what? CFAT. But from this you have to deduct one of the commission, because because undertaking this project you are losing a commission worth of 75,000, mean 36,000 rupees, commission worth of 36,000 after tax treatment. So if it is a before tax, means it should be added to before. But if this is the commission, it's a company is losing because of undertaking this project. This is called a opportunity cost loss. So what I would like to convey to you is, this is an opportunity cost loss. Whenever you are undertaking a project, right? Undertaking a project, because of this project, you are generating an opportunity and getting a benefit, that is called opportunity cost benefit, that should be considered. Whenever loss is happening, that is called, what is that? Opportunity cost loss, that should be deducted while evaluating a project. Here opportunity cost loss, that too after tax, that is the reason we deducting it from after tax. Okay, thereafter we got the operating cash inflow. Then after adding this, we got the salvage value also, we added terminal cash inflow also considered. This is nothing but total cash inflows. Here the point is 1 to 7 years and 8th year they get, right? No, directly also you can find it out, right? So 1 to 7 years and 8th year separately they calculated. They brought the present 1 to 7 years cash inflow 1,90,178.08. and eighth year it would be 26 lakh 654.03. And if you sum it up both, after this, if you direct the cash outflow, you will get 16,832.06. So this is NPV, dear students. So this is the way in which NPV to be computed. Okay, right. And thereafter, important topic to be discussed is here it is. Here we calculated. Then you should understand one more topic is capital rationing. So capital rationing capital rationing means, you try to understand. Capital rationing means systematic allocation of limited funds on more financially viable project with an objective to achieve maximum NPV. So what is a capital rationing? It is a systematic allocation of limited funds on more financially viable projects with an objective to generate maximum NPV. So examination point of view, capital rationing also very important. So while doing a capital rationing, projects being classified into two types. One is a divisible project, another one is indivisible projects. The projects may be divisible, means proportionate investment could be possible. Such a projects are called, what is a divisible project? Uh, no surplus funds is possible in this. Why? Because whatever the amount left to you, okay, you can directly can make investment on such a project, is called a divisible project. For example, gold, silver, shares, all this comes under this category, right? Thereafter, indivisible projects. So indivisible projects are those projects proportionate investment is not possible on this project unless until you don't have adequate investment, right? So for example, building, land, machinery, vehicle, all these things comes under this category, right? Capital rationing is assumed to be projects are, what is it, divisible. Capital rationing assumed to be projects are divisible. Projects are indivisible. How the corporate companies they make. So now once again, what we discussed is, what is a capital rationing? Capital rationing is systematic allocation of limited funds on more financially viable project in order to generate maximum NPV. How many types of project? Divisible, indivisible. Divisible project example, gold, silver, right? Indivisible projects are building, land, machinery. So how this limited fund should be spent on divisible project? Very simple. When you are making capital rationing, assume it to be projects are divisible. In such a case, what you have to do is better to follow what is that order of preference of investment. That is, first estimate financial viability, whether the NPV positive or not. Check it. Make the investment as per the order, and how much amount you got it, right? How much amount left you at the end, you can proportionately invest on that project. So there is a linear relationship between NPV and outflow of the project. Okay, this is the divisible. Coming to indivisible project, in indivisible, identify the financial viability of the project. Next, make the investment in the form of, what is that, combination. So combination, best combination to be chosen out, but in that what happened, the investment should be adequate or sufficient. Okay, that is. And what are certain assumptions with respect to capital rationing is, it is assumed that the scarcity of funds happens only at the time of investment. It does not mean that entire life the project is going to run with what scarcity. A project, all the projects are mutually independent, not mutually exclusive. Next, either project may be accepted or rejected, but not postponed. And a project must have, well, projects are divisible. There is a linear relationship between inflows and outflows. Okay, these are the not inflows, not outflows, sorry, inflows and NPV. So proportionate investment, you make it on project, right? The same proportionate return you may generate from the project. This is the capital rationing, dear students. Here, projects are mutual independent. A project may be accepted or rejected, and there is a linear relationship. Then the next concept is internal rate of return. Internal rate of return. This is a wonderful topic. Internal rate of return. Internal rate of return. It is the maximum rate of return one can earn or one can generate the income from the project. Let us take, you are an investor and you want to make investment in the project. What do you think? If I make investment in this project, what would be the return I supposed to get it? What would be the maximum return I can generate? Can be learned with called, what is that, IRR. So here it indicates what maximum return I can earn by making investment in this project. What is the maximum rate of interest at which I can raise funds in order to make investment in this project? Comes under IRR. Okay, IRR is the maximum rate of return one can earn by making investment in this project. So IRR is the maximum discounting rate at which NPV equals to 0. See, this is the maximum rate of interest one can pay, or else you can say it is the maximum interest cost one can pay in order to undertake a project. Right. So estimate NPV at the given rate. NPV must be 0. You see, in order to estimate IRR, one of the strategy to be followed is at NPV at IRR, right? If you want to find it out IRR, take a discounting rate. Calculate NPV. Any discounting rate, if the NPV equal to 0, then it would be what is that? IRR only. So because IRR is the maximum interest rate at which NPV equals to 0. So while calculating IRR, you should understand the different types of pattern of cash inflow. Single cash inflow might be multiple cash inflow, mutually single cash inflow, multiple unequal cash inflow, multiple equal cash inflow, and multiple equal infinite cash inflow, which is called perpetuity. Any of the pattern of cash inflow you take, these students, one rule is keep it in mind that NPV should be positive. So take the cash inflows, take the cash outflow, calculate NPV, and use a discounting rate. If the at the given discounting rate NPV is positive, then not NPV positive, NPV 0, that is called IRR. How the corporate companies takes the decision on this? See, basing on NPV, decisions to be taken into consideration. Basing on NPV like that, basing on profitability, similar way, while taking IRR also we can take a decision. You see here, when project is single, calculate IRR. If IRR is greater than cost of capital, accept the project. When IRR is equal to cost of capital, either accept or reject. When IRR is less than cost of capital, reject the project. Coming to here, multiple projects, mutually independent, mutually exclusive. Mutually independent means accept all the project if IRR is greater than cost of capital. Mutually exclusive means accept the project which has highest IRR. Now, basing on this, right, we are going to solve a small problem. Let us check in this problem. Estimation of IRR. See, here in this problem, let us take, we are going to solve the problem number B here. Both are similar only. Let us take, or you can say both the project. See, a company proposes to install a machine whose cash outflow is 36 lakhs. The life of the machine is 5 years and its salvage value at the end of the life is nil. The machine will produce net operating income after depreciation is 68,000 per year. The tax rate is 45%. So present value factors are given, right? Now you see every year equal cash inflow. In such a situation, your investment is how much? 3,60,000. Every year cash inflows 68,000. It's not the cash inflow. They are saying that it is a net operating income after depreciation. Net operating income after depreciation means PBT. So now from the PBT you have to calculate CFAT. What the first job? First, this in order to calculate IRR in this model, what we have taken, net operating income before tax we take it, less tax we deducted, PBT we got it, add depreciation you got the cash inflow. And you know that IRR is a discounting rate at which NPV equals to 0. So NPV equal to cash outflow and every year cash inflow, present value annuity factor R percentage at which NPV equal to 0, right? By making separate of present value annuity factor, we find it out 3.29. By tracing of IRR, 3.29 lies between 15% and 16%. At 15%, factor value NPV is 6,490 positive. At 16%, it is a negative. Thus, IRR lies between what is it? 15% and 16%. Okay, now we can compute IRR. IRR taking interpolation formula L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. By taking interpolation formula, we calculate 15.74 is the IRR. So this is the formula. When IRR exactly comes 0 at the given rate, you can take granted the concern rate as a IRR. But the thing is, keep it in mind, when IRR lies between two guess rate, in such a situation, you have to, by using interpolation, you have to find it out IRR. What is the interpolation formula? Just now I told you, here it is, L1 plus NPV at L1 divided by NPV at L1 minus gets plus, right? NPV at L2 into L2 minus L1. So this is the way to find it out, dear students. And next concept is discounted payback period. So discounted payback period also important one. Here it is. What is the discounted payback period? Let us make. Discounted payback period is it's a payback period which is estimated from discounted cash inflow. So payback period we have, but the payback period could not consider time value of money, but discounted payback period considers time value of money. So here what you do is whatever the cash inflow you got it, you discount the cash inflow and basing on that cash inflow, you can estimate NPV. Sorry, you estimate payback period. First, in order to do the discounted payback period, step number one, discount the future cash inflow with the cost of capital and you will find the discounted cash flows. Basing on discounted cash inflows, you can find it out payback period. So, what is the difference between traditional payback period and discounted payback period? Traditional payback period ignores time value of money. Discounted payback period considers time value of money. Whenever problem is asked NPV, profitability index, no doubt at all, discounted payback period may also asked. Why? Because all these three methods are used discounted cash inflow. By summing up of total operating cash inflow, making minus cash outflow, you will find NPV. By summing up of total cash inflow divided by cash outflow, you will find a profitability index. By taking cash inflows with support, analyzing what is the investment you made it, you will find what is a discounted payback period. Okay. How do you take a decision? Single project. Discounted payback period is less than standard payback period. Accept the project. When discounted payback period is more than standard payback period, reject the project. When discounted payback period equal to standard payback period, either accept or reject the project. Coming to multiple project, mutually independent, mutually exclusive. So accept all the project if discounted payback period is less than standard payback period. Accept the project which has least payback period. So mutually exclusive means you can accept the project which has least payback period. So this is the another concept with respect to discounted payback period. So dear students, since I discussed with all the topics with you in this problem, well, we know that the time limitation is very less, right? So timing is very low, we can say, but that is the reason we discussed all the concept with respect to capital budgeting. You remember I discussed with whenever you will make a huge investment, right? Either any of the project you take, the investment always be taken into the considering capital budgeting methods. We gone with the methods, we gone with the payback period, we gone with the discounted payback period, NPV, profitability index, discounted payback period. I explained the problem with respect to NPV and payback period I got discussed, and another one is capital rationing, also very important topic I discussed with you, and profitability index and NPV and IRR. All this concept, keep it in mind and work it out well, right? So certainly you will get the good judgment. These are the points I would like to say with you once again. I have to convey these points also. I gave some important points, very important points, key points I gave. Okay, profitability index, and why I took one problem as a very essential one, because these many points covers in this problem, right? So this is with respect to investment decision. Thank you. Hi dear students, just now successfully we completed investment decision. So now I'm going to take one more chapter called dividend decision. Well, dividend decision. Dear students, financial management is a subject of decision making. There are three major decisions are very vital. Number one, investment decision. Number two, financing decision. Number three, dividend decision. So the company has to raise the required funds from various sources at a least cost, could be dealt with what financing decision. Whatever the funds you raised funds, the company has to systematically make investment on various fixed assets and various current assets, right? That is comes under the investment decision. In the investment decision, we have how to make investment on fixed assets. We used to discuss with the capital budgeting. How to make investment on current assets, we used to discuss in working capital management. And another one is dividend decision. Dividend decision. What is a dividend decision? You see here, I submitted some information. So just now I told you financing decision, dividend decision. See, dividend decision means whatever the profit the company made, right? whether this profit, whether the profit the company made, is it worthable to declare dividend is a good thing to the company or else retaining. See, dear students, for when you raise a capital for equity share from equity shareholders, from debenture holders, right? For both people have certain coupon rate to be paid. Okay, for debenture holders, we used to pay, it's a commitment to be paid, it's a fixed rate is there. For debenture holders, coupon rate is there. For preference shareholders, is coupon rate is there. But what about the equity shareholders? It not. There is no any type of coupon rate. But the thing is, regarding equity shareholders, there is no commitment to pay, no coupon rate, no commitment to pay. But the thing is, dividend decision speaks that what to do with the profit, earned profit. Well, so is it good to the company to make dividend or retaining? Is it good? So whether the profit available should be given to the shareholders or retained, what we called as dividend decision. Okay, dividend decision. Now coming to dividend decision, if you observe it, the theories of dividend decision. There are two types of theories. Argues that some theories argues that dividend decisions are relevant. Some theories argues that dividend decisions is irrelevant. First of all, you should understand what is a relevance theory, what is a irrelevance theory means. The point is, certain theories argues that dividend decision of the company is very essential. It's because the dividend decision of the company, either you declare a dividend, not to declare a dividend, this decision certainly influences market value of the share. Such decisions are called relevance theories. Irrelevance theories argues that the dividend decision of the company may be irrelevant. Irrelevant, it indicates either you make dividend, not to pay dividend, it does not influence the market value, because market value of the company is depends upon effective, productive investment decision of the company. How effectively you are going to take investment, that is the matter, right? How, whether you pay dividend, not to pay, it does not make. So that is the dividend decision. Relevance theories, irrelevance theories, right? Relevance theories, how many theories? Relevance theories, Walter, Gordon, Linter, Graham Dodd. Four theories comes under this category. Whereas in irrelevant theories, you will find the Modigliani Miller as well as residual theories. Okay. Now coming to, before going to this relevant theories, you better to understand some basic concept. Dividend per share. How do you calculate? Total equity dividend divided by number of equity shares. Dividend rate, dividend per share divided by face value of the share. Dividend yield, dividend per share divided by market price. Payout ratio, dividend to payout ratio actually. So dividend per share divided by earning per share. Retention ratio, retaining profit divided by EPS or earnings, or else 1 minus dividend payout ratio is nothing but retaining ratio. So, and another one is a growth rate. Whatever the retaining profit you made it, you may invest in outside. So that is called retaining ratio. So finally, what I would like to say to students, before going to this dividend decisions, it's better to learn all these things concept, right? Once 1 minute. What are the major decisions of financial management? Three: financing decision, investment decision, dividend decision. What is a dividend decision? It is a decision with respect to what to do with the earned profit, whether dividend to be given or returned. Okay. And how many dividend models are there? Two types. What are they? Relevant model, irrelevant model. What do you mean by relevant model? Relevant model argues that dividend decision of the company certainly influence the market value of the share as well as company. Irrelevant model, dividend decision does not influence the market value of share, because that is an independent factor. Okay, that depends upon investment, right? Not the dividend decision. Okay, that is. Let us come to first one, Walter model. Walter model is a very, very important model, examination point of view, right? What this Walter model argues that value of the company depends upon, what is that? Value of the company depends upon dividend decision of the company. Dividend decision of the company. So this decision, it argues that, right, a company able to increase its market value or influence its market value by implementing what is that? By implementing effective dividend decision. So what this argument indicates, what this argument indicates, you see, Walter argues that if a company makes a profit, okay, if a company makes a profit, the company has a two choices. Choice number one, either to declare a dividend or else retain it. Okay, either declare it or retain it. So here it is. Now here it, if a company makes a profit, it has a two alternative, either to declare or retain it. Right? Thing is, if the company declares a dividend, what to do? What happens actually? What, not what to do? What happens? The equity shareholders, who is the person who have a choice to, what is it? This entire profit goes to in the hands of equity shareholders. Then equity shareholder get the choice to make an investment. The whatever the amount he hold, right? Whatever the amount he may get because of dividend decision, by investing this amount, he may generate the return. That return is called invest KE or investor expected rate. So investor expected rate or yield rate or KE. This is the return generated by the equity shareholders when company declares a dividend. If that rate is, let us take 10%. Number two, if the company retains, what company do? Company could not keep this funds idly with it, right? It will make investment and it invest somewhere else. So now try to understand. If company retains funds, company reinvests, right? In such a case, it generates the return that is called IRR, or return on investment, which is also called R. If company declares, equity shareholders get a chance to make investment. So that is called, what is that? KE. Now try to understand, if RKE you have, right? RKE you have. If R is greater than KE, it means that by retaining funds of equity shareholders, company able to generate more return. In such a situation, is it essential to give dividend to him? Tell me, is it essential to give a dividend? No, because company able to generate more return in such a case while retaining 100%. It means that by paying 0% dividend payout ratio, company can increase its market value. That is the point you have to understand. When R is greater than KE, it is a better to declare 0% dividend payout ratio, then company market value will increase. When KE is greater than R, in such a case, what happened? The investor of the company is a wonderful, worthwhile comparing to you. In such a case, it is a better to declare 100% dividend payout ratio. Okay? In such a case, market value will increase. For this purpose, you have to understand given things. First of all, how do you calculate EPS? Number one, earning availability equity shareholders divided by earning availability equity shareholders divided by number of equity shares. That would be EPS. So EPS market value is nothing but, according to this theory, market value is the present value of future benefit discounted at investor expected rate of return. Some of the concept you must be very clear. One is EPS. How do you find EPS? Earning availability equity shareholders divided by KE. So DPR, dividend to payout ratio, 40%, retaining ratio, 60%. KE is nothing but investor expected rate or yield rate, R equal to IRR. These are the certain points you should understand. Okay, right. According to this theory, if KE is R is greater than IRR, or R, then it is better to declare 100% dividend payout ratio or 0% retaining ratio to increase the market value of the company. If K is less than R, then it is better to declare a 0% dividend to increase the market value of equity. If R and KE both are same, in such a case, dividend decision does not influence, right? For this purpose, you have to understand the formula. What is the formula here? D plus D plus E minus D into R divided by KE whole divided by KE, where P represents market price, E represents earning per share, D represents dividend per share, KE cost of equity, rate of capitalization, discount rate. They may use a different rates. Keep it in mind. R indicates internal rate of return or return on investment. Okay, this is the problem. Basing on this, we done a problem. I'm going to show you one problem. We are going to solve the problem, right? The problem is here. It is the following is the information. I think is it the problem? I get it. 75 lakhs. No. Here it is. See, the following is information. This is the Walter model. The following figures given have been collected from the annual report of ABC Limited for the current financial year. Net profit 75 lakhs. Outstanding 12% preference shares. Preference shares are there. So number of equity shares 7.5. Return on investment is 20%. Cost of capital is 16%. Now tell me, dear students, by observing this problem, you can within second we can come to conclusion that, right? Conclusion that R is greater than K. So whatever the company able to generate, that is R here, which is given R, is at 20%. If you declare a dividend, the equity shareholders may invest outside and he may generate just 16%. In such a case, what is a better? Company has, in order to increase the market value of the company has to follow 0% dividend payout ratio. But if company gives more dividend, then automatically market value of firm decreases. Okay, let's for that purpose compute approximate dividend payout ratio to keep the share price 42 they're given, and determine optimum dividend payout ratio, and prove that the dividend to payout ratio determines above optimum using random payout ratio 25, 50, 75, 100. This is the point they're given. Okay, it means that if the company follows, what happens? If the company follows dividend payout ratio is randomly 25%, 50%, 75%, 100%, what is the implications? These students try to understand the beauty of this one is when R is greater than KE, you should not declare a dividend. The whatever the dividend payments are given here, this is not an optimum dividend payout ratio. The optimum is 0%. Why? Because company is excellent in this field. Company can do the miracles. In such a case, giving dividend is not at all right thing. Okay. Now you try to understand. First of all, in order to calculate market value of firm, just now I told you market value of firm formula D plus E minus D into R divided by KE whole divided by KE. Okay. Now the point is net profit is 75 lakhs. From that, if you have to deduct what is that? Preference dividend. If you deduct preference dividend, you will get the earnings for equity shareholders 45. So divided by number of equity shares, you will get the 6 rupees. So market price equal to D plus E minus D into R divided by KE. What the first part is asked, if the market price want to be 42, in such a case, what would be the dividend payout ratio? Dividend payout ratio formula, dividend divided by EPS or EPS. Okay. Now in such a situation, right, market price equal to, first of all, you have to find it out dividend basing on given market price of 42 rupees. So 42 rupees given dividend divided by 0.20 divided by 16%. D E 6 rupees minus D. By resolving this dividend, you got the 3.16, whereas EPS, you know that 6. So 3.12 divided by 6, you will get the dividend to payout ratio. It means that if the company can make a dividend payout ratio worth of 52%, in such a case, the market price would be 42. Next, here, second question, what they asked is, determine optimum dividend payout ratio and the price of the share at that price. See, what is the optimum dividend payout ratio? Currently, R is greater than KE. The company has to follow 0% dividend payout ratio. It should not give any dividend to the equity shareholders. Reason is very simple. R is greater than KE. When company is better than investor, why you give dividend, man? Why you give? Why do you give actually? That is the reason optimum dividend payout ratio would be 0% dividend payout ratio. If you have any doubt, let's prove the problem at the optimum dividend payout ratio. D equal to 0 declare kar diya. R divided by KE minus D. In such a case, it would be 46. 46.88 when you declare it 0%, right? Whereas if the company by chance follows 25%, see what I told you, if you follow 0%, you can make market price approximately 46. If you follow 25, automatically market price decreases. 50 again decreases, 75 again decreases, 100 drastically decreases. Is it really, sir? Let's prove. As per Walter, if company follows 25% dividend payout ratio, in such a case, 1 minus 1.5, 20 divided by 16, 6 minus 1.5, then it got the 44.531. Whereas 50%, it would be 42.188. Whereas 75%, it would be 39.844. Whereas 100% dividend payout ratio, it would be 37. So this is the Walter argument theory, right? Walter theory is a wonderful theory. This theory argues that whether company declare a dividend or not to declare a dividend is depends upon R and KE. If R is greater than KE, by following 0% dividend payout ratio, company can increase its market value. When R is KE is greater than R, by following 100% dividend payout ratio, company can increase its market value. So the next theory we are going to discuss in next class. Thank you. Yes, hello, good morning, dear students. Yesterday we started working capital and we completed successfully working capital estimation. Now from this chapter, important areas, right? I prepared an exclusive material for you. And with the support of this material, I will explain few problems. And these problems are very, very important for the examination point of view. Okay, let's first understand operating cycle. It is another topic. Apart from working capital estimation, one of the area where we must give a priority is nothing but an operating cycle. What is the operating cycle? How it is to be estimated? Operating cycle period, it is the time period in which raw materials are converted into cash. So every company, when it takes raw material, it will convert into cash. In order to convert into cash, right, it need to spend a lot of time. It could not happen. So it's not a chutki pay. It's not a Feviquick ad seems to be. Once you buy the raw material, it takes a time to conversion of work in progress, finished goods, debtors. By by passing all the stages, then only company able to generate cash. Thus, operating cycle also called cash cycle. Why? Because once this cycle gets completed, it can able to generate cash cycle. Operating cycle is a combination of various holding periods. What are the various holding periods? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period. In order to compute the operating cycle period, right, one must estimate various holding periods. Before going to calculation of how operating cycle period estimation takes place, being a student, you should be able to find it out various individual holding period. Let us take estimation of operating cycle period. The formula is this. Net operating cycle period equal to raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditor payment period. Okay, this is the point. Now, in order to estimate this holding period, you have to understand how to calculate raw material holding period. Raw material holding period formula could be this: average stock of raw material divided by raw material consumed during the year into 365. Okay, average stock. Average stock equal to opening stock plus closing stock divided by 2 is the average stock. So if you do like this, you will get the raw material holding period. Thereafter, work in progress holding period. Average stock of work in progress divided by cost of production into 365. This is work in progress holding period. Thereafter, average cost of production. You know that opening stock plus purchases minus closing stock. So this is nothing but raw material consumption, direct wages, direct expenses. If you add it, you will get the gross work cost. Opening stock of work in progress less closing stock of work in progress, you will get cost of production. Right? Average stock here, finished goods holding period. Average stock of finished good divided by cost of goods sold into 365. Thereafter, debtors. Average debtors divided by credit sales into 365. Thereafter, creditor payment period. Average creditors divided by credit purchases into 365. Then number of cash cycles how to be calculated. Number of cash cycles equal to 365 divided by net operating cycle period. So whatever the holding periods you considered and you computed number of cash cycles. Okay. So number of cash cycles. This is number of cash cycles. Number of cash cycles, how do you get it? 365 divided by net operating cycle period. Thereafter, how do you calculate working capital? Working capital is nothing but total cost divided by number of cash cycles. If you take it cash cycle per cycle working capital, you will get it. Very simple. The working capital, what you are computing is working capital per cycle. So these are the certain important formulas should be needed in order to solve the problem. Once again, check these formulas and understand the cost. Operating cycle is a time period in which raw materials are converted into cash. Thus, it is also called cash cycle. Now, with the support of this explanation, we are going to solve a problem here. Problem number 3 I'm going to take here is it. The following information forecasted by R Limited for the year ended 31st March 2021. So raw material 60 opening is given, dear students. Opening 31st March 2021, 31st 2000. This is the 65, 45 opening and closing divided by 2. You will get the average stock. Work in progress 51, 35. Finished goods 70, 60. Debtors 135, 112. Creditors 71, 68. Okay, annual purchase of raw material 400, annual cost of production 450, annual cost of goods sold 525, annual operating cost 325, annual sales 585, right? These are the details they given. So you may take 1 year as equal to 365, right? You have to find it out. What is that? Net operating cycle period, number of operating cycles in the year, amount of working capital required, and a company is a market leader. Market leader means no other companies is going to handle the same business what our business is doing. Like IRCT is the market leader, Pedialyte is the market leader because there is no other companies in the market simply. So market leader means it's a in the market it is the only leading company. Of course, you may say there's a monopoly also. Okay, and it has no competitors. No competitor means no doubt at all monopoly itself. Based on a market survey, it's a planning to discontinue sales on what basis? Credit basis, and delivery of the product based on the prepayment to reduce the working capital requirement. They don't want to continue credit. In such a situation, what would be the impact? You are required to compute the reduction in working capital requirement such a scenario. This is the problem. If the company, since it is a market leader, if it discontinues credit period to be offered to the client, in such a case, how much of working capital it's supposed to save? That we have to find it out. Okay, let's move to the problem. Here, the problem is this. Okay, our raw material holding period. How do you calculate average stock of raw material divided by average stock of raw material divided by 12 months? Not 360. Average stock of raw material divided by raw material consumed during the year into 365. Raw material consumed, opening stock plus purchases minus closing stock. So here, by taking the concern values there, if you estimate like this, 45 lakhs, 400 lakhs, 65, 380 lakhs, you got it. Work in progress. Work in progress holding period. Average stock of work in progress divided by cost of production. Average stock divided by cost of production. You got the 35. Next, finished goods holding period. Average stock of finished good divided by cost of goods sold. Average stock 60, 70 divided by 2. Cost of goods sold which is given 525. So 45 days. Debtors collection period. Average debtors divided by credit sales into 365. Creditor payment period. Average creditors divided by credit purchases into 365. Whereas the net operating cycle period. Net operating cycle period equal to, just now I told you the formula: raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period. 53, 35, 45, 77 minus 63, you will get 147. What this 147 it indicates? Company spends how many? 143 days to convert the raw material into cash. So it takes a time to convert the raw material into cash over the period, for the period of how much? This is okay. Raw material into cash, in order to convert this one, it's spending 147 days. So it means that 147 company need to convert the raw material into cash. That would be the reason the company also required to maintain working capital for 147 days. Okay, that's now what are the number of cycles in a year? Number of cycles in a year equal to 365 divided by net operating cycle period. So 365 divided by 147, you get what? You will get number of operating cycles. So amount of working capital required. Amount of working capital is nothing but cash cost divided by number of cash cycles. So 325 is the total cost. 25 is the depreciation. Well, we know that depreciation is a non-cash expenses. What you have to do is from 325 minus 25, you will get the 2.5. That is nothing but in total, what is that? 120 lakhs. So this is the problem, dear students. Next, reduction in working capital. Present investment in working capital is 120 lakhs. So less revised investment in working capital is nothing but 300 lakhs already we are spending now. 300 divided by 360 into 70. You will get the 57.5. So reduction in working capital 52.50. Okay, because 147 minus 77 days, if you deduct it, you are going to estimate what is that 47 days, 40 days, sorry 70 days, 70 days reduced one. That reduced one you are going to estimate. If you estimate, it would be 57.5. If you deduct it, you will get 62.50. So this is operating cycle way. So operating cycle is a very important topic in examinations. You can get, there is a lot of chances to expect this question from public exam. Right. The next concept I am going to take is debtors management. What is that? Debtors management. See, debtors management also very important in working capital management chapter. In debtors management, what we do is we will evaluate whether it is a good to company to provide credit period or not, whether it is a good for the company to offer cash discount or not. Or in this concept, we are going to learn what is a debtors, what is management actually debtors means. So how a company has to evaluate this debtors management. Okay, dear students, let's move to what is a debtors. Debtors means whenever in order to make a credit sales, when you make a credit sales, debtor firms or debtors needs. So debtor is not a credit sales. Debtor is nothing but it's an amount required in order to provide credit period to the client. So I have a 1 lakh rupee. If I have a 1 lakh rupee, with this 1 lakh rupee, I can offer credit to my client 30 days. It means that even my client won't pay money within the 30 days. No problem. I can run my business because I have this money. So the same point can be understood like this. How much money I need to get blocked, right? My money gets blocked if I offer 30 days credit to my client. So that is the debtors. So company makes a credit sales, debtor firms. What is the debtors management? Debtors management, it is the systematic management of book debts. Management means what? Balancing. If the company don't have any credit sales so far, in order to make more credit sales in future, the company what to do? A company has to increase credit period and offer more credit to client and has to make more sales. When company makes more, when company offers more credit period, what happens? Company gets an advantage, right? So management debtors means if debtors are low, you have to increase. Debtors are huge, you have to decrease. That is the debtors management. Here debtor debtors management includes increasing book debts, decreasing book debts. How you increase the book debts? By offering credit period, you can, by offering credit period or extending credit period, you can increase book debts. By offering cash discount, by reducing credit period, you can decrease the book debts. But being a financial manager, what you have to do? When you offer book debts, what is the benefit you supposed to get? What is the cost you supposed to incur? From benefit cost, you have to consider, you have to take net benefit. If net benefit is positive, offer. If net benefit is negative, reject. Similar to offering cash discount, also similar to this. Benefits, cost. So net benefit when offer, reject. Benefit when company offers cash discount, what is the benefit? What is the cost? From benefit minus cost, if you direct net benefit, basing on that, you can take decision, right? In order to evaluate the policy of this, you have to understand its format very wonderful effective way. This format is given in our study material, even our mastermind material also this format is there. This approach is evaluated on total basis because 30 days total we used to calculate the profit, and at the 50 days also we will identify not profit net benefit, we will compare both. In order to estimate this benefit, what you have to do? First of all, you have to estimate expected profit. Because if I offer credit period, even if I extend the credit period, what happens? Here I have taken two columns. Present column, I assume that present 30 days company offering. Okay. In future, by chance, company wants to extend the 30 days. In such a case, 30 plus 30, it will become what is it? 60 days. In 60 days, what would be the impact on company? So whether it would be good for the company to extend this credit period from 30 days to 60 days is a benefit or not. That is my job to find it out here. In front of you with this format support, first I will explain the format, then with the support of formal problem and solution, I am going to explain, right? Let's, first of all, what you do is, what happens to company's profit if company offers 30 days and extends to 60 days? Let us take. First, the company makes a sales. From the sales, generally you have to deduct the variable cost because it's a direct cost. From the sales, if you deduct your variable cost, you will get contribution less fixed cost you have to deduct. Then you will get the collection cost, additional cost might be, administration cost, might be cash discount, might be any other supervisor charges, all these things. Sometimes it may be bad debts also, collection cost, and you may add it a less bad debts. Bad debts also is there, right? So after deducting everything, you will get the profit before tax. From that, you have to deduct your tax. Then you will get the PAT. So this is the profit after tax the company able to generate at 30 days and 60 days. That you have to find it out. Thereafter, what you have to do is you have to calculate opportunity cost. Opportunity cost here, what it speaks that you are offered 30 days credit to client. Okay. So 30 days amount, what you spent on this product is getting blocked. If you might have got this amount immediately from your client, right? You might have invested these funds outside and you might have got the wonderful benefit, right? Because of offering this 30 days credit period or 60 days credit period, the opportunity what you might have create, that is going to be, what is that, uh, dismissed or disappear, gets disappear. There you also you are losing an opportunity cost loss, so this project looks attractive only when it recovers your opportunity cost also. That is the reason, even after calculating profit after tax, what we do is we will deduct that opportunity cost also, right? Then how the corporate companies, they used to estimate this opportunity cost. This opportunity cost can be estimated basing on credit sales, basing on total cost incurred. Basing on credit sales, instead of the total cost what I wrote there, you can take credit sales also, no problem. But before going to evaluate this one, you try to check the problem whether is there any specific direction given to you in estimation of debtors or not. If nothing is mentioned, ball is your court. You can take the any of the method and you can evaluate it. Are you getting right? Coming to how to net benefits to be estimated, total cost divided by 12 into debtors collection period into opportunity, then you will get the net benefit A minus B. Okay. So if the net benefit is incremental from comparing to here, it's the benefit, then this 30 days credit period be extended. So this is the procedure to be followed while evaluating credit period, right? In order to support my explanation, my format here, I will take a problem and I will explain. This problem I have taken from the new study material. This is the problem. New study material problem. Mosaic Limited, very, very important. RTP, MTP also this problem covered, and I am going to explain this, right? Let us. Mosaic Limited has a current sales of 15 lakhs per year. Cost of sales is 75%, and bad debts are 1% of the sales. Cost of sales comprises 80% variable cost, 20% of fixed cost. Try to understand. Mosaic Limited 15 lakhs of sales is there. Out of this, 75% is cost of sales. Multiply, if you multiply 15 lakhs into 75%, you will get what? Cost of sales. Okay. And bad debts are 1% of the sales. Cost of sales comprises 80% of variable cost and 20% of fixed cost. It means that 15 lakhs into 75%, if you multiply, you will get the cost of sales. From that cost of sales, 80% would be the variable cost, 20% would be the fixed cost. Keep it in mind, fixed cost will remain same irrespective of whether your sales increases or decreases. While the company's required rate of return is 12%. Mosaic Limited currently allows the customer 30 days credit, but it is considering increasing this to 60 days credit to credit sales. It has been estimated that this change in policy increases sales by 15% because you are offering credit period to client. Because of offering this credit period to client, company able to generate, what is that? The net benefit. It is able to generate net sales, not net benefit, sales by 15%. Bad debts will increase from 1%. Previously 1%. This 1% will become how much percentage? 4%. It is not expected that the policy change will result in increase in fixed cost. But because of this, fixed cost will remain constant. Fixed cost is not going to increase. Okay. Should the Mosaic Limited introduce the proposed policy? Now. So this is the question. Okay. Now try to understand what is the Mosaic Limited problem. Mosaic Limited company is offering currently 30 days. Okay. Now it has a proposal to provide additional 30 days, means to 60 days. 260 days means by 30 days actually. So 30 days, 60 days you take it. Just now I explained the format in the same procedure. You have to identify what is the current sales, 15 lakhs. What is the future sales? It is going to increase by 15%. Then evaluate 15 lakhs into 115%, you will get the sales. From that purpose, you try to understand variable cost. Whatever the sales into 75% into 80% would be the, what is that? Variable cost. But fixed cost presently, how much you used to calculate, that fixed cost will remain constant. Examiner expects that you do mistakes. Don't do like that. Okay. Now what you do? You see sales. How much it is the sales? You see evaluation of credit policy of Mosaic Limited. Benefit. First A, you have to take sales. Okay, sales. Here sales 15 lakhs, but whereas sales is going to increase 115%, less variable cost, less fixed cost. Next, bad debts. You will get the after deducting bad debts, but fixed cost will remain same. Either sales may increase, sales may decrease, but fixed cost will remain same. By deducting sales minus variable cost, fixed cost, bad debts, you will get the profit before tax. From this is the profit before tax. Since there is no tax in the problem, then you have to calculate opportunity cost. Opportunity cost can be estimated on total cost, on variable cost. You can take out total cost divided by 12 months into debtors collection period. By considering this, you will get the opportunity cost 11 lakh 11,250, here 25,200. From this benefit, right? From this, if you deduct it, okay, from this profit, if you deduct your cost, you will get the net benefit worth of 3 lakh 48,750. Here, 3 lakhs, here 3 lakhs 70,800. So net benefit comparing to here, the company able to increase net benefit by 22,050. Since incremental benefit is positive, so 22,050. So it is advisable to the company to extend credit period. Extend the credit period from 30 days to 60 days. So this is the procedure, dear student, to be followed. Okay. So with this, we completed three areas. Number one, working capital estimation. Number two, operating cycle. Number three, debtors management. Next, in debtors management, one of the important point is, what is that? Factoring. Okay. One of the important point is factoring. Okay. Factoring. Factoring is, what is that? An innovative financial service. Innovative financial service. Factoring is an innovative financial service. So whenever company makes a credit sales, in order to collect this money effectively, it uses factoring. So here, why the reason for taking the factoring is, so reason for nothing but effective collection of book debts, effective collection of book debts, and number two is the financial as a source of finance, source of finance. See, factoring is, you try to understand the factoring mechanism, how it takes place. This is the procedure. Okay, here there is a company. This company made a credit sales to various parties. The different parties, company made a credit sales. Now the company has a problem with respect to how to collect this entire money from various parties. In such a situation, the company takes factoring agreement. So factoring agreement it takes. Factoring agreement with another person called factor. A factor may be person, a factor may be company, a factor may be institute, a factor may be business. Okay, it takes agreement with the factor. And this factor, because of this, factor goes to the various clients and collect the money and handovers to the company, and for this purpose he will charge factoring fees. Will charge factoring fees. So you won't do it. So for effective collection of book debts, company takes the factoring agreement, because once you make a credit sales, you cannot concentrate always with whom, always with the credit debtors whom you made a credit sale, because you normally busy with your business transaction. For that purpose, what you have to do is, here you can take the factoring, or else when you made a credit sales, sometimes whatever the credit sales you made it, you can take that receivables, you go to the factor and you can take an advance. In such a situation also, the company has a two problems. Problem number one is, will it good for me to take, what is that? This person may have a dilemma that, will it good for me to take the factoring agreement? He is a factor, right? He is a factor, and he may think that, will it good for me to take the factoring service for effective collection of book debts, or I need a finance, I made a credit sales, I have a receivables, this receivables I can mortgage from outside, I can take the loan, or with the support of this I may take the loan from other sources. But what happens if I knock the doors of factor? Could I able to generate the funds at a least cost comparing to other sources? This is also one of the dilemma of the company. Being a CA student, you should able to find it out this both. Then you have to analyze, will it be good for you or not? Okay, so in the factoring, you have two things we have to learn. That is a evaluation of factoring service to know whether it is a worthwhile or not. That is, in this CA inter books, we have first one, evaluation of factoring service, and another one is effective cost of factoring. Effective cost of factoring. Evaluation of factoring. What you do is, in the sake of evaluation of factoring, this is the format you try to understand. Evaluation of factoring. First, evaluation of factoring. What you take? What are the various benefits? You have to find it out. Number one, savings of bad debts. Savings of bad debts would be one of the advantage. B, savings of collection cost, one of the advantage. If the factor able to collect the money and early it we used to give, then savings of opportunity cost. These are the certain benefits. You total it, and you know that sometimes you have to make certain payments also for factor, because he won't do the free service. That is a B. C, B, you take a cost. Cost number one. What is the cost you can take? Cost is nothing but you will can financial charge. Financial charge. That is a financial charge or interest. Okay, sometimes if the factor is not able to provide the money within the given time period, then we used to lose an opportunity cost. Or sometimes if you take a loan, then for the loan you have to pay interest. Okay, because of factor, if the company not able to collect the money within the promised due date, or if the company reduces sales because of the word given by the factor as a negative manner, not positive manner. So company wants to make a sales, but factor provides you such a information, because of that information you are not able to make a sales. In such a case, you have to lose an opportunity cost loss also. Opportunity cost. What do you do? This add these three things, if it is a possible. Problem is given in opportunity cost. So now from this benefit, you deduct all these things. If your net benefit is positive, accept. Otherwise, what is that? Reject. So B given. Now C, net benefit, you find it out. If net benefit is positive, you can accept. Otherwise, reject. So this is the evaluation of factoring service, benefit and cost and net benefit. Okay. Right. Now, with support of this, we are going to solve the problem. Here, the problem is there. Here you see a factoring company, a factoring firm has a credit sales of 360 lakhs. and average collection period is 30 days. The financial control estimates that bad debt losses are around 2% of credit sales. The firm spends 1,40,000 annually on debtors administration. Okay. The cost comprises telephonic and fax bills and along with salaries of staff members. These are avoidable costs. A factoring firm has offered to buy the firm's receivables. The factor will charge 1% commission and will pay an advance against the receivables on interest of 15% per annum after withholding 10% of reserves. What should the company do? This is the problem. This problem is extracted from study material. I personally believe these are the certain areas before going to public exam you have to remind. Okay. And one thing is, other than these areas, it's okay. Okay, means your regular preparation will support you, but you have to make eye on these topics. Next, here the company makes a credit sales of 3 lakhs. Average collection period 30 days. Okay, now 30 days. The financial control estimate bad debt losses is 2%. If you take the factoring, you are going to save the money. And the firm spends 1,40,000 annually on debtors administration. And the cost comprises telephone, fax bills along with the salaries. These are avoidable. Factoring firm has to buy the receivables worth of 1% commission and pay advance against receivables with an interest of 15%, withholding 10% as a result. What shall company do? Right here, what do you say this? Evaluation of factoring. What we have to do? Savings of bad debts. Because of factoring, you are going to save the bad debts. And what is this? And the savings of administration cost. Okay, if you add the both, you will get the 8,60,000. You are going to get the benefit. And annual commission from the receivables, you are going to get it 1%. So 360 lakhs into 1%, that is a 3,60,000. And for advances, you have to find it out. This one is advances. Your debtors already you estimated. Advance he provides only from receivables. First of all, you have to calculate receivables. Credit sales divided by 12 months or 360 into debtors collection period. 360 divided by 360 into 30 lakhs less margin you have to deduct 10%. 27 lakhs you got it, and he will deduct the commission also on this. Commission would be 30 lakhs into 1% means 30,000. So total 27 lakhs 70,000 you used to get it. So interest on that is nothing but 26 lakhs 70,000 into 15%, that is a 4 lakh 5,000. So after deducting interest and commission you used to get the net benefit worth of how much? 7 lakh 60,000 total. And if you deduct the net benefit 99,500. So with effect you are worthable to take what is that factoring service, because of this factoring service uh, company able to make what is it more sales, because you are offering credit period two factor and you are offering service factor service, and because by implementing that one you are collecting money means you are getting money, right? So that is the reason, dear students, the evaluation of factoring, right? Are you getting? And here I will give you certain formulas. Sometimes in order to estimate, this is the evaluation. Sometimes if you want to calculate what would be the effective cost of factoring. What is that? Effective cost of factoring. Effective cost of factoring. Sometimes you used to find it out the cost of factoring. Effective cost of factoring means it is the effective cost of, it is the equivalent annual rate of interest, interest or annual rate of cost if the company takes factoring service. Company takes factoring service. So effective cost of factoring equal to effective cost of factoring equal to interest per annum you take plus commission per annum minus benefit per annum divided by net amount realized. net amount realized. With the support also you can calculate what is that effective cost of factoring. Okay. Thereafter, dear students, you have to put an attention on what is that maximum permissible bank finance, or you say cash budget. You try to understand, I cannot solve all the problems because time is very, very limited. Cash budget. Uh, Cash budget is a systematic estimation of availability of cash in the given time period. So cash is a highly liquid come emergency asset. All the problems of the company directly, indirectly links with what cash budget. If the company able to provide the cash budget, it can predict that how much of cash the company is supposed to hold in its pocket in concerned future. Because dear students, try to understand any company, either if it is facing the financial problem means certainly either they might have spent more than received, or certainly they might have paid, or they may fail to recover the money. So once, if you want to run a business over the period, it is very, very essential to prepare a cash budget. It is one of the prediction. So generally in CA Inter, we used to find it out the cash budget on receipt and payments model. In order to prepare cash budget, you try to understand how many months you have to take into consideration. That is the important point. Here, let us take how the estimation of cash budget. So let me take a January, February, March, maybe 3 months. What you do is, you have to identify first of all what is any opening cash balance. Is there any opening cash balance? If the company is existing, then it will have the opening cash balance. Then you have to identify receipts. So receipts, you have to calculate all the receipts, come cash sales, collection from debtors, sale of machine, loan, and any other receipts you received, all the receipts you take into the consideration and make the total of all the receipts. So you take the total receipts. From the total receipt, it is your due responsibility to identify payments. You have to consider the payments. Okay, payments. Once you make a payments, various types of payments the company has to pay because of salaries, wages, bonus, whatever the expenses it has to pay, and it has to make the payments to the suppliers. It has to do the payments to the creditors, payment of loan, purchase of machines, all these things comes to the payments. If the all these payments, whatever the payments are given in the problem, you have to make all the payments to them, right? From that payments, if you sum it up, what is that? From receipt, okay? From the receipts. What you do here is you have to understand opening cash balance you have. So now you can find it out the closing balance. Closing balance equal to A plus B minus C. Add opening cash balance, payments minus closing balance. You will get opening plus not closing balance. Opening plus receipt minus close minus payments. You will get the closing balance. This closing balance tells to opening balance to next year. Okay, this is the procedure. You have to understand the cash budget. While preparing cash budget, from this opening plus receipt, you will find what is that closing balance. Again, this closing balance would be opening for the next month. Opening plus receipts minus closing balance, you will find what is that final figure. Opening plus receipt minus payments, you will get the closing balance. So this is the one of the concept cash budget. Please verify the cash budget. While preparing cash budget, keep it in mind. Don't consider non-cash expenses like depreciation, preliminary expenses. Don't consider, or any expenses is going to come is going to be realized beyond the cash budget period. Don't need to consider, because if you are asked to prepare cash budget for the sake of January, February, March, but the company makes a sales at February, but the client gives a 2 months credit period, means from February to March, 1 month, March to April, it is going to recollect after May. In such a case, no need to consider that one. Okay, that is an important point to be considered. This is the cash budget. Thereafter, one more important point you can pay attention is maximum permissible bank finance. So working capital estimation, one of the important. Operating cycle is important. Debtors management is important, and factoring is important. Cash budget, just I told you, it is also important. Keep it in mind. Thereafter, you have maximum permissible bank finance. Maximum permissible bank finance. Maximum permissible bank finance also very, very important. Shortly, 2 marks question they may ask you. Maximum permissible bank finance, it was given by the Tandon Committee. Tandon Committee recommendations. So Tandon Committee recommend that how much of working capital, loan for working capital to be provided. They maintained in this, they recommended the three methods. Method one, 75% of current assets minus current liability. Then standard current ratio would be standard CR 1:1. Okay. Thereafter, method 2, 75% of current assets minus current liability. Then standard current ratio 1.33:1. Thereafter, method 3, 75% of current assets minus core current assets minus current liability. So you can take standard current ratio would be 1.77:1. So these are the various maximum permissible bank finance methods are recommended by Tandon Committee. Okay, for 2 marks question, you can also keep on the eye on this. So these are the working capital important areas, dear students. Follow these important areas. Since time is very, very limited, we have to go with these topics very, very important way, because coming exams, working capital estimation and operating cycle, factoring and debtors management, maximum permissible bank finance. Okay, check this one. Certainly, you will get the good judgment. Thank you. Hi, dear students. Yesterday we discussed the dividend decision. So, what is the dividend? How the dividend decision takes place? Once again, I will recap. So, financial management is a subject of decision making. There are various decisions: financing decision, investment decision, dividend decision. Right? Dividend decision is very, very crucial. In this dividend decision, the financial manager has to take very, very solid, sound, productive, effective decision. That is nothing but what to do with the earned profit. Should we declare a dividend or return? So for this purpose, there are different types of schools or established, means theories are developed, approaches are developed. This approach has been classified into two types. One is relevant models, another one is irrelevant models. Relevant theories argues that dividend decision certainly influence the market price of the equity share. That's why dividend decision is very essential. Sir, dividend decision means giving dividend or retaining profit, sir. So means whatever the profit you earned, is it good to declare a dividend or retain? It's not a matter. Either you give dividend or to give dividend. Certainly, dividend decision will influence market price. That is relevance. In that relevance theory, we discussed about a Walter. So Walter argument is, when Walter, what it explains, when company generates a return, the market value of the company is depends upon, dividend decision of the company depends upon either give a dividend or not to give a dividend. Is depends upon R and K. R means rate of return, or IRR earned by the company. When company returns, it will reinvest and it will generate the return. What is that return? How much that return is? right? Being a financial manager, you have to check that one. When you gave it this profit to equity shareholders, then equity shareholders get a chance to make investment. In such a case, how much return he is supposed to generate? Okay, that is a KE. When R is greater than KE, in order to increase the market value, follow 0% dividend payout ratio. Don't give dividend, right? Retain 100%, right? Whereas a K is greater than R, in such a case, the investor earning is better than you. Then in such a case, declare 100% dividend payout ratio, right? So this is the concept what we discussed, right? Now, basing on this Walter model itself, we had one more problem also we will discuss from study material. The following information applied to total earnings 2 lakhs, number of equity shares 20,000. 2 lakhs divided by 20,000, you will get the earning per share. So, whereas a 2 lakhs into 100 rupees, if you multiply it, you will get the total equity share capital. By taking a total earnings divided by share capital, you will get the return on investment of the company or R. Okay. Dividend payout ratio 1 lakh 50,000. It means that from 1 lakh 2 lakhs, you are making a payment of 1 lakh 50,000 means 150 divided by 2. 150 divided by 2 lakhs into 100 is nothing but dividend payout ratio. So how much percentage you are paying here? It is a 150 divided by 200 into 100. That equals 75% company making. So PE ratio is 12.5%. PE ratio is nothing but KE. PE ratio for PE ratio is not nothing but from the PE ratio you can extract a KE. How? I will tell you. PE ratio formula market price divided by EPS, whereas KE equal to EPS divided by market price into 100, right? That is the strategy. So if in this given data, what they asked, compute equity capitalization rate, that is nothing but KE and return on investment. Okay. Analyze whether the company following optimum dividend payout ratio. Find the value of share as per present dividend policy. Find the value of optimum dividend payout ratio. Compute PE ratio at which dividend policy will have no effect on the share. So now in this situation, KE we have to calculate what they asked, cost of equity capitalization rate, that is a KE. So PE ratio equal to, we know that PE ratio market price divided by EPS, reciprocal of PE ratio is nothing but KE. That is the reason KE equal to 1 divided by PE. 1 divided by 12.5 times is nothing but 8%, right? What about the R? R is nothing but return on capital employed. So in this problem, you try to understand the company making a earning availability to equity shareholders is 2 lakhs. 20,000 into 100, if you multiply, you will get the total capital employed. In such a case, 2 lakhs divided by 20,000, 2 lakhs divided by 20 lakhs into 100, this is nothing but 10%. So first part answer, we got it. Analyze whether the company following optimum dividend payout ratio. So dear students, here R is 10%, okay? KE is 8%. What the Walter argument is, when R is greater than KE, company has to follow 0% dividend payout ratio, whereas company currently following out of 2 lakhs, it is giving 1 lakh 50,000 rupees. It means that 75% dividend payout ratio it is making. In such a case, what we say that the company is not following 100% dividend payout ratio. We're getting my point? That's. Then what is the observation is? So here the answer is this, right? Since R is greater than KE, the company has to follow 0% dividend payout ratio, but company following 75%, so it should not follow optimum dividend payout ratio. Coming to find out the value of share at the present dividend policy. Present value of the share. According to Walter, what is the formula? D plus E minus D into R divided by KE whole divided by KE. In such a case, what you do here, it is D, dividend is given. How do you find it out dividend? For that purpose, you have to calculate the dividend. So here the dividend directly they are given either D equal to 7.5. How do you get it? This is nothing but total earnings divided by number of equity shares. You will get the earning per share. Out of that 75%, 2 lakhs divided by 20,000. This is 2 lakhs, right? 2 lakhs divided by 20,000 equal to 10 rupees into 75%. That is 7.5. So 7.5 is the dividend, EPS is 10. So R divided by KE equal to 132.81. Okay, that is. And compute PE ratio and find out the value of the share. Present dividend policy, this is also completed. Compute PE ratio at which dividend policy have no effect on the market price of the share. See, dear student, now R is 10, right? When R is 10 means KE also must be 10. When KE 10 means PE ratio would be 10 times. When KE is 10 times, then only market price does not makes any effect. Compute PE ratio at which dividend policy has no effect. We know that according to Walter, when R is greater, R is equal to KE, so dividend policy does not affect the market price. But R is 10%. So when PE ratio does not affect means KE must be 10%. When KE is 10% means PE ratio should be 10 times. When PE ratio is 10 times, then KE is 10%. I repeat once again. When PE ratio is 10 times, KE is 10%, which is equal to R 10%. In such a case, dividend decision should not affect. Next, will your decision changes if PE ratio is 8 instead of 12.5? In such a case, certainly we can change the problem. When PE ratio is 8 instead of 12.5, in that case, you have to find it out the PE ratio. Okay, what the point is given. Will your decision changes if the PE ratio is 8 instead of 12.5? So 12, 8. Previously, it is a given. Here it is 12.5. Now it is 8. So here 1 divided by 8 into 100 equal to 12.5% is the KR. Sorry, KE is a 12%, R is 10%, right? In such a case, what happens if the company follows same dividend policy? It would be like this. So market price equal to, here it is 7.5, 10 divided by 12.5%. You got it. 10 minus 7.5, 12.5% means if the KE is a 12.5%, in such a case, market price would be 7.5. So this is the Walter theory, dear students. Okay, and that would be the Walters. Well, we can also follow one more theory because before going to that, before after. So, dear students, so this is the problem. So we discussed the two problems from the Walter model, and next we are going to discuss Gordon's theory. Right? I will show you the PPT. Gordon's theory. See, Gordon's model. See, Gordon's model. This is also very important model. Gordon also comes under the concept of what is that relevance theory itself. So he will also comes under what theory? Relevance theory. So according to Gordon, if R is greater than KE, R is greater than KE, it is advisable the company has to retain. But the thing is, just retaining it does not make any sense. Okay, the retained amount company has to make reinvest, and it's supposed to generate what is that better growth rate. When while retaining, when you make a reinvestment, there would be three types of firms. One is a growing companies, saturating companies, declining companies. Whatever the funds you retain, if you reinvest on the given rates, right? If R is greater than KE, R is greater than KE, you are retaining. It's okay. But while investing in the companies, right, there would be a three types of companies. When you invest on growing companies, you may get the better growth rate. But when saturated company, normal growth rate, declining company, if you invest, you will get what is that negative growth rate. When growth rate gets negative, automatically investor expected rate increases. When investor expected rate increases, automatically market price decreases. Once again, yeah. So here, this is that in dividend decision. We'll come to here. In dividend decision, Walter theory is finished. Just Gordon theory. Gordon's dividend model is nothing but in this problem, right? Let us take a company is there. Let us take a company is there. Company R is greater than KE. In such a case, what is a better thing? Company 100%. What has it has to retain. Okay, you retained it 50% or 60%. You retained amount company again, it has to make what is that? Reinvestment. So when it makes a reinvestment, right? Retaining ratio into reinvestment equal leads to what is that? Growth rate. Okay, when company gives positive growth rate, it may reduce investor expected rate of return. It decreases investor expected rate of return. But whereas if you invest in negative and you submit a negative growth rate, automatically investor expected rate increases with effect to market price of the company gets damaged. So here the point is what the logic behind this one is according to Gordon, market price equal to MP0 equal to DPS1 divided by KE minus growth rate. Okay, where DPS1 equal to DPS0 into 1 plus growth rate can be KE is nothing but investor expected rate of return or yield rate. Whereas growth rate, how do you calculate growth rate equal to retaining ratio into rate of return on reinvestment. Rate of return on reinvestment. So this is the Gordon's dividend model. Okay. Gordon dividend model argues that if the company wants to really increase the market price, it has to return and reinvest. It has to submit the better growth rate. That growth rate will reduces a risk element or KE with effect to market price increases. So indirectly speaking, if the company has a wonderful opportunity, our company is going to invest on what is that high growth oriented companies, then it's supposed to generate wonderful growth rate. When growth rate increases, automatically market price of the company increases. So this would be an ultimate objective of this theory, right? So here the point, if you want to calculate the market price, growth rate should be positive. Growth rate when positive, then automatically KE decreases. When KE decreases, market price increases. That's why when R is greater than KE, simply R is greater than KE, market price won't increase. Thereafter, there is a lot of things remain balanced. What to do? You have to make reinvestment and you have to submit the better growth rate. So this is the idea of Gordon theory. Let us solve the few problems. I gave the formula for this. Gordon theory, DP market price equal to DPS1 divided by KE minus growth rate. DPS1, DPS0 into 1 plus growth rate equal to retaining ratio into rate of return on reinvestment. And finally, market price could depends upon three elements: investor expected rate, growth rate, and DPS1. Let's solve the problem. Here, this is the problem which is given. The following figures collected from the annual report: net profit after tax 30 lakhs, outstanding 12% shares. Means from 30 lakhs you have to deduct 12% preference shares, then only you will get the profit. Number of equity shares from 30 lakhs minus preference dividend, means 30 lakhs minus preference dividend divided by number of equity shares, then you will get the EPS. Okay. And the return on investment is 20%, cost of equity is 16%. You see, return on investment 20%, cost of equity is 16%. But simple Walter theory argument is when R is greater than KE, then automatically by retaining market value increases. Gordon argument, no, R is greater than KE. Okay, you retain it, but thereafter you reinvest it, generate growth rate. That growth rate will reduce investor expected. With effect, market price increases. So that would be the observation of our observation or theory approaches of Gordon. Now here the calculate price of the share using Gordon model if the company follows dividend payout ratio 25%, 50%, 100%. Let's take if the company retains at 25%, this is the dividend payout ratio 25%. So then retaining ratio is 75%. If the 75% company is going to make investment here 20%, and where you find the growth rate. If it is a 50% dividend payout ratio, retaining ratio 50%, and go on make a dividend investment here, and you will find the growth rate 100%, no chance. Okay, so then you have to find it out growth rate where KE also given, and the DPS1 you have to find it out. DPS1, how do you find it out? Already net profit after tax is given. From that preference dividend you deduct earning availability equity shares, you will get it divided by number of equity shares, then you will find the EPS. If the 25% dividend means EPS into 25%, you will get the dividend payout ratio. Okay, and the EPS into this 25% you will get the dividend per share. So dividend divided by K is 16% and deduct the growth rate, then you will find the market price. Okay. So now you see net profit 30, preference dividend 12, earning available to equity shareholders 13, earning per share is 18 divided by concerned shares. Shares, how many shares? 3 lakh shares. Then you got the EPS. So price as per the Walter theory, market price equal to DPS1 divided by KE minus growth rate. You can also write like this: EPS into dividend payout ratio divided by KE minus growth rate. So when dividend payout ratio is 25%, dividend payout ratio 25% means 6 rupees is the EPS into 25%, whereas KE is this. This 25% is dividend payout ratio means retaining ratio is 75%. Whereas the rate of return you are going to invest in 25%. It means that growth rate, how much? 0.75 into 0.20 into 100. Okay, then you can find the growth rate. So the dividend payout ratio, then this growth rate should be deducted from it, and basing on this you can also find it out. Here it is. So 15% is the growth rate. KE 16 minus 15, you will get the 1.5 divided by 1%, that is nothing but 150 you will get. Coming to second option, dividend payout ratios of 50 means 6 rupees is the EPS into 50 divided by 16. Remaining 50, 0.50, you are going to invest in 0.20 means 10%. So 3 divided by 16% minus 15%, that equal to 50 rupees. Third option, 100% dividend payout ratio. Then 6 asterisk, your growth rate won't commit, then you will get it 37.50. So these are the various ways in which dividend to be computed. Market price is computed as per Walter theory. Okay. Coming to, we are going for the next model problem. Next problem, we are going to discuss here one more problem, Walter and Gordon theory. Okay. And so far I discussed Walter. Thereafter, I came with Gordon. Now in this problem, I'm going to merge both Walter and Gordon theory. With this model we are going to conclude. The following information below: earning per share is 60, capitalization rate, that is nothing but KE, rate of return R is 25%, dividend payout ratio 30% means retaining ratio is 70%. Okay, compute Walter's model. According to Walter, what is the formula? D plus E minus D into R divided by KE whole divided by KE. So earning per share is 50. Dividend payout ratio 30 means retaining ratio 70%. Whereas here you can easily find it out. EPS is how much? Kitna hai tha? 60. 60 into 30, 18. R is given. R is how much? 25%. KE also given 15%. 15%. Okay, so EPS 60 minus 18. So divided by KE, you got it a 586.67. Okay, whereas Gordon model, Gordon argument is that 7 dividend payout ratio you are making 70, you are retaining dividend payout ratio you are making 30, dividend 30, retaining 70. 70 you are going to reinvest at 0.25 means 25%. It means that 0.70 into 0.25 into 100. 17.5%. So it means that 17.5% means 7.5%. Here they could not give it to the market price. Walter given. Okay, where you can also find it out like this. According to Gordon, Walter finished. Gordon, DPS1 divided by KE minus growth rate. DPS1, just to be computed, earning per share is 6 means 30%. 60 into 30%. 60 into 30%. That is 18. KE is given 15%. Okay. Whereas here 0.70, right? 0.70 into 0.25 into 100. That equal to, it is more than 17.5%, means The point why here market price they could not ask is, see, the fundamental idea, there's nothing but the growth rate must be always less than the cost to be paid. But in this situation, cost is more. But that is the reason. Just they asked us what would be the optimum dividend to payout ratio under Gordon model. So here the market price won't come. According to Gordon model, how do you find it out? What would be the optimum dividend payout ratio? Means when R is greater than KE, R is greater than KE by retaining 100% dividend payout ratio, retaining 100%, right? The company able to increase its market price. But the most important point is when company whatever the retains, it reinvest, it may generates a better growth rate. So comparing to investor, then market price of the company may increase. So that is the point with respect to Gordon model, dear students. The next model is Modigliani and Miller hypothesis. Dear students, just now we completed Walter and Gordon. These two is relevance models. But now in front of you is showing or displacing is nothing but Modigliani and Miller hypothesis. So according to this approach is the irrelevance model. In this model, what the argument is whether dividend is paid or not to paid, okay, does not influence the market value of company. What influences it's a wonderful investment decision. How effectively the company able to take investment decision that would makes market price somewhere. Okay, that is the Modigliani Miller approach. So approach supports the irrelevance of dividend. Firm's dividend policy has no effect either the price of the firm's stock or cost of capital. Nothing is going to influence. Here, the market price, this theory is based on certain assumption. Number one, perfect capital markets, no taxes and no discrimination, fixed investment policy. Life is nothing but 1 year. Whatever the market value we are estimating, everything comes under the 1 year category. No flotation cost, no transaction cost, risk of what is that? Uncertainty. What is that? Risk of uncertainty. So all these things comes under this category. What are the assumptions? Perfect capital market, no taxes or no tax discrimination, fixed investment policy, no flotation cost, transaction cost, risk of uncertainty, and 1 year holdings. Right. So basing on this theory, if you want to declare it, what you have to prove in this theory? The simple argument is this. Modigliani Miller argues that market value never influenced with the dividend policy. So that's we have to prove it. His way of explanation is this, right? First of all, you should able to find it out market to market value of firms. But market value, either if you declare a dividend, not to declare a dividend, market value will remain same. So his idea behind is very simple. When company declares a dividend, what happens? When company declares a dividend, automatically its wealth of the organization means market value of the company decreases. And at the same time, he projected a fixed investment policy. When fixed investment policy stands in front of you, you are declaring dividend, your market value decreases, where you have to invest. In such a case, what you have to do? You have to go for what is that? New equity shares. In such a case, when new equity shares you issue and you raise a capital, and if you make investment means, so both the sides of the balance sheet will not affect. So either you declare a dividend. In such a case, what happens? If you declare a dividend, so your market value decreases. Market value decreases. And in order to undertake investment, you will raise more number of shares in order to undertake investment. So here, for the sake of investment, you get the cash. Here, more number of equity shares increases. So both will have set of effect. What about the investor? For example, I am holding 100 shares. Okay, if the company declares a dividend, what happens? For 100 shares, I will get the dividend. Good. But the point of highlight is, what about the market value? Market value decreases. So I would be benefited in one point. That is nothing but dividend I will get it. But with effect market value decreases. There also set of effects takes place. With effect market value of the company will remain same. So market value company as well as investors market value also remains same. Only benefit happens here is nothing but what? How effectively you will undertake investment decision. So here you have to follow certain calculations. So calculation is nothing but P0 equal to, you know that MP0. Market value is nothing but present value of future benefits discounted at investor expected rate of return. So MP0 generally P1 plus D1 divided by 1 plus KE. So if you want to extract P1, What is the formula? P0 into 1 plus KE minus D1. And new number of shares, if you want to issue, means funds required divided by MP1. You can write like this: investment minus earnings minus dividend divided by P1. So value of firm, existing shares, new shares into P1 minus investment plus earnings divided by 1 plus KE. So this is the total market value. This formula will support you to find it out, market value of firm. Okay, let's take a few examples. Here, RST Limited. This model problem is there in our material. RST Limited has a capital 10 lakhs in equity share 100 rupees each. The shares are currently quoted at par. The company proposes to declare dividend 10 per share at the end of the current financial year. The capitalization rate of risk class which the company belongs to is 12%. What will be the market price of the share at the end of the year if a dividend is not declared, if dividend is declared? Assuming that company pays dividend and is net profit of 5 lakhs and makes a new investment 10 lakhs during the period, how many new shares must be issued? Use the model. Using model, we can identify. So now the question arises here is, when you declare a dividend, not to declare a dividend, market price does not make any information. For example, given information, MP0 100 rupees, DPS1 10 rupees, KE is 12%. Next, we know that MP0 equal to D1 plus MP1 divided by 1 plus KE. So MP1 equal to P0 into 1 plus KE minus D1. So that is the formula. In basing on this, right, estimation of MP1 when dividend is not declared. When dividend is not declared means at the D point it will give, you will get a 0. In such a case, MP1 equal to 100 into 1 plus 12% cost of equity, right? Here it is 12% minus 0. It means it will get 112. So when dividend won't declare, market price increases generally. Whereas estimation of market price when dividend declared, then MP1 equal to MP0 into 1 plus KE minus D dividend. So 1 or 2. With effect of what I told you, that when company declares a dividend, market value what happen? Decreases. And estimation of new number of equity shares. New number of shares you required means when dividend is declared. New shares equal to investment minus earnings minus dividend divided by MP1. So 10 lakhs minus 5 lakhs minus 10,000 into 10. So earnings. So when you are declaring dividend means when you make earnings, you have to declare a dividend, right? 10 rupees divided by 1 or 2. You will get the 5883. So this would be the observation, right? Here when dividend is declared, not to declare. This is the formula. Once again you apply. Observe here. Estimation of MP1 when dividend is not declared, and estimation of MP1 when dividend is declared, and the number of new shares. So this is the way you should understand Modigliani-Miller theory, market price when dividend is declared, when dividend is not declared, and at the same time new number of shares. Coming to, we will have next problem also we can declare. Here you observe it in this problem. M Limited, this is also from study material, right? M Limited belongs to a risk class for which capitalization rate is 10%. It has 25,000 outstanding shares and the current market price is 100. It expects net profit of 2, 2,50,000 for the year, and the board considering dividend of 5 per share. M Limited requires to raise 5 lakhs for approved investment expenditure. So how approach affects the value of limited if dividend are paid, not to paid. You see, M Limited is a risk class for which capitalization rate K is 10%. It has 25,000 outstanding shares. Currently, it has 25,000 shares and current market price is 100. It expects net profit. How much net profit it expects? 2,50,000 here. Board considering dividend to be paid 5 per share. So M Limited requires to raise 5 lakhs for the approved investment. How much they are needed? 5 lakhs. So how approach affects the market value of M Limited if dividends are paid, not to paid. Once again, recoup. What is the Modigliani-Miller argument is? When dividend declared, dividend not declared, market value will remain same. In such a situation, what we have to find it out? Market value is nothing but new shares plus existing shares into MP1 plus earnings minus investment divided by 1 plus KE. This is the market value of firm. Now, when we know that when company declares a dividend, in such a case, generally market price decreases. With effect, the more number of shares you have to issue. When company won't declare, in such a case, market price would be high. In such a case, less number of shares will you issue. With effect, there is a impact on market price. By keeping this one, first of all, you should calculate MP1, market price at the end of the period. You take the two columns, particulars, one column dividend declared, another column is not declared, like this. You see, the estimation of market value of firms when dividend is paid, when dividend is not paid. So number of existing shares, 25,000, 25,000. P1, okay, existing shares 20,000, 20,000. Now P1, when dividend declared, not to declare. What is the formula of P1? Just now I gave you MP0 into 1 plus KE minus D1. That is 100 into 1.10, that is a 10%, minus dividend declare is 5 rupees. In such a case, it would be 105. When dividend is not declared, 100 into 1.10 minus 0, that is 110. So number of new shares, you are going to get it. Number of new shares equal to number of investment minus earnings minus dividend to be paid. 5 lakhs minus 2.5 lakhs minus 1.25 lakhs divided by 105. So 3,571 new shares will come when company declares a dividend. When company not declares dividend, 5 lakhs minus 2.5 lakhs divided by 110, that is 2 lakh 273. Right now, investment, you know that 5 lakhs you needed. Earnings, you know that 2 lakh 50,000. Now, market value of firm. What the formula is? New shares, existing shares divided by MP1. MP1 varies with respect to dividend declaration. Okay, and minus investment plus earnings divided by 1 plus KE. That means 25,000 plus 3,571. This is the when dividend is declared. In such a case, 3,571. You getting here? So here the new shares. Okay, number of new shares. So existing shares 25,000 plus 3,571 into 105 minus 5 lakhs plus 2.5 lakhs earnings divided by 1.10, 25 lakhs. Whereas here also, if you declare like this, 25,000 number of existing shares, P1 110, number of new shares 5 lakhs minus 2.5 lakhs divided by 110, 2,273. So investment is 5 lakhs, earnings is 2 lakh 50,000. So market value of firm 25,000 plus 2 lakh 273, 25,000 shares plus 2,273 into 110 minus 5 lakhs plus 2.5 lakhs divided by 1.10 used to get at 25 lakhs. It means that dividend declare, dividend not to declare, market value of firm will remain same. See, in order to make you very clear, I made this analysis, right? This made analysis. So simply Modigliani theory is irrelevance theory. Either you declare a dividend, not to declare a dividend, market value could not get affected. Market value will remain same. But market value of the company will be influenced with investment decision. So these are the three important theories, dear students. In our syllabus, we used to declare this one: Walter theory, Gordon theory, and Lenter theory. Once again, Walter Gordon relevance model. MM is irrelevant model. Recheck once again what is the formula for Walter theory. D plus E minus D into R divided by KE whole divided by KE. Whereas Gordon DPS1 divided by KE minus growth rate. Coming to Modigliani Miller MP1. MP1 equal to first of all, you should understand MP0. MP0 equal to P1 plus D1 divided by 1 plus KE. Coming to MP1. MP1 equal to MP0 into 1 plus KE minus D1. Thereafter, number of new shares equal to investment minus earnings minus dividend. Whereas divided by MP1. Coming to market value of firm. New shares plus existing shares into P1 minus investment plus earnings divided by 1 plus KE. Right? So just for the sake of time being, these three theories are very important from the examination point of view. I vividly given the even a tabulation form also. So more than the 4 repeated model in public exam question papers questions I explained. Right? With this, dividend decision is completed. Hi dear students. Just now we completed dividend decisions. Now I am going to take risk and uncertainty in investment decision. Dear students, this chapter is very important for 5 marks. Majority we will get this chapter for 5 marks only. So in this chapter we are going to discuss various methods through which we can evaluate the risk of the project. Okay. How this chapter is completely different from investment decision, first you should understand once again. Okay. Then we will go with the different types of methods. Okay. Coming to here, dear students, What is capital budgeting, right? What is investment decision or what is capital budgeting? So investment decision. Dear students, the fact is this means whenever company raises the funds, right? When company raises capital, it has to make investment, okay? It has to make investment. The investment should be done on fixed assets and investment should be done on current assets. How to make investment on fixed asset is nothing but capital budgeting. Capital budgeting or investment decision. Got it? Now we will come to from here. In investment decision, right? In order to make evaluation, we will follow different types of methods. But in all different types of methods, these methods being classified into, the traditional methods. Another one is modern methods. What are the various methods we used to take? Payback period, ARR in traditional method we used to take. In modern method, we used to calculate NPV, profitability index, IRR, and discounted payback period we used to calculate. But among these methods, right, we know that NPV become very, very popular, eminent method. Okay, let us take to evaluate a project, right, whether this project is worthable or not. There is a project, right? Here it is a project. Whether this project is worthable or not, if I want to know that, what would be the investment I supposed to make on this project? So what is my investment on this project I am going to make? If I want to calculate what is my investment on this project, in order to know that one, right? Generally, in order to know this one, whether this project is workable or not, for that purpose, what is that? I used to make various evaluation techniques, right? I used to make various evaluation techniques. So let us take, I used to calculate NPV. We used to calculate NPV. In NPV estimation, what we observed it, NPV. So where we will calculate the PV of cash inflow minus PV of cash outflow. If NPV is positive, we say that project is worthable to accept, right? It's good. Up to here, the treatment is wonderful. But my question here it is, are you clear that the cash inflows what you are going to use are the cash flows what you used in order to evaluate a project? Will it be certain in future? No, it could not be certain. For that purpose, the cash flows which are not at all certain, such a cash inflows, if you have taken in order to evaluate a project, then how this project would be worthwhile? Tell me, will it be worthwhile? No, because your way of evaluation of project, what you have taken assumption that future cash inflows are certain, that is absolutely blunt mistake. It's not at all possible. In such a case, what to do? What financial management says, whenever you are going to evaluate a project, okay, consider cash inflow, cash outflow, no doubt at all. But that cash inflow, cash outflow undergo with the various risk factors. You have to consider that risk factor. Basing on that, you have to identify it. Let's come to what is risk. Okay, here the question arises: what is risk? Okay, tell me, what is risk? So what is risk? Risk means nothing but uncertainty of return. What is it? Risk indicates uncertainty of return. If you make investment, right, in any project, the return what you supposed to get, you never going to get because there is a certainty. In such a case, why a project when risk indicates uncertainty, you cannot get it? That means that there is a variability of return, uncertainty of return will take place. In such a case, exactly, we cannot say that this project is worthwhile. So there are different types of risks is going to identify: project risk, industry risk, international risk, environmental risk, because there are different factors which makes a project, even though the project is worthwhile, but you are not going to get exactly what you determine. For that purpose, there are different types of methods we are going to evaluate the project, right? So risk adjusted methods, risk adjusted methods. We are going to calculate different types of methods. Number one, risk adjusted discounting rate, adjusted discounting rate based NPV we will calculate. Thereafter, certainty NPV we will calculate. Certainty equivalent factor based NPV we will calculate. Then scenario analysis we make. Then sensitivity analysis we will make. And while coming to statistical method, where statistical method we will calculate what is it? Probability based expected NPV will calculate, and thereafter we will find it out. After expected NPV we will calculate what is that variance we will find it out, standard deviation we will calculate, and coefficients of variance we used to find it out. So these are the various methods: risk adjusted discount rate based NPV, expected NPV, certainty equivalent factor based NPV, scenario analysis, sensitivity analysis, statistical method we follow, probability, variance, standard deviation, coefficients of variation. By considering all these methods, we will evaluate the project, right? So risk is inevitable, dear students, but the thing is risk should not be neglected. Risk should be considered. After considering risk, one has to take evaluation. Okay, so first, next class I'm going to take expected NPV. What is that? Expected NPV. Hello, dear students, good morning. So yesterday we started risk analysis in capital budgeting, and you know that we discussed all this concept: what is a risk, what is uncertainty, and how this identity means the identity of risk takes place. But now we are going to discuss various methods and how these methods to be evaluated. Number one, in this analysis, we are going to take a expected NPV. First one is what is that? Expected NPV. We are going to solve this called what is it? Expected NPV. What is expected NPV? How the evaluation takes place means risk could be adjusted or mitigated with this technique that is called expected NPV. Before going to this one, right, we should understand what is a probability. What is that? Probability, you should understand probability. So probability, you have to identify what is the probability. A probability is nothing but a chance of occurring an event. Occurring an event. Okay. A probability is nothing but a chance of occurring an event. Let us take today India versus England match is going on. Today, at the time of video shooting is going. If someone asks you, if someone asks me that, if you say that who is going to win the match, so in order to give a response, what I have to do is I have to take at least 10 matches which was happened between England and India, and I have to take how many matches India won. Let us take 5 matches. England won 5 matches. In such a case, we won 5 matches, they won 5 matches. The probability is 50-50. Whereas we won 8 matches, they won 2 matches, means we have a chance of 8. So that is nothing but a probability. So probability means chance of occurring an event. The sum of this probability distribution is nothing but sum of the sum of probability distribution is nothing but 1. The total sum of probability distribution is nothing but 1. So this is the probability chance you have to identify. If you want to find it out, the expected NPV, right, the one more important point you have to consider is, along with this, one of the important point you have to consider is expected NPV. You have to calculate expected cash flows. Expected cash flows. So probability, first you have to understand probability, you have to identify cash flows and expected cash flows. How do you get the expected cash flows? Expected cash flows, what are you going to get? It means cash flows into probability. When any cash flow, this cash flows may be, what is that? Inflow and outflows. When inflows and outflows are multiplied with the probability, you will get it. What is that? Expected cash flows. Now try to understand what is the expected NPV then. So expected NPV is nothing but, right? Expected NPV. Expected NPV. When cash flows are given directly basing on that cash inflow, if you compute NPV, that is called NPV. But expected cash inflow, expected NPV means what do you say? It is the NPV. It is the NPV which is estimated from expected cash flows. How do you calculate expected NPV? PV of expected cash flows, PV of expected cash inflows minus PV of expected cash outflows. PV of expected cash inflows minus PV of expected cash outflows is called what is that? Expected NPV. So how to calculate this one, right? How to estimate this cash inflow? You will find it out, right? How to estimate this? Estimation of expected NPV. How do you calculate expected NPV? Number one, step number one, PV of expected cash inflows and outflows. Step two, estimation of expected NPV. Right. If decision making, how do you take a decision making basing on this? Right? How do you take a decision making? So the point is, if expected NPV is positive, then accept the project, otherwise reject. So expected NPV is positive, accept. Then negative, reject. Zero, either accept or reject. So this is the procedure, dear students. How do you find it out? Now tell me, what is expected NPV? It is the NPV estimated from expected cash flow. In order to understand this one, you should find it out. Probability, expected cash flow with the probability, if you multiply expected cash flows. Expected cash flows may be inflows or outflows. Expected NPV, it is NPV estimated from expected cash inflows. So what you do is, first of all, you have to calculate the cash flows. Thereafter, you have to multiply with what expected cash flows. First of all, you have to find it out the cash flows. Cash flows are multiplied with the probability, then you will get it the expected cash flows, and from cash inflow minus cash outflow. Okay, then you have to find it out expected NPV. How the procedure? Once again, I'm saying first to calculate cash flows, expected cash flows. Expected first cash flows. Cash flows are multiplied with the probability, then you will get what? Expected cash inflow, and after bringing into the present, then you have to find it out expected NPV. Let us solve the problem with respect to expected NPV. There is a problem in our material, or I will show you. This is the, once again I will show the PowerPoint presentation also here. It is the NPV which is estimated from expected cash inflow, right? Expected cash inflows, right? So find out expected cash flow, find out the present value of expected cash flow, and you have to apply the formula. Let us solve some problem on this category. Here we will take a problem. Now, here I'm going to take a problem. This is I have taken from our mastermind material, and the same problem also covered in the new study material. See, possible net cash flows are project A and project B. and their probabilities are given below, right? The discount rate is 10% for the both the project. Initial investment is 10,000. Calculate expected NPV of the each of the project. Now tell me, how do you calculate expected NPV? Expected NPV, if you want to find it out, first of all, you have to calculate expected cash flows. The possible events A, B, C, D, E given, cash flows are given, probability given. Project B, cash flows are given, probability given. So what you have to do is the cash flows, whatever you're going to get it, you have to multiply with the probability. Then you will get expected cash inflow. Thereafter, you have to bring the cash inflow into present by using present value factor, the 10%, right? So here what I have done, calculation of expected cash inflow in each of the project. Possible event A, B, C, D is there. Cash flows 8,000 here. In this problem, you see 8,000, probability 0.10. What I have taken? 8,000 0.10, 10,000 0.20, 12,000 0.40, 14,000 0.2. Expected cash inflow 8,000 into 0.10, 800, 10,000 into 0.20, 2,000, 12,000 into 0.40, 4,800, 14,000 into 0.20, 2,800. Now these are the cash inflows I got it, right? And for project B also 24,000, 20,000, 16,000, 12,000. Probability by multiplying this, I got the expected cash inflow. Now, considering this one, right? Expected cash inflow equal to NPV, expected NPV equal to PV of cash inflow minus PV of cash outflow. For project A, if you sum it up, all these events is going to happen in a 1 year. For that purpose, what I have to do is, whatever the cash inflow I got it, I have to multiply with the probability. Then I have to find it out expected cash inflow. Then I have to sum it up. So here, by summing up of all this factor value, how much I got it? 800, 2000, 4800, 2800, 16. If you sum it up, the total would be 12,000. I got it. So 12,000. Let's check it this problem once again. So 1600, 2000 plus 800 plus 4,800 plus 2,800 plus 1,600. 12,000 got. So 12,000 is the total cash inflow I got at project A. Now by 12,000 in a year you are going to get it. So present value factor 10% 1 year minus, you know that investment you made it how much? Investment you made it at 10,000 rupees. In such a case, what you do is 10,000. So present value factor 10% 1 year means 0.909 minus 10,000, that equal to 908. So 12,000 into 0.909 minus 10,000 equal to 908. That is project A. Project B, expected NPV 16,000 into present value factor 10% 1 year minus 12,000. I got it worth of how much? 16,000. Hello, this is now 16,000. Let us check it here. So 2,400, 3,000, 8,000, 2,400, 2,400 plus 3,000 plus 8,000 plus 1,800 plus 800, 16,000. So 16,000 I am going to get it. 16,000 into present value factor 10% 1 year. 0.90 minus 10,000. You will get the 4,544. Since given projects are mutually exclusive means, since expected NPV is highest, it is beneficial to select the project. So this is the way in which expected NPV to be calculated. Once again, expected NPV, what the procedure we have followed? This is the procedure. Expected NPV, it is the NPV estimated from expected cash flows. So PV of expected cash inflow minus PV of expected cash flow. Expect estimation of expected cash inflow, decision making also we done it. So with this model we completed expected cash inflows. Expected cash inflows come expected NPV. Okay. Now we move to what is that? Another topic is risk adjusted based NPV. What is that? Risk adjusted NPV. Risk adjusted discounting rates are based NPV. Risk adjusted discounting rate based NPV. Dear friends, what is a discounting rate? First of all, you should understand what is a discounting rate. Discounting rate is also called cutoff rate, also called cost of capital. Whenever company need a capital, the company raises the funds from various sources. It is a due responsibility of the company to make investment. So while evaluating risk adjusted discounting rate, what it conveys, it is the NPV, right? Yeah. It is the NPV which is estimated from risk adjusted, estimated by using risk adjusted discounting rate. Risk adjusted discounting rate. So what is the risk adjusted discounting rate? So here risk adjusted discounting rate, what it explains. So risk of the project also must be considered. Along with this, what is that? The cost of capital, what you generally pay, plus you have to add certain risk premium to it. I will tell you, dear students, here one of the example. I always interested to convey this one. This is the risk adjusted discounting rate. It is the risk adjusted discount rate. Basing on this one, investor expects high return from the high risky project. So he will expect some plus compensation. When risk investor expects undertakes a project which includes high risk, in such a case, he should not expect a normal return. He will expect more return, more than, because he knows that this project is high risky one. Even after knowing high risk, if he makes investment, then he has to get more. For that purpose, in this method, what happen? We will use high discounting rate. High discounting rate, just now I told you, the cost of capital rate we will use for the discounting, but plus we will make a premium. So keep it in mind, plus or minus the premium to be added or reduced. Okay, that is, for example, this is the point. Risk adjusted discount rate is a sum of risk free rate and risk premium. The risk premium depends upon the perception of risk by the investor of a particular investment and the risk aversion of the investor. Risk adjusted discount rate equal to risk free rate or cost of capital rate plus risk premium. You see, this is the one of the area of Sahara Desert. In the middle of the desert, one of the Indian companies doing business there, I know particularly. So if the company does business there, means it is a taking lot of risk, right? In such a case, will we expect the same return? No, you should expect what? More than that. And at the same time, you are doing a project at Iceland, right? In such a case, you are doing business. Will you expect same? No, you will expect more than this. So such a return, in such a case, what happened? In order to evaluate this project, you should not expect just the cost what you raised. Okay. Along with this, you have to you have to consider certain additional premium also, additional amount also. That is called risk adjusted discount rate. Here you should understand two things. One is risk free rate, another one is a risk premium. Risk-free rate is nothing but make be considered as a cost of capital what you supposed to get it, and risk premium to be considered because you are taking. In this method, one of the beauty technique of this method is nothing but, in this method we won't consider, what is it, along with cost of capital, we will expect additional risk premium, and in this method we won't disturb the cash flows. Because just now I discussed the risk adjusted discounting expected NPV, where the cash flows are adjusted with what? Probability. But in this method we won't disturb the cash flows. We will disturb, or we will modify discounting rate, considering that risk to be paid. Okay, that is the point. So how we have to calculate the risk adjusted discounting rate, right? Here you have to modify, you have to take the cost of capital and you have to add risk premium to concern part, and you have to take a risk adjusted discount rate. By using that risk adjusted discounting rate, you have to evaluate a project. At risk adjusted discounting rate, your NPV is positive, then the project should be accepted, otherwise rejected. Okay, right. This is an idea. Let's solve the problem. Once again, how this uh, risk adjusted to be estimated here, how it is to be estimated, you see. First of all, identify the cash flows. Number two, compute the risk adjusted discounting rate. Risk adjusted discounting. So wrote risk adjusted discounting rate equal to cost of capital plus risk premium, and discount the cash flows with the not discounting rate. Risk adjusted discounting rate. Decision rule. If the project yields positive NPV, it can be accepted, otherwise rejected at the risk adjusted discounting rate. Okay, right. Now we take the problem here. This is the problem which is a given. Okay, let's move to problem number 2. The new project limited, evaluating 3 projects, project 1, project 2 and project 3. The following information is available in respect of these projects. Particulars project 1, project 2. Cost 15 lakhs, 19 lakhs. Inflows 1 year, 2 years, 3, 4, 4 years. The 4 years are cash flows are given, and risk index. Risk index is nothing but a technically called beta. Beta. So beta is given means indirectly he has to identify risk. He giving a guidance. He is giving instructions that so risk adjusted discounting rate to be estimated basing on CAPM approach. Because beta is given. Well, we know that CAPM approach. A previous class we discussed CAPM approach was proposed by Sharpe. He identifies that cost of equity should consider risk-free rate plus risk premium, where beta plus where adjusted discounting rate or KE equal to RF plus beta into RM minus RF. So those students who are aware of CAPM approach, they can solve this problem very easy manner. So risk index 1.80, 0.60. In beta it is a high. This is a high risky project. Here 0.60. This is a low risky project. So minimum required rate of return in the firm is 15% and applicable tax rate is 40%. The risk-free interest rate is 10%. So find out the risk-adjusted discounting rate of these projects and compute the NPV and which project is the best. They are asked this identity. Now what to do? What we have to do? Very simple concept is this. Whatever the cash flows are given, you are not going to disturb it because the risk of the project you are mitigating by adjusting, by modifying discounting rate. In this problem, the discounting rate is 15%, whereas discounting rate is 15%. Now you are going to add to it with discounting rate 15% along with you have to add the risk premium. For that purpose, you have to consider the beta and the risk-free interest rate is 10%. So what you have to do is, first of all, you have to estimate risk-adjusted discounting rate with the CAPM approach based. For that purpose, risk-adjusted discount rate according to CAPM approach, what do you say? RF plus beta into RM minus RF. This is the formula I told you previous class. So risk-free rate for project 1, 10%, 15 minus 10 and into beta 1.80. If you convert into percentage, it would be 19%. For 2, risk adjusted discount rate 0.10 plus 15% minus 10% into 0.10, 13%. Now, by taking this 16%, 19% for project 1, 13% for project 2, you have to evaluate the project. Let us take project 1. Annual cash inflow given 6 lakhs. So present value annuity factor to be taken for this is for taken for how much? 19% because this project has huge risk. So hence, since risk is high, this project also to evaluate we have to use a high discounting rate. So that is a 16% 4 years 2.639. By multiplying this, you will get a 15,000 15 lakhs 83,400 less cost of capital 15 lakhs. If you deduct 83,400 used to get the NPV. Since NPV positive, project 1, right, we may accept. But if the given projects are mutually exclusive, then we must compare one with another. In such a case, next project 2. So here cash inflows every year differ. That means 1, 2, 3, 4 cash flows are there. and 13% to be taken into consideration. Since every year cash inflow, here every year cash inflow same, that's why we used vanity factor. But here we use present value factor, and 4 lakhs factor value. By multiplying this both used to get the present value. Summing up of this present value, you will get the total present value 21 lakh 13,800 less cost of investment 19 lakhs. So you will get the NPV 2 lakh 13,800. 2 lakh 13,800. Now what we have to do, since both the project submits NPV positive, but project 1 gives you maximum NPV. So not project 1 I guess. Project 2 gives maximum NPV. So project 2 to be accepted. This is the risk adjusted risk. Once again, dear students, profit is reward of risk taking. If at all any person takes huge risk, he deserves to get huge return. That is a basic principle, basic condition also. So what this model conveys that if the project is high risky one, the financial manager or investor who is going to undertake a project, he should not get only the cost of financing, what he incurred, but also he should get more than that because he's taking. So that is the idea for this one rule. So whenever you want to evaluate a project, don't take cost of capital as a directly, right? You consider the risk and modify the risk discounting rate as a risk adjusted discounting rate. Basing on that discounting risk adjusted discounting rate, if you evaluate a project, if it gives positive NPV, then accept. Otherwise, okay. Coming to next method is certainty equivalent method. Certainty equivalent method risk analysis. See, certainty equivalent risk analysis is a similar to expected NPV. In certainty NPV and expected NPV, there is a little bit difference is there. If you are able to analyze that one, then you can easily solve it. Dear friends, whenever any investor who makes a huge investment, right, complex, substantial expenditure, he will makes on complex project. In such a case, if you ask him that what is the cash inflow you will expect, if you say that by taking the probability, if you consider just the expected cash inflow, it really makes a huge risk to the concerned project. So sometimes to make evaluation of the project, we won't consider the probability. We will consider certainty. Certainty. How much exactly the certain cash inflow we supposed to generate in the project. Basing on that certain cash inflow, we will evaluate the project. Such a NPV, which is estimated from certain cash inflow of the project, such a NPV is called certain NPV. So, dear students, in this aspect, what you have to do is, first of all, identify the cash flows. Point number one. Number two, identify what is the certainty equivalent factor. First of all, you should understand what is the certainty equivalent factor. Certainty equivalent factor is the ratio which is explains that from uncertain cash inflow, how much exactly certainly the cash inflow you are going to get it. Now what to do? From uncertain cash inflow, multiply with what is that CE factors, you will get the certain cash inflow. Basing on that certain cash inflow, if you calculate NPV, then you will it would be called certainty NPV. Why? Because sometimes the project probability does not give much satisfaction to the investor. Okay. Now here it is. We will discuss here it is certainty, certainty NPV. Certainty NPV. What is certainty NPV? What we can say, it is the NPV, it is the NPV which is estimated, it is the NPV which is estimated for certain cash flows. That means if you invest a project, that project may gives you what is that cash flows. That cash flows have what is that uncertainty. In order to bring certainty, uncertainty. So what we do is we will multiply with what is that CE factor. CE factors. When certain cash inflows are multiplied with CE factors, then what you will get it is certain cash inflows. We will get the certain cash inflows. So basing on that certain cash inflows, right? Basing on certain cash inflow, if you calculate a NPV, such a NPV called what is it? Certain NPV. If certain NPV positive, accept. Negative, reject. Equal to zero, either accept or reject. This is called certainty NPV. So this is the NPV which is estimated from certain cash inflow. Well, so in order to make whether the project is workable or not, you have to find it out cash flow first. Then you have to understand. So what is the CE factor? Here the one of the factor you should understand CE factor. What the CE factor it indicates. So it is nothing but certain cash inflow. CE factor is nothing but certain cash inflow. For example, 5 lakhs is the uncertain cash inflow. Uncertain. Out of this 5 lakhs, you are going to get the 1 lakh certain cash. For 5 lakhs, you are getting 1 lakh is a certain. For 1 rupee, how much you are going to get? For that purpose, certain cash inflow divided by certain cash flows divided by uncertain cash flow is nothing but C factor. Certain cash flow divided by uncertain cash inflow is nothing but C factor. Once you multiply with this uncertain cash inflow with this CE factor, you will get the certain cash inflow. So by taking this certain cash inflow, if you compute NPV, you will get what is that? Certain NPV. If the certain NPV is positive, the project should be accepted. This is the idea. Okay. Here, I will give one more time presentation also. This is here. This is so how to compute the CE factors. Convert the uncertain cash inflow into certain cash inflow by multiplying with the certainty equivalent factor and discount the certain cash flow at the risk free rate. Why we have to take only risk free rate? Why? Because already you mitigated risk by taking CE factors. Okay, right. So now basing on this, we will solve the problem. Here you have to solve the problem is, see, in this problem we were going to use a certainty equivalent factor, right? The Textile Manufacturing Company Limited is considering one of two mutually exclusive proposals, Project M and N, which requires the cash outflow of 8,50,000, 8,25,000 respectively. The certainty equivalent approach is used incorporating risk in capital budgeting decision. The current yield on government bond is 6%. In this, in this it is used to risk-free rate, 6%, which is used risk-free rate. The expected net cash inflow of the certainty equivalent factor. CE factors are given here. For project M, two projects are there. We have to evaluate. For investment is project M is how much it is 8,50,000. For N it is 8,25,000. Risk free rate is given 6%. We have to use the discounting rate as 6%. Reason is very simple because you are already mitigating risk with the CE factors. So how do you evaluate the project? If you have to find it out NPV basing on what is that CE factors, what you have to do first of all is already here the cash flows are what is that uncertain cash inflows are there. By multiplying the CE factors, uncertain cash inflow with the CE factor, you will get the certain cash inflow. When certain cash inflows are you got it by taking discounting rate is 10%. If you compute NPV, the NPV what you are going to get it is NPV basing on certain cash inflows. NPV basing on certain cash inflows. Are you getting my point? Right. Similar to project M also you have to do like that. So let us solve this problem. First of all, statement showing net present value of project N. Here, what you have done? We took the years. We took the year. Then we took the cash flows. Cash flows are multiplied with the CE factors. When cash flow CE factors is multiplied, we will get the adjusted cash flow, or you can say certain cash. Certain cash. It means that you see 4,50,000 uncertain cash inflow, you are going to get it, but certainly you are going to get it 3,60,000. So, and if you bring into present, it would be 0.943, 0.890, 0.840. Now, if you bring into the total into present, it would be 10 lakh 10 lakh, sorry, here if you multiply 3 lakh 90,000 into 0.843, 3 lakh 39,490, 3 lakh 50,000 into 0.890, 3 lakh 11,500, 2 lakh 50,000 into 0.840, 2 lakh 10,000. If you sum it up total PV cash inflow, you will get it 8 lakh 10,940, 980 minus 8 lakh 50,000. You will get the 10,980. This is the way to find it out, evaluate the project basing on certain cash inflows. Okay, coming to project N also, what we have done just now, we took the year. Here the cash flows, CE factors. If you multiply both, you will get the adjusted cash flows or certain cash inflows. By taking this PV factor, if you multiply, you will get the PV cash inflows. NPV, what is the formula? PV of cash inflow minus PV of cash outflow. If you deduct this initial investment, you will get it to 1,71,350. So between these two, if you observe it, first project gives 10,980, second project gives 1,71,350. But both projects are really workable. Why? Because you are not taken the cash flows, you are taken certain cash inflows. At certain cash inflows, both the project gives NPV positive means both the project should be accepted. But since which mutually exclusive means which project gives you highest NPV, that project should be accepted. Are you getting my point, ma? Right. So this is the point to be considered, right? Right, sir. Why should we use? Why can't we use risk-adjusted discounting rate? Reason is very simple. Already you mitigated risk by taking CE factors. Then what is the need to go with what risk-adjusted discounting rate again? Because if you take risk-adjusted discounting rate again, it gives double impact. It's not a fair enough. Okay. Then with this risk certainty equivalent approach also finished. Then we move to another approach is called sensitivity analysis. Sensitivity analysis also one of the analysis where we can mitigate the risk element of the project. But here what we do is we will find it out. We will find it out. First of all, NPV we will calculate and we will identify that which factor is so sensitive in this NPV, and if that concern factor undergoes change or undertakes change or make changes in future, then what would be the impact on NPV? We will find it out. And which factor makes NPV so sensible, or which on which factor NPV is you depend on more. In such a case, what we do is we will hedge that change or we will protect that change. With effect, one can restrict the risk of the project or one can hedge the risk of the project. So sensitivity analysis, dear students, sensitivity. Let me tell you, even in touch me not leaf is there. Once you touch it, right, once you touch it, right, automatically it gives a lot of efforts. So sensitivity analysis is one of the analysis where we calculate NPV by taking all the factors, and we will identify that which factor estimated NPV is so sensitive. By protecting, by hedging, by controlling that factor, one can adjust the risk element of the project. Why? Because at the time of calculation of NPV, the factors what you are going to there, okay, you consider this one, but it is not confirmed. It is not guaranteed that in future the same factor is going to be exist. Sometimes they may undertake change. In such a case, what to do? Because of inflation, because of environmental factor, because of scarcity, because of political instability, because of competition, because of government policy, because of internal problem of the company, also it takes place. When all these factors takes in such a case, what we have to do? So here we will, in sensitivity analysis, we will identify that. Once we will calculate NPV. While calculating NPV, we will take sales units, fixed cost, variable cost, okay, fixed cost, variable cost, number of years, financing cost, interest rate, and the investment. Let us take a tax and depreciation because which is tax is not in our control. But by chance, if tax is also there, means we have to consider. But these factors, sales units, variable cost, fixed cost, number of years, rate, and investment. Okay, all these factors directly, indirectly determines NPV. But at the time of evaluation of NPV, these factors are very good, comfortable, are certain. But in future, they may not be certain. In such a case, you have to identify that how much of change in the given factor can makes your NPV 0. You have to identify. Or else, if the given factor undertakes given percentage of change, then how much percentage of estimated NPV is going to be changed? I repeat again. In sensitivity analysis, if the how much of percentage of change in given variable which can makes NPV 0. Why? Because if NPV positive, we can take the project. But when NPV 0 means we will raise your hands. That's why we must be very, very cautious. So what would be the impact on this? That is the important thing. Thereafter, what we have to do is, if the given factor changes, how much percentage of NPV gets changed. So small percentage of change in given factor, which makes huge change in NPV, we must keep it an eye on that, and we have to protect it. Or else, we believe that each factor may influence NPV. In order to make NPV 0, how much percentage the concern factor has to change. So by analyzing that also, we can protect. Okay, this is the NPV. In this calculation of NPV, first you consider the factors. Number 2, calculate NPV, and observe what is the point of the problem is given, whether they are identifying that given factors is going to be changed, or else the given factor change in each factor which makes NPV what to be estimated. You have to find it. Okay. Hi dear students. So yesterday we discussed sensitivity analysis. Right. We identified it is one of the analysis where we can hedge the risk of the project. Sensitivity analysis, once again I recoup what it happens. What is this? How we are going to hedge the risk? See, NPV is a wonderful topic, a wonderful evaluation method, right? If you want to evaluate a project, NPV is always best. But the thing is, one of the important point is the factors what you use to compute NPV never be a constant. It may undertake change, it may go change, or it may get fluctuations. In such a case, we will find it out what would be the impact on NPV if the given variable may changes, or how much of change in given variable which makes NPV 0. So for this purpose, we will make sensitivity analysis. For that purpose, step number 1, we will calculate NPV. Then basing on the given input or given the expectations of the problem, we will calculate it. Right. Let's move into the problem. Here, this is the problem I have taken from our material. X Limited is considering installation of new machine with the following details. Initial investment 1400 crores, annual unit sales 100 crores, selling price per unit 40, variable cost is 20, annual fixed cost 500 crores, depreciation is 200 crores, discount rate is 12%, tax rate is 30%. Okay. The considered life of the project is how many years? Of considered as a 4 years with no salvage value. Okay. Now in this problem they asked compute the NPV. Okay. First part they asked NPV. Okay. NPV, how do you calculate? NPV is nothing but the PV of cash inflow minus PV of cash outflow. So investment already given, 1400. Now what is your job is? Your job is to find it out the cash inflow. How do you find it out the cash inflow? Annual sales, unit sales are given. So selling price minus variable cost, you will get the contribution, right? Sales into contribution, sales units into contribution per unit. If you multiply, you will get the total contribution. From the total contribution, if you deduct a fixed cost, you will get the PBDT less depreciation, PBT less tax, PAT, add back to depreciation, you will get CFAT with the support of present value factor. If you bring into present, then it would be present PV of a cash inflow, you will get it. From the PV of cash inflow, if you deduct the cash outflow, you will get the NPV. Okay, that is a point. Now, this is for how many years actually given? 4 years, right? You are calculating cash inflow for 1 year. You are calculating cash inflow for 1 year. So remaining year, it will take place in a same way. Let us calculate first of all NPV. In this problem, unit sold, how many? 85. Selling price per unit is 29. Variable cost is 12. Annual, this is the second part they are given, right? And second part, before coming to second part, first we will do it the first part, right? Selling price per unit 40. Variable cost is 20. 20 minus this contribution, just now I told you, contribution is how much? Contribution is 20, number of units sold 100. So units sold into contribution, you will get the total contribution. From the total contribution, if you deduct fixed cost, you will get the PBDT. less depreciation, you will get the PBT, less tax you will pay, you will get the PAT, and add back to depreciation, you will get the CFAT. Actually, in this problem, they could not add it as CFAT, you have to add back it. Okay. Then, if such a cash inflow you got it with the support of what is that? PV of cash inflow, PV of cash outflow, right? You have to add back this depreciation. Depreciation is 200. If you add back means it would be 1010. You will get it. 1010. 0012. 11 actually. So 910 plus 200, right? 1110. Zeros what? Okay. This is the actually CFAD, but a little bit numerical mistake. They have taken this. No problem. Just modify this one. Now, what does that means? Once you calculate the cash inflow, you're supposed to get it this cash inflow over the period of how many years? 4 years. Every year cash inflow remains same. In such a case, to bring into present, will you use present value factor or annuity factor? No doubt at all, you have to use present value annuity factor, because every year the cash inflow remains same. In order to bring into present value annuity factor, you took the 3.038 because 12% 4 years. 12% 4 years, it would be 3.038. If you multiply 910 into 3.038 and 1400. Next, 1400 into 1, 1400, 1 to 4, 910 into 3.038, that is a 2764. Now you calculate NPV. NPV equal to PV of cash inflow minus PV of cash outflow. Cash inflow 2764 minus 1400 equal to 1364.58. This is nothing but NPV. Okay. Now this is the NPV given. Now what is the part B they given? What is a part B? Compute impact of project NPV. Compute impact of project NPV. If change in variable is as under, compute each variable having maximum impact of NPV. Now, dear students, in the problem they have given the various factors. Unit sold 85. Previously, how much it is? Unit sold. Annual unit sales 100. Now the unit sales came to 85. Selling price, previously it would be selling price 40, now it become 39. Variable cost, previously 20, it will become 22. Annual fixed cost, previously it was 500, now it is 575. If the things happens like this, okay, things happens like this, then what would be the impact on NPV? That is the part they are asking. Compute the impact of the project NPV if change in variable is as under, and the compute each variable is having maximum impact on NPV. That's you have to find it out. Okay. For this purpose, what we will take, whatever the data they have given, basing on that, we are going to find it out. So selling price, see, one sales price will become, sales unit become 85. We are taken, this is 85. Selling price per unit 39. Variable cost is 22. Annual fixed cost 575. Okay. If this is the situation, selling price per unit we have taken here, selling price, variable cost, contribution, number of units sold. Well, dear students, the previous class we discussed what is a sensitivity analysis. Well, once again, the sensitivity analysis is one of the important analysis, where in this method we believe NPV is sophisticated technique where we evaluate first of all NPV by considering several factors, and we will identify that each and every factor may have a chance to change, may have chance to take a change in coming future. In such a situations, what would be the NPV, where we have to find it out. In this sensitivity analysis, we will identify, so into which factor NPV is so sensitive. It means that if any factor changes the given percentage, right? How much of percentage of given factor which makes NPV 0, that we are going to find it out. Another aspect also we will calculate that. So what would be the percentage? What would be the percentage in NPV if the given percentage changes in a given range? For example, each factor changes by 10%. This is our prediction. So what would be happens in coming future? Coming future with respect to NPV. If each factor changes, then what would be the change in NPV? We are going to find it out. Or else sometimes what percentage of given factor has to undertake change so that it has to make NPV 0. So let us take, that is a sensitivity analysis. It includes two parts. Step number 1, we have to calculate NPV. Second, step number 2, we have to evaluate sensitivity of NPV. Let us take the problem number 4. X Limited is considering installing of new machine with the following details. Okay. Initial investment 1400 crores, unit sales 100 crores, selling price 40, variable cost is 20. So 20 minus 20, it is nothing but 20 would be the contribution. Annual fixed cost 500, depreciation 200, discounting rate is 12%, tax rate is 30. Okay. So consider life of the project is 4 years. Now, what the question is given here, compute NPV of the problem, NPV of the project, that is a basic identity. Compute the impact of NPV if the given change variable is under means unit sold would be 50, selling price 39, variable cost 22, annual fixed cost 575, in which variable have maximum impact on NPV. So it means that that factor makes your NPV 0. That is the reason you must be very, very cautious with respect to concern factor. That's you are going to find it out, right? Okay, PV factors is given. What we have to do, first of all? First of all, there once again understand the problem. What is the NPV? And if the given factor changes, how much percentage is not there? Because of the factors, now it is this value, variable cost this much, fixed cost is this much, constant rate of interest is this much, like that he has given different types of value. If the values would be like this, then what would be the impact on NPV? That's we have to compute. Let us take first step. We is to compute the NPV. In order to calculate NPV, what is the formula? PV of NPV equal to, what is the formula? Tell me. NPV equal to, so NPV equal to PV of cash inflow minus PV of cash outflow. Do you agree? NPV equal to PV of cash inflow minus PV of cash outflow. Basing on that, you have to identify by keeping NPV formula in mind. You have to calculate first PV of cash inflow minus cash outflow. You will get the NPV. Let us take here the factor value given like this, right? So selling price per unit 40, variable cost is 20, contribution A minus B, you will get the contribution, number of units sold 100, so total contribution 20 into 100, 2000. Next fixed cost 500, depreciation, if you deduct, you will get the profit before tax less tax. If you deduct it, you will get the PAT. Add back to depreciation, you will get the CFAT. So dear students, here PAT plus depreciation would be CFAT. Actually, this is a PAT, you have to add back. So 910 plus 200. So that is nothing but 1110 would be the CFAT. By mistake, we have taken here 910. Don't consider this one. You know the procedure, right? Thereafter, this is the every year annual cash inflow. Once annual cash inflow finished, you have to bring into present. So every beginning used to make 1400. Thereafter, this is a 1010. So if you calculate the NPV, 1400 into 1400, here 111110 1 into 3.038, that equal to, the answer would be 3372.18 minus 1400. That would be, the NPV would be 1972.18. So this is the NPV, because NPV formula PV of cash inflow minus PV of cash outflow. Basing on this, we calculated NPV. Okay, there the matter ends. Next, what would be the estimation of sensitivity of each of the factors, right? Here base case NPV no need, already we calculated base case NPV. But if the selling price goes for how much? 85, and the unit selling price is 39, variable cost is 22, annual fixed cost 575. In such a case, what would be the NPV? Right now, we have taken various factors like this. Selling price 85 is there, right? This is the base case NPV what we calculated. Selling price per unit, selling price, variable cost, contribution, okay. Number of units sold, if you multiply with it, you will get the total contribution. Next, annual fixed cost and profit before tax, depreciation, PBT, tax, PAT, add back to depreciation, you will get the 1900 they have given. So depreciation they should not consider it, here considered, and there it ignores. That's a 900. PAT is 700, 1700, and here it is 700, 200. So net cash inflow is, if you bring into present value annuity factor, so 2734.2, whereas initial cash outflow 1400. So you got the NPV. Now try to understand. Previously NPV would be, already we calculate 1972. 1972 minus 1334, that is a 638. So NPV changes, decreases by 32.35 percentage, right? Next, selling price per unit is 39. Here 85 is the number of units sold, right? 85 is the number of units sold here. But now selling price is 39. In such a case, selling price minus variable cost, contribution, number of units, total contribution, fixed cost, PBDT, depreciation, PBT, less tax, PAT, add back to depreciation, cash inflow, PV factors, PV of cash inflow, initial cash outflow, NPV, it would be 1176. So now if you compare with this one, right? So it is just down by 2201 ton. It means that 10.75 percentage. Whereas variable cost 22. Variable cost, here it is the matter, right? Here it is changes. So selling price, variable cost, contribution, number of units, total contribution, fixed cost, PBDT, depreciation, okay, PBT, tax, PAT, add back to depreciation, and PV factor. If you consider the total cash inflow 1957, and if you calculate NPV, then NPV would be 475. So comparing to this one, it is a down by 21.56 percentage. Whereas by chance fixed cost is 575. So selling price, variable cost, contribution, number of units, multiply total contribution. Here it is the fixed cost. Fixed cost. From this, profit before tax, less depreciation, net before tax PBT, less tax at 30%. Now you will estimate cash inflow, PV factor, initial cash outflow 1400. NPV would be 1813. So finally NPV changes is 179. It is nothing but 8.26 percentage. Like that, what we have done, if the given factor changes in the given way, right? If the value would be like this, in such a case, what would be the NPV? We computed. So after computation this, we came to know that most important element is nothing but this one. Which one? That is a unit sold, because that can makes NPV so sensitive. That is, the NPV is this one. So unit sold is the NPV is so sensitive to unit sold. Now, being a financial manager, if you take 100% care with respect to unit sold, you can hedge the risk of the project. So this is sensitivity analysis. Once again, sensitivity analysis is a wonderful analysis where we estimate NPV. There we will draw the conclusions that how much of impact on NPV if the given factor changes in the given way, or how much percentage the given factor should change in order to make NPV 0. Right. Next concept is scenario analysis. Scenario analysis. The scenario analysis is just a little bit an impact, a little bit similar to sensitivity analysis. In sensitivity analysis, we will measure the impact of one factor where which can makes NPV so drastic, so worthful. Okay, but in scenario analysis, we will think that what happens if everything goes in a as per the will and wish of the investor. So scenario means an outcome of the consequences. For example, if you think like this, sir, selling price may decrease, variable cost may increase, fixed cost may increase, tax may increase, sales unit may decrease, investment may increase. In such a situation, what will happen? We used to, if you pick it up with the one factor, that is called sensitivity analysis. Scenario analysis, if you think, okay, let us take, everything works against you. So say investment increases, fixed cost increases, variable cost increases, sales unit decreases, number of years decreases, rate of interest increases. Okay, even if everything, if you think that every factor moves against your will and wish, that is a worst case scenario. What is that? Worst case scenario. If everything goes positive, where investment not going to increase, decrease. Rate of interest decrease, variable cost decrease, fixed cost decrease, sales price increases, sales unit increases. When if you think best, that is called best case NPV or best case. Whereas if you take a moderate, that is nothing but modern. So there are three scenarios. Okay, one is worst case, best case, and base case. You can say moderate. So these are the scenarios. In worst case scenario, we will compute the NPV. Everything thinks that what worst itself. In best case, we will believe that everything is going to happen very positive way. So that is the scenario. What is the difference between sensitivity analysis, scenario analysis? So both will consider the NPV, but whereas in sensitivity analysis, we will take only NPV. Sensitivity analysis, we will take in by only one factor which makes NPV sensible. In scenario analysis, we will take what is that? All the factors, right? That is a analysis. Let us move. We will check in order to make you the better. I will take a problem. SG Limited considering project Z with the initial outlay of 7,50,000 and life is 5 years. The estimate the project are as follows. Sales units 4,500, 5,000. 5,500. In worst case, what happened? How much you can get it? 4,500. Best case 5,500. Base case 500. Selling price 175, 200, 225. Worst case, base case, best case. Variable cost. This is the worst case because cost increases, right? Whereas 100, 125. If this is the best case, this is the base case. Fixed cost 50,000, 75,000, 1 lakh. Worst case 1 lakh. Best case 50,000. Base case 75,000, right? Depreciation included in fixed cost 35,000 and corporate tax rate is 25%. Assuming this cost of capital is 15%. Find out the annual cash inflow each of the scenario and determine NPV in each scenario. That is nothing but worst case scenario, best case scenario, base case scenario. Okay. First of all, we are going to understand what is a worst case. In worst case, everything against companies will and wish. So high cost and low price, volume sales units also taken. Right. In worst case, let us take sales units 4,500, base case 500, best case for 5,500. Selling price 75, worst case, base case 500, 225. Less variable cost 150, 175, 125, 100. Contribution from selling price minus variable cost if you deduct contribution. Less fixed cost, worst 1 lakh, 75 base case, 50,000. Less P, you will get the fixed cost. If you deduct it, you will get the PBDT. Okay. PBDT, you can deduct the depreciation or find it out the PBT. You can, no problem, you can make it a contribution, fixed cost. Then PBDT, less depreciation, add back to depreciation. You will get the CFAT. So CFAT here, 44,375, 2,60,000, 5,13,125. Best cash flows. Now what you have to do, you have to find it out NPV. Initial cash outflow 7,50,000, 7,50,000, 7,50,000. Cash inflow 4,44,375, 2,60,000 and 5,13,125 in best case. Now if you make it the cumulative PV factor 3.353, 3.353, 3.53. If you multiply, you will get the PV of cash inflow 1,48,789.3, 8,71,780, 17,20,508.3. NPV is negative here, NPV positive, NPV positive. So it means that what is your observation is, in worst case scenario, if everything moves against you, you are not going to get it the best NPV, you are going to get it 6,01,210.63. Whereas base case NPV, it would be 1,21,280. In best case, 9,70,508.13. So this is the way to find it out, best case and worst case and base case NPV, dear students. Okay, so with this, we completed risk analysis in investment decision, right? Thank you.
Very good morning to each and everyone, my dear children. Welcome back to the next session with regards to the topic ratio analysis. In the previous session, we have completed with overall return ratios. Let's continue with the next session. So, overall return ratios or the ratios from balance sheet to TPL account or TPL to balance sheet. So now let us start learning the ratios with respect to balance sheet to balance sheet. Coming to balance sheet, you're having two kinds of ratios. One is like short term, another is like long term. First, let's concentrate on short term solvency ratios. So the ratios are short term solvency ratios, or these are also called as liquidity ratios. So there are three liquidity ratios where you need to understand. But before that, would like to tell you the list of current assets and current liabilities. What is the list of current assets we are having? Like cash, bank, or of course cash equivalents, debtors, or bills receivable, stock, prepaid expense. Hardly, I guess, these might be the uh, current assets we are having in a business concern. Coming to current liabilities, we have bank overdraft, creditors, bills payable, outstanding expenses. Yes. Let's come to current assets, ranking of their liquidity. Of course, number one rank is with cash, bank, and cash equivalents. Next, number two is with debtors and bills receivable. Then stock debtors is more liquid because they are having specific time frame where you can sell it out. But coming to stock, you're not having specific time frame when you're going to sell and whether you're going to sell or not. So when compared to stock, debtors is a bit more liquid. So three is for stock. And prepaid expense, it's not at all a liquid item. Reason being, you might have already paid the expense and now you're not going to get any amount from prepaid expense, but you're going to get just service. And hence, prepaid expense is not considered at all. But if you need, you can give rank number 4 for that. And coming to current liabilities, whether bank overdraft, creditors, bills payable, outstanding expense, for all the things, it is rank number 1. Reason being, bank overdraft has to be paid within specified period as agreed. Creditors has to be specified, to be paid in specified period. Bills payable has to be paid in specified period. Outstanding expense also you can drag it on, right? Hardly 1 month expense you can keep it as outstanding, but apart from that you can't keep that, right? So at the end of the day, even outstanding expense also needs to be paid in a specific period. So whatever all the current liabilities you are having, this must be paid in specific period, and hence it is considered as a single rank, that is rank number 1. Rank number 1. So moving on to the next thing, you just understand with respect to the rankings. Let us find the ratios. Ratio number 1, current ratio. Ratio number 2, liquid ratio, or it is also called as quick ratio, or even it is also called as acid test ratio. And ratio number 3, where you are ratio number 3, absolute liquid ratio or absolute quick ratio or cash ratio. Coming to current ratio, which is nothing but current assets by current liabilities. Liquid ratio, in the sense, out of current assets you need to consider only the most liquid items. So from total current assets, if you deduct stock and if you deduct prepaid expense, you're going to get liquid assets divided by current liabilities or liquid liabilities. All the current liabilities are absolutely liquid. Of course, there are certain others, or there are certain other boards where they are telling that bank overdraft might not be a quick or liquid liability. Reason being, there are two kinds of bank overdrafts: renewal bank overdraft and temporary bank overdraft. That is not at all required here. So as far as our subject is concerned, all the liabilities are liquid liabilities itself. And absolute liquid ratio or absolute quick ratio or cash ratio is nothing but cash plus bank plus cash equivalents divided by current liabilities. What are the ideal ratios, sir? 1:1, and ideal ratio is 1 is to, I'm sorry, uh, ideal ratio is 2:1. For liquid ratio, it is 1:1. For absolute liquid ratio, it is 1:2. What is the meaning of this, sir? To pay current liabilities of 1 rupee, it's always best to hold 2 rupees. To pay 1 rupee of current liability, it's always better to hold 1 rupee as current assets after deducting stock and prepaid expense. To pay 2 rupees of current liability, it's always better to hold 1 rupee in the form of cash, and the remaining 1 rupee you're going to get either from debtors or bills receivable or from sale of stock, something like that. So these are what your liquid ratios. Current ratio, liquid ratio, absolute liquid ratio. Of course, since we are just going with the fast track revision like marathon classes, we are not going into the deep details like why the ratio is 2:1, why it is 1:1, and why it is 1:2. But on an overall basis, just remember current ratio, liquid ratio, cash ratio. Current assets by current liabilities, current assets by current assets minus stock minus prepaid expense divided by current liabilities, cash and cash equivalents divided by current liabilities, and the ratios comes to 2:1, 1:1, 1:2. That's it. This is what all about your short-term solvency or liquidity ratios. So let's go through the next set of ratios, that is long-term solvency ratios. These are also called as capital structure ratios. So long-term solvency ratios or capital structure ratios. What will we learn here? So just check it out, my dear children. First of all, long-term solvency ratios, in the sense you're having non-current assets and you're having equity share capital, preference share capital, reserves and surplus, and altogether miscellaneous assets. Altogether, I would like to call this as equity, because I told you this can be called as equity or shareholders funds or intrinsic value or net assets or net worth or owned funds or proprietary funds. So altogether, I would like to call this as equity. And of course, the next thing is all about debt. Hope you have remembered even this one. Debt includes only non-current liabilities. Total debt includes both current and non-current. So as far as ourselves is concerned, debt includes only non-current liabilities. Let us confine only to this area. That is, I mean to tell equity and debt. Let's not go for total debt. I mean, current liabilities is not considered here. Now, so first of all, let's consider equity and debt proper mix, because long-term solvency ratios or capital structure ratios, you'll be concentrating on capital structure and how your capital is pulled and employed for. So equity and debt. So remember, my dear children, debt plus equity is equals to capital employed. Debt equity ratio, debt plus equity is nothing but capital employed. I'm telling you, remember, my dear children, if your equity is 1 part, your debt can be a maximum of 2 part. It can't be more than that. And hence your capital employed is like 3 parts. I mean to tell, if your total capital employed is 3 parts, out of which owned funds might be 1 and borrowed funds might be 2. It can't be more than that. If borrowed fund is more than 2 parts of the total capital employed, then the risk will be increasing a lot and lot, wherein you have to satisfy the outsiders. And after satisfying the outsiders, you have to satisfy the equity holders. The risk will be increased, because also, my dear children, what is it called? Too much of anything is good for nothing. So if even though you're having over debt where you can do an excellent business, there might be some sort of deviation where the business cannot be done properly due to overcapitalization or overfunding. If you need 100 rupees, it is best to hold 200 or 150. More than that is absolutely not needed. If you are holding, it will be leading to some it will mislead your spending process. And hence, if one is your equity, ideal part of having debt is two parts. So now from this we can frame three ratios, my dear children. Debt to equity ratio, debt by equity, which is like 2 by 1 or 2 is to 1, and debt to capital employed, which is nothing but debt by capital employed, that is 2 by 3. And finally, equity to capital employed ratio, equity by capital employed, which is like 1 by 3. So these are ideal ratios, these are three ratios, and this is the computation. Debt equity ratio, debt to capital employed ratio, equity to total capital employed. So debt by equity, debt by capital employed, equity by capital employed. Let me go with next set of ratios. You're having equity, you're also having debt, and of course whatever the equity and debt you're having, you'll be employing the same in total assets. So your next part is all about equity to total assets ratio, which is nothing but equity by total assets, debt to total assets ratio, which is nothing but debt by total assets. Remember, one very important thing is that in total assets, you're getting current assets, you're getting non-current assets, also you're getting non-operating assets. But here under liabilities, we are just going only through the long-term portions. So it is something that if your total assets are this much, how much funding is made through equity and how much funding is made through debt? We are learning that thing in these ratios. Equity to total assets, equity by total assets, and debt to total assets, debt by total assets. We are not concentrating on the whole liabilities to whole assets or something like that. Our intention is all about if you're having this much of total assets, how much is the funding of equity and how much is the funding of debt. There's no ideal ratio for this because it is up to each and every business concern. And one thing that could be appreciated is all about this equity to total assets is also called as proprietary ratio. Proprietary ratio, which is in another terms, proprietary fund by total assets or owned funds by total assets. That is nothing but equity by total assets. So equity to total assets is also called as proprietary ratio. Take care. And moving on to the next thing. Yes, last and final two things. Fixed assets to capital employed ratio. I mean to tell you having fixed assets and you having capital employed. So how to compute this, sir? Non-current assets or fixed assets divided by capital employed. Of your total capital employed, how much is the funding that you have been gone through for fixed assets? That is what the ratio. And the ideal ratio is less than 1. Even not less than or equal to 1, remember, it is just less than 1. Non-current assets or fixed assets divided by capital employed. If you are having 100 capital employed, it is always better to hold, better to invest less than 100 in your fixed assets. Otherwise, what happens in the sense, if you employ your total capital in fixed assets, then your current assets will be funding only through current liabilities. You may not have at least 1 rupee extra cash. Again, it may become a riskier part. So it's always better to hold less than 1. Less than 1 is the ideal ratio, fixed assets to capital employed ratio. Of course, in examination, you will not use this ratio to a greater extent. And also another ratio, capital gearing ratio. Of course, you may not be using this ratio in a very greater extent, even in examination. And what is capital gearing ratio? See, debt equity ratio is nothing but debt by equity. Remember, my dear children, this capital structure ratios or long-term solvency ratios are also called as leverage ratios. Leverage is a kind of taking advantage, and too much advantage is obviously risk. So leverage is a kind of taking advantage. Too much advantage is a kind of risk. So what is advantageous part in a business concern? Not just equity, it is debt. But too much of debt is again a kind of riskier thing. And so whatever this debt equity ratio is there, this is also called as leverage ratio. Of course, these are all called as leverage ratios, of which this is absolutely called as leverage ratio. The name of Leverage ratio in another style is nothing but debt equity ratio, debt by equity. Capital gearing ratio is also called as absolute leverage ratio. What is this one, sir? So to tell you, capital gearing ratio is nothing but fixed by variable funds. For your kind information, if you have taken debt by equity, debt divided by equity shareholders funds plus preference share capital, I can write it like that, right? But this is fixed, this is fixed, this is the only variable part. So if you want to increase the advantage or get the leverage benefit to the shareholders, always there's no need to invest just in debentures. You can also go for a kind of preference share capital. Of course, whatever fund you raise, it is having its own advantages and disadvantages. That is a secondary part. But if you want to get the leverage benefits, not only debt but also you can go for preference share capital. And hence, my dear children, capital gearing ratio is nothing but debt plus preference share capital, which are fixed funds, divided by equity shareholders funds, which is nothing but a kind of variable funds. So this is what all about your capital gearing ratios. So all these are nothing but your long-term solvency ratios. Check out debt to equity ratio, debt to capital employed, equity to capital employed. These are the three ratios. And after that, equity to total assets, debt to total assets, of which equity to total assets is called as proprietary ratio, where you're going to use the same in the examination to a varied extent. And even this debt is to equity ratio is also used in the examination. And also remember, you can use total debt ratios. Total debt is nothing but debt, long-term debt plus current debt. You just keep that in your brain, because you may get debt to total debt ratio, total debt to debt ratio, total debt to equity ratio also. The rest that you can do, if you know the concept, you can do it. And capital gearing ratio, which is also called as absolute leverage ratio, fixed funds by variable funds. Last but not least, of course, a kind of least, reason being it is not tested in the examination, fixed assets to capital employed ratio, which is like less than 1 is the ideal ratio. These are what your long-term solvency ratios. Now, moving on to the next set of ratios. So we have completed TPL ratios to balance sheet, TPL to balance sheet items, balance sheet to balance sheet items. Wherein TPL to balance sheet, we have completed overall return ratios. And balance sheet to balance sheet, we have completed liquidity ratios and capital structure ratios. I mean to tell, short-term solvency ratios and long-term solvency ratios. And moving on to the next thing, let's go with the ratios that is relating to P&L to P&L or TPL to TPL. Trading P&L accounted to trading P&L account ratios. So, of which first we are going to start learning the profitability ratios. Profitability ratios is nothing but expressing everything in the form of sales. Expressing every ratio in the form of sales is nothing but profitability ratios. I mean to tell, say if your sales is 100, how much is your COGS percentage? How much is your GP percentage? How much is your operating expenses percentage? How much is your operating profit percentage? Like this, expressing everything in sales is nothing but profitability ratios. Then if everything is expressed in the form of sales, then why these are called as profitability ratios, sir? Because the main highlighted things in profitability ratios is gross profit ratio, operating profit ratio, net profit ratios. I mean to tell, we'll be greatly concentrating on the profit elements as expressed on sales. If you are able to express the profit elements on sales, then you can also express the contrary to that. I mean to tell, cost on sales. So that is the reason we are going to learn the two things under profitability ratios. So let's go with the first one, gross profit ratio. Whenever you are able to express gross profit, then you are also able to express COGS ratio. So GP ratio is nothing but GP by sales into 100. COGS ratio is nothing but COGS by sales into 100. Remember, my dear children, overall return ratios, where the first ratios we have learned, something like return on equity shareholders funds. EAES divided by equity shareholders funds multiplied by 100. In the sense, overall return ratios are expressed in percentages. Again, profitability ratios are expressed in percentage, whereas short-term solvency and long-term solvency ratios are expressed in times. 2 times, 3 times, 6 is to 5 times, something like that. Anyways, let's come back. After GPR and COGS ratio, operating profit ratio, which is nothing but operating profit divided by sales into 100. And moving on to the next thing, operating expense ratio. Operating expense divided by sales into 100. Next is all about operating cost ratio, which is operating cost divided by sales into 100. Biggest doubt that we might get here is all about what is the difference between operating expense and operating cost, sir? Remember, sales, cost of goods sold, gross profit, operating expenses, operating profit. Always remember, my dear children, cost is a broader term when compared to expense. So if you're concentrating on operating expense, this is just that one. But operating cost, in the sense, whatever cost you have incurred in the business concerns for due course of activities, that is all called as operating cost. I mean to tell, cost of goods sold plus operating expense is equal to operating cost. The rest no need to explain, because you know GP, you know COGS, you know operating profit, you know operating expense, you know operating cost now. Because we have completed the first part of ratio analysis, where we have done with the statement of P&L account that is drafted for the purpose of ratio analysis or for FM. Sales minus COGS, which is nothing. COGS is nothing but opening stock plus purchases plus direct expenses minus closing stock. And the rest, like minus operating expense is equal to operating profit. And new term here is all about operating cost, which is nothing but COGS plus operating expense is nothing but operating cost. Anyways, let me move on to the next thing. And next is all about net profit ratio, which is nothing but net profit by sales into 100. But my dear children, if you have got the format of P&L account where we have learned for the purpose of FM, we did not use the term net profit at all. Yes, we did not use the term net profit. Then what net profit here is all about? Remember, net profit is all about, generally, even in accounts also, net profit is nothing but profit from P&L account, which is after creating provision for tax. So here also it is nothing but after tax. I mean to tell, net profit is nothing but EAT, earnings after tax. So here net profit ratio, you have to take it as a part, something like EAT, earnings after tax. That is what your net profit ratio. Net profit is nothing but EAT. And let me move on to the next thing, finance cost ratio, which is nothing but finance cost is nothing but interest. So interest or finance cost divided by sales into 100. That is what your finance cost ratio. So these are what all your profitability ratios: GPR, COGS ratio, operating profit ratio, operating expense ratio, operating cost ratio, which is a new term. Operating cost includes both the cost of goods sold and operating expenses, and net profit ratio and finance cost ratio. Let me move on to the next set of ratios. Those are coverage ratios. Under coverage ratios, one more thing I would like to tell. I'm sorry. Coming to profitability ratios, what are ideal ratios? It's very simple. For all the profits that we have counted here, how much ever higher, that much ever ideal is. Whereas coming to cost, how much ever lower, that much is the ideal. So for cost related elements, the lower is the ideal. For the profit related elements, the higher is the ideal. And moving on to the next thing, coverage ratios. Listen, we are going to learn here coverage ratios in the sense, number one, interest or finance cost coverage ratio, preference dividend coverage ratio, equity dividend coverage ratio. Of course, there is another thing, that is debt service coverage ratio, which is not at all tested in the examination. Then what do you mean by this finance coverage ratios? First of all, listen, coverage ratios are nothing but if you need to pay something, how much profit you are earning, how many times that expense is covered from your profit. If you want profit of 10, of which if you are paying 1 rupee, then the coverage ratio is nothing but 1 by 10. I mean to pay 1 rupee, 10 times is your profit. To pay 1 rupee cost, 10 is your profit. That is what your coverage ratio. I mean to tell all about coverage ratio in the sense how many times the expense is covered with respect to the profit. So finance cost coverage ratio is nothing but, remember, you will be paying finance cost or interest from EBIT. I mean to tell EBIT minus interest. So finance cost coverage ratio is nothing but interest or finance cost divided by EBIT. And remember, coverage ratios are expressed in times. Overall return ratio percentage, short-term solvency times, long-term solvency times, profitability percentage. Now coverage ratio, again these are expressed in times. So interest or finance cost divided by EBIT, because you will be paying interest from EBIT. Say for example, you have got 10,000 is the interest, and EBIT you have earned is like 10 lakhs. So it's all about 10,000 divided by 10 lakhs, something like 0.01, which is nothing but 0.01 by 1. So to pay 0.01 cost, you have earned 1 rupee profit. That is covered times. Okay. And coming to preference dividend coverage ratio. See, you're paying preference dividend from EBT because, I'm sorry, EAT. Yes. EBT minus EBIT minus interest, EBT minus tax, EAT. From EAT, you're going to pay preference dividend. So it's all about preference dividend divided by EAT. So you'll be paying preference dividend out of EAT. So how many times of EAT you have earned in order to pay 1 rupee of preference dividend? Or in another terms, in order to pay, I mean, if you have earned 1 rupee EAT, how much preference dividend you are paying? Say if your preference dividend is 14 lakhs into 10%, which comes to 1,40,000, and you have earned 20 lakhs for that. So 1,40,000 divided by 20 lakhs, which is 0.07. So you earn 20 lakhs and you're paying 1,40,000, and it is something like 0.07, which is nothing but by 1. So to pay 0.07 of preference dividend, you're earning 1 rupee, or out of 1 rupee, you're paying 0.07 as your preference dividend. That is what your preference dividend coverage ratio. And coming to equity dividend coverage ratio, equity dividend you are going to pay from is earnings available to equity shareholders. I mean to tell EAT minus preference dividend, EAS minus equity dividend. So equity dividend coverage ratio is nothing but equity dividend divided by EAS. To pay this much of equity dividend, how much EAS you have earned? Or if you are earning this much EAS, how much equity dividend you have paid? That is what your equity dividend coverage ratios. And I would like to tell even debt service coverage ratio also. Debt service coverage ratio is nothing but if you're taking debt or loan from any particular business concern, you have to pay interest and principal. You have to pay interest and principal. Okay. And moving on to the next thing. To pay this interest and principal, how much cash profit you have earned? How much cash profit you have earned? This is what your debt service coverage ratio. But before conclude this one, my dear children, don't think that I'm telling reversal ratios to you. I'll tell you one thing. Remember, coverage ratios, I told you that these can be expressed in times. But there are situations where these can be expressed even in percentage also. So to tell you, listen, first one, finance cost coverage ratio. Original ratio which is given in our all materials is all about EBIT divided by interest. And next, preference dividend coverage ratio. Preference dividend divided, EAT divided by preference dividend. equity dividend coverage ratio is divided by equity dividend. So if you have got something like EBIT 10 lakhs and interest is 1 lakh, 10 lakhs divided by 1 lakh, which is nothing but 10. What is the meaning of this 10, sir? Meaning of 10 is nothing but 10 by 1. To pay interest of 1 rupee, you are earning 10 rupees EBIT. This is what the times is all about. But I have told you in a reversal way, right? Don't judge immediately. Now understand carefully. Interest by EBIT, of course, multiplied by 100. I mean to tell 1 lakh divided by 10 lakhs into 100, which is nothing but 10 percentage. In another word, 10 by 100. So if you're earning 100 rupees of EBIT, you're paying 10 rupees as your interest. So whatever here I have told 0.07 times, better to convert it into percentage, 10%. 0.07 times, which is nothing but 7%, 1%, something like that. So please take care. Don't judge immediately. Please try to understand that coverage ratios can be expressed in two types. One is times, another is percentage. But coming to our materials, it is expressed in times. But one time he has tested even in percentage also, that is like ratios, even with coverage. So be careful. If they have asked in percentage, it is better to consider in interest by EBIT, preference dividend by EAT, and equity dividend by EASE. But if coverage ratio is given in times, EBIT by interest, EAT by preference dividend, EASE by equity dividend. Take care. And finally, debt service coverage ratio. As I told you, something like interest plus principal, which is nothing but installment, divided by cash profit. Because you have to pay installment out of cash profits, not just your profit from P&L account, which that is accrual profit. Of course, multiplied by 100 is nothing but percentage. But since it is being concentrated on times, it is something like cash profit divided by interest plus principal. So again, coming to cash profit here, you have to start it from EBIT because you will be paying interest only before interest and tax. So EBIT minus, take care, tax here. For overall return ratio, EBIT minus tax rate, because their entire EBIT is treated as your profit. But here your EBIT is not treated as profit. You would like to find cash profit. So EBIT minus tax is to be considered. Of course, we have to eliminate all the non-cash items. Add non-cash expense minus non-cash income divided by interest plus principal. This is what your debt service coverage ratio. Final tagline, my dear children. Please take a note. Coming to coverage ratios. If you want me to express as per our materials, it is obviously profits divided by cost. I mean to tell, if it is finance cost coverage ratio, EBIT divided by finance cost. If it is preference dividend coverage ratio, EAT divided by preference dividend. If it is equity dividend coverage ratio, is divided by equity dividend. I would not like to concentrate on debt service coverage ratio because it is not tested. Now, all these three elements are expressed in times. But once or twice, or I mean like just one time, even he has asked coverage ratios in percentage. At that time, finance cost by EBIT into 100, preference dividend by EAT into 100, equity dividend by EASE into 100. So take care. Coverage ratios might be expressed either in times. Coverage ratios might be expressed either in percentage. One time he just concentrated on percentage, but this is obviously on a rare case or an advanced concept. But this is what the regularized concept. And finally, we have to cover turnover ratios. And tomorrow we are going to cover turnover ratios. All the best. Thank you. Very good morning to each and everyone, my dear children. Let's go with the last and final set of ratios, turnover ratios. What are turnover ratios and why these ratios? And of course, let's learn the set of ratios. First of all, my dear children, know the meaning of turnover. It's a wrong perception that turnover means sales. But remember, turnover is not sales. Turnover is an item which turns a particular element, that is called as turnover. A business is turned over because of sales, and hence for a business concern, turnover is always sales. But if you have taken creditors, for creditors is an element which will be turned out from purchases. So for creditors, turnover is nothing but purchases. Like that, you have to check out. Remember, my dear children, for turnover ratios, ideal ratios, how much ever the higher, that is the ideal. The higher the turnover ratio, the ideal the ratio is. Now, moving on to the set of turnover ratios, let us start. First one, raw material turnover ratio. Before that, remember, for each and every turnover ratio, numerator is turnover. For every profitability ratio, denominator is sales. For every turnover ratios, numerator is turnover. But turnover is different from each and every ratio. So raw material turnover ratio. Raw material for, what is the turnover for raw material? Is nothing but cost of raw materials consumed. The cost of raw materials consumed divided by average stock of raw materials. Of course, you all people know what is average stock of raw material, which is nothing but opening raw material plus purchase of raw material plus direct expense relating to that acquisition of raw material minus closing raw material. This is what cost of raw materials consumed. Cost of raw materials consumed. Average stock of raw material is very simple, like opening raw material plus closing raw material by 2. Now, so what is the significance of this ratio? Remember, a particular business concern is able to manufacture 10 lakhs by maintaining an average stock of 1 lakh. Then what is the turnover ratio? 10 lakhs divided by 1 lakh, which is nothing but 10. Now, if you take another business concern, even it is also manufacturing 10 lakhs with an average stock of just 10,000, where the turnover ratio comes to 100. So it's all something that maintaining higher level of stock is good or lower level of stock is good. It's obviously lower level of stock, because if you maintain higher level of stock, you will be incurring insurance expenses, you'll be incurring storage cost, holding cost, storekeepers price, etc. and etc. So always maintaining lower levels of stock with higher production is the best option. And the same way here also, if you maintain lower levels of stock and if you're maintaining higher production, automatically your ratio will become higher. So that is what your cost of raw materials consumed divided by average stock. And immediately after raw material turnover ratio, we are supposed to learn raw material holding period. See, raw material holding period is nothing but 1 by raw material turnover ratio multiplied by, if you want to tell it in days, 365 days or 366 or 360, whichever is given in the question. If you want to tell it in months, 12 months. This is what your raw material holding period is all about. And 1 by raw material turnover. In our first example, we got 10, right? So 1 by 10 into 365 days. 36.5 in case 1 is the raw material holding period. So if you're purchasing raw material, it is in your business concern for 36.5 days, which is good. If you've taken 100, it will become 3.65 days, which is more good, which is better. Obviously best. Reason being, you purchase the raw material and just your holding period is 3.65 days. After 3.65 days, immediately you are starting the production. You're issuing the raw material for the process of production, which is a very good thing, which is the best thing actually. So in other words, 1 by raw material turnover ratio is nothing but reversal of this. I mean to tell, average stock divided by cost of raw materials consumed multiplied by 365 days or 12 months. That is what your raw material holding period. And like that, let me go with the other ratios, like after raw material work in progress turnover ratio and work in progress holding period. Work in progress turnover ratio. What is turnover for work in progress? Which is nothing but cost of production. Cost of production is nothing but cost of raw materials consumed plus direct labor plus overheads. I mean to tell all the factory cost. Whole divided by average work in progress, which will be your raw material turnover ratio. Remember, turnover ratios are expressed in times. Holding period is expressed in days or months period. Work in progress holding period, of course, reverse. Average work in progress by cost of production multiplied by 365 days or 12 months. Now moving on to the next set of ratios. Debtors turnover ratio and debtors collection period. Here we won't call debtors as a holding period. We'll call it as a debtors collection period. So debtors turnover ratio is nothing but sales, credit sales divided by average debtors. Debtors collection period, average debtors by credit sales multiplied by 365 days or 12 months. Now moving on to the next thing, creditors turnover ratio and creditors payment period. So credit purchases divided by average creditors, and the payment period is nothing but reverse. That is average creditors divided by credit purchases multiplied by 365 days or 12 months. And yeah, these are the main parts. And other turnover ratios, fixed assets turnover ratios. For all the remaining, turnover is nothing but sales. For raw material consumed. For work in progress, cost of production. For debtors, credit sales. For purchase of creditors, credit purchases. But for all the remaining turnover, sales. Here total sales now, not credit sales. For debtors, credit sales. But for all the other turnover ratios, it is nothing but yes, sales. Total sales will be considered. Fixed assets turnover ratio. Fixed assets. Sorry, sales divided by fixed assets. Current assets turnover ratio, sales divided by current assets. Total assets turnover ratio, sales divided by total assets. Working capital turnover ratio, sales divided by working capital. A small modification, average fixed assets, average current assets, average total assets, average working capital. Average is nothing but opening plus closing by 2. And one more important thing that we have missed, finished goods turnover ratio and finished goods holding period. COGS divided by average fixed assets, or this is also called as inventory turnover ratio. And the holding period is nothing but average inventory or finished goods by COGS multiplied by 365 days or 12 months. That is what finished goods holding period is all about. So now at the end, some rules. Point number 1. If you need to find COGS, then go for COGS. If COGS is not available in the question, go for sales. If you need sales, go for sales. If sales is not available in the question, go for COGS. So wherever you have to use COGS, you have to use COGS. That is like here. But it is not available in the question, sir. You can use sales. Wherever you are supposed to use sales, use sales. So, but that is not available in the question, sir. Then use COGS. It's always better to consider average elements in turnover ratio. But if average elements is not available, go for closing element. Average creditor, average debtor, average finished good, average raw material, average work in progress, average fixed assets, average total assets, average working capital. If average data is not there, then you can consider closing. Till that point of time, you have to consider average itself. So now let me go with the overall elements of ratios. I'll just close the topic just within the next 5 to 10 minutes. Let me go with overall ratios at one stretch itself. Overall return ratios. Return on equity shareholders funds, return on equity or return on shareholders funds, return on capital employed before tax, after tax, return on capital employed in business before tax, after tax. computations is divided by equity shareholders funds into 100 expressed in percentages. It divided by shareholders funds or equity into 100. Return on capital employed EBIT before tax by capital employed into 100. After tax EBIT minus tax rate by capital employed into 100. Return on capital employed in business after tax before tax operating profit by capital employed in business into 100. After tax operating profit minus tax rate by capital employed in business into 100. That's it. So these are the ratios from balance sheet to TPL account or TPL to balance sheet. Now we are going to see short-term solvency ratios or liquidity ratios expressed in times, and these are from balance sheet to balance sheet. On a whole, you are having three ratios like current ratio, liquid ratio or quick ratio or acid test ratio, absolute liquid ratio or absolute quick ratio or cash ratio, current assets by current liabilities, current assets minus stock minus prepaid expense divided by current liabilities, cash plus bank plus cash equivalents divided by current liabilities. Ideal ratios 2:1, 1:1, 1:2. No ideal ratios for overall return. How much ever the higher, it is ideal. And moving on to the part 3, that is long-term solvency ratios or capital structure ratios or leverage ratios. In this, debt to equity, debt to capital employed, equity to capital employed, equity to total assets, or this is also called as proprietary ratio, debt to total assets. Next, capital gearing ratio, and last but not least, fixed assets to capital employed. Debt to equity, debt by equity, debt to capital employed, debt by capital employed, equity to capital employed, equity by capital employed, equity to total assets or proprietary ratio, equity or proprietary funds divided by total assets, debt to total assets ratio, debt divided by total assets, capital gearing ratio, fixed by variable funds, debt plus preference share capital by equity shareholders funds, finally fixed assets by capital employed, fixed assets by capital employed. And what are the ideal ratios? Ideal ratios, debt is to equity 2:1, debt by capital employed 2:3, equity by capital employed 1:3. No ideal ratios for proprietary ratio and debt to total assets ratio. No ideal ratio for capital gearing. Fixed assets to capital employed less than 1 is the ideal ratio. Of this is called as leverage ratio, and of this capital gearing ratio is called as absolute leverage ratio. This is what part 3. Part 4, profitability ratios. These are expressed in percentages, and this is from TPL to TPL. Ratios: gross profit ratio, COGS ratio, operating profit ratio, operating expense ratio, operating cost ratio, net profit ratio, finance cost ratio. So findings: GP by sales into 100, COGS by sales into 100, operating profit by sales into 100, operating expense by sales into 100, operating cost by sales into 100, net profit by sales into 100, finance cost by sales into 100. GP, sales minus COGS. COGS, opening stock plus purchases minus closing stock, of course, plus direct expenses if any. Operating profit, sales minus COGS minus operating expense, add operating income. Operating expense, which are in daily activities of the business concern. Operating cost, operating expense plus COGS is operating cost. Take care. COGS plus operating expense. Net profit, here you need to consider it. Finance cost, you all people know, interest. So for profits, the higher is the ideal. For costs, the lower is the ideal. And next, coverage ratios. Coming to coverage ratios, general rule expressed in times. These are also from TPL to TPL. You're having four coverage ratios: finance cost coverage ratio, preference dividend coverage ratio, equity dividend coverage ratio, debt service coverage ratio. And ratios: EBIT divided by finance cost, EAT divided by preference dividend, is divided by equity dividend, cash profit divided by interest plus principal. To the max extent, these are what the ratios. But if coverage ratios are given in percentages, then reversal of the ratios and multiplied by 100. Finance cost by EBIT, preference dividend by EAT, equity dividend by EAS, interest plus principal by cash profit. Into 100 will give you the ratios. But to the max extent, only times is being tested. So I would like to confine only to the times. With the discussion now we are going to have. So only one thing, everything is good. Cash profit, of course, not needed, but who knows? Our exams are CA examinations. So cash profits is nothing but EBIT minus tax, not tax rate, take care, minus tax plus non-cash expense minus non-cash income. That is what your coverage ratios. And last but not least, turnover ratios. Just now we have completed all the turnover ratios, which are expressed in turnover ratios are expressed in times, and period ratios are expressed in days. And of course, these are turnover ratios, which is nothing but TPL to PPL. Sometimes we'll be considering even balance sheet also. So let's go with turnover ratios. Raw material turnover ratio, raw material holding period, work in progress turnover ratio, work in progress holding period, finished goods turnover ratio, finished goods holding period, debtors turnover ratio, debtors collection period, creditors turnover ratio, creditors payment period, and all the others. Working capital turnover ratio, fixed assets turnover ratio, current assets turnover ratio, total assets turnover ratios. Of course, you can also tell capital employed turnover ratio. That's it. So let me go with the things. Raw material turnover ratio. Cost of raw materials consumed by average raw material. Average raw material by cost of raw materials consumed multiplied by 365 days or 12 months. Work in progress turnover ratio, COP, cost of production divided by average work in progress. Holding period, average work in progress by cost of production multiplied by 365 days or 12 months. Finished goods turnover ratio, or also called as inventory turnover ratio or stock turnover ratio, which is nothing but COGS divided by average inventory. Holding period, average inventory by COGS multiplied by 365 days or 12 months. Debtors turnover ratio, credit sales by average debtors. Holding period or collection period, average debtors by credit sales multiplied by 365 days or 12 months. Creditors turnover ratio, credit purchases by average creditors. Payment period, average creditors by credit purchases multiplied by 365 days or 12 months. Other things, working capital turnover ratio, sales divided by average working capital. fixed assets divided by average fixed assets. Sorry, fixed assets turnover ratio, sales divided by average fixed assets. Current assets turnover ratio, sales divided by average current assets. Total assets turnover ratio, sales divided by average total assets. Capital employed turnover ratio, sales divided by average capital employed. Some of the rules. The higher the ratio, the ideal that ratio is. If average data is not available, consider closing data. If you need sales, but sales is not there in the question, go for COGS. If you need COGS, but COGS is not there in the question, go for sales. So that is the end of your revision of ratio analysis, my dear children. All the best for your examinations. Very good morning to each and everyone, my dear children. So welcome to the next topic, that is all about ratio analysis. First of all, let's understand the term. What is the meaning of ratio analysis? Analyzing financial statements through ratios is nothing but ratio analysis. Likewise, I would like to tell you one thing, my dear children. All the time, you may not get accurate and absolute understanding with absolute terms. There may be times where you need to go ahead with relative terms a lot and lot, because you may need the comparison so that you will be understanding the financial statements in a better way. Say, for example, company A profit is rupees 1 lakh, company B profit is rupees 10,000. If you're having this kind of position, of course, everybody, you just ask anyone which company you'll choose. Of course, if I were in your position and if I've got this information, apart from this, if I did not get any other information, I'll be choosing company A for sure. Reason being, company A is having huge profits. I won't choose company B. But let's understand another reality by considering capital employed. Capital employed of company A, say for example, rupees 10 lakhs. Capital employed of company B is, say for example, rupees 10,000. Just observe this one now. Return on capital employed is 100%. Return on capital employed is just 10%. So by looking at this scenario, we can come to a conclusion that company B is having higher return generation rather than company A when considered on capital employed. So your decision is changed. So your decision might get affected with relative terms if you have compared, not just with the absolute terms all the time. Also, to compare two companies, either for inter comparison or intra comparison, you can't compare it on absolute terms basis. I mean to tell, industry is a group of firms. Industry is having its average. That industrial average will be expressed in percentages itself, but not in absolute terms. That's like industrial average profit is 10% and firm's profit is rupees 25 lakhs. So now you have to compare it with industry, then you have to compare whether is it like 10% or not, a minimum of 10% or not. Or say for example, another firm had earned just 25,000. You have to compare 25 lakhs to 25,000. That may not be fetching you a correct and proper understanding. So what is the correct fetching and correct understanding is all about just going with some relative terms, that is nothing but ratio. So now let me tell you, my dear children, ratio is a mathematical term which is expressed in A by B form. I mean to tell all about numerator and denominator. Remember, whichever term you're telling something like numerator by denominator, these two must be on a common comparison base. You can't put two different elements where the elements can't be compared at all. That is absolutely not permitted. So you have to consider only those elements. You have to consider only those elements, listen very carefully my dear children, which are having common comparison base. Before that common, I mean apart from that common comparison base, you cannot consider any other thing. So take care. Let us analyze. What includes in a financial statement, sir? Financial statements includes balance sheet, trading account and P&L account. So I would like to tell balance sheet and trading P&L account. I mean to tell all about position statement and period statement or income statement. So now we are having such a kind of ratios where we can relate balance sheet items to balance sheet items itself, balance sheet items to trading P&L account items, and trading P&L account items to trading P&L account items. So you'll be getting something like either you can understand with balance sheet to balance sheet ratios, balance sheet to TPL ratios, TPL to TPL ratios. So first let us concentrate on balance sheet to TPL ratios. I mean to tell all about overall return ratios. Overall return ratios. What are overall return ratios? You're having some investment, and how much is the return that you have got on that investment is nothing but overall return ratios. Anyways, let me go with the statement of P&L account for the purpose of ratio analysis or FM. I mean to tell you can't go with the schedule 3 accounts P&L account. This is purely relating to ratio analysis or FM. I mean to tell EBIT minus interest minus tax etc and etc. So check out sales minus COGS. I mean to tell cost of goods sold. And after that, you might have got gross profit. And from gross profit, you will be deducting operating expenses, add operating incomes. Then you're going to get operating profit. After that, you'll be considering non-operating income and non-operating expenses will be deducted. And finally, you're going to get EBIT, earnings before interest and tax, minus interest. Then you're going to get EBT, earnings before tax. And after that, minus tax, you're going to get EAT, EAT, minus preference dividend. Then you're going to get EAS. Understand this format of P&L account like sales, regular course of business, COGS, regular course of business, GP is like product profit, which is purely depending upon a product. And moving on to the next thing, operating items, which are purely relating to business. Non-operating items, which are belong to the business but not are related to business. I mean to tell, say for example, there are two buildings, building 1 and building 2. Building 1 is purely for the purpose of office and administration purpose. Whereas coming to building 2, it is not for office and administration purpose. It is for the purpose of investment like giving for rentals. Then this rental income, whatever is there, it will become a non-operating income. But from building 1, you will not get any income, but you are having depreciation on building 1, which will be considered as an operating expense. Also say, for example, my dear children, you have got repairs for building 1 and you have done repairs for building 2. Repairs for building 1, since it is for office purpose, it will be considered as an operating expense. Repairs for building 2, since it is for rentals investment purpose, it will be considered as a non-operating expense. So even non-operating items absolutely belongs to the business, but those are not related to business. Try to understand this carefully. So after that, you have got EBIT, earnings before interest and tax. And interest is a finance charge or finance cost which has to be shown separately, and hence interest is separated from EBIT. After that, EBT minus tax, EAT, preference dividend, and finally earnings available to equity shares. Now, this is what all about your FM related statement of P&L account. Let us start with FM related balance sheet. In balance sheet, you're having equity share capital, reserves and surplus, preference share capital, non-current liabilities or commonly called as debt and current liabilities. Remember, my dear children, if you come to accounts, whether current liabilities or non-current liabilities, it is commonly called as debt. But coming to FM, it is totally different. Debt includes only non-current liabilities. And for your kind information, there are two terms called total debt and debt. Debt includes only non-current liabilities or long-term liabilities, whereas total debt is having both non-current liabilities and current liabilities. So take care. as per the point of view, as per the viewpoint of FM, always debt includes only non-current points. And coming to assets, you're having fixed assets, current assets. Take care, I'm writing one specific item like non-operating items. I mean to tell non-operating assets or non-operating items are nothing but investments. Likewise, in our example, building 2, that will be considered here. So whatever we have got building 2, that will be considered. And moving on to the next thing, miscellaneous assets or fictitious assets. Assets, I mean items which are to be treated as assets, but really those are not assets. Those are called as fictitious or miscellaneous assets. I mean to tell heavy advertisement expenditures, P&L account loss. See, if you're having profit, it will be shown in reserves and surplus. If you're having loss, you can deduct it from reserves and surplus, or you can also show it at asset side. Under asset side, you have to show it under a specific head called miscellaneous or fictitious assets. Anyways, this is what your balance sheet. So now check out carefully. I would like to relate these terms, which is called as equity shareholders funds, which is nothing but equity share capital plus reserves and surplus minus miscellaneous assets. And if I have considered preference share capital also, it will become shareholders funds. Listen, my dear children, this is called as shareholders funds or net assets or net worth or intrinsic value or proprietary funds or even owned. The total terminology is different, but conclusion or the outcome is same. See, if you observe shareholders funds, shareholder in the sense both equity and preference will be there, and hence equity share capital plus reserves and surplus plus preference share capital minus miscellaneous assets is nothing but the total fund relating to shareholder, which is nothing but shareholder funds. And coming to net assets, see, net assets is nothing but assets minus outside liabilities. I mean to tell all assets minus all outside liabilities. In another word, assets minus outside liabilities is nothing but shareholders funds. I mean to tell shareholders funds minus miscellaneous assets. Of course, all together shareholders funds. And net worth, of course, net value, which is nothing but share capital plus reserves minus miscellaneous assets. Intrinsic value, the same. Proprietor, proprietor is nothing but owner. So proprietor fund or owned fund is nothing but owners of the company's fund. So owners of the company are nothing but shareholders, which is nothing but shareholders. And moving on to the next thing, if you have considered this one, so equity share capital plus reserves and surplus plus preference share capital plus debt minus miscellaneous assets, which is called as capital employed. Remember, my dear children, capital employed in accounts is different and capital employed in FM is different. Capital employed in accounts will be considering only owned capital employed. But coming to FM, even borrowed capital is also considered as capital itself, long-term capital. So capital employed in the sense equity share capital plus preference share capital plus reserves and surplus minus miscellaneous assets plus debt or non-current is also considered, which is nothing but capital employed. Listen, now I would like to add all these things and would like to deduct these two. Not only miscellaneous, but I would also like to deduct non-operating items. Capital employed in business. Say, for example, capital employed, equity shareholders funds. I mean to tell equity share capital plus preference share capital plus debt plus reserves and surplus minus miscellaneous assets. You got some 1 lakh. Out of this 1 lakh, you have invested in some non-operating items like investment in a company to the extent of 20,000. So out of 1 lakh available to you, 20,000 is used for the purpose of other business, and only 1 lakh is the amount that is being used by my particular business concern. So this 20,000, whatever this 20,000 is there, it is a non-operating item, and hence if you have deducted this one, you're going to get 80,000, which is literally nothing but capital employed in business. So capital employed in business is nothing but whatever the capital employed minus non-operating items. So at the end, it is something like this: capital employed in business, current liabilities, current assets, and non-current assets or fixed assets. Capital employed in business is nothing but equity share capital plus preference share capital plus debt, I mean to tell non-current liabilities, plus reserves and surplus minus miscellaneous assets. How? If you have deducted these two things, current assets minus current liabilities, you're going to get working capital, which is nothing but amount available for day-to-day business use. So at the end, capital employed in business is nothing but non-current assets plus working capital. This is what you have to understand. So check out, we have completed P&L account that is related to FM and balance sheet that is related to FM. Now I'm going to put some elements here. You just match those elements, and the elements are nothing but shareholders funds, equity shareholders funds. I mean to tell, this is including preference share capital, capital employed, which includes non-current liabilities like debentures also, and finally capital employed in business includes only operating items. Now let me come to P&L account related items, where I would like to consider the things like, first I've got GP, gross profit, product profit. Then I've got operating profit. After that I have got EBIT. After that EBT, earnings before tax, earnings after tax, earnings available to equity shareholders. Now I would like to give some description even for this. Equity shareholders funds, in the sense only equity shareholders. So earnings available to equity shareholders belong only to equity shareholders. Earnings after tax. Earnings after tax is nothing but including preference dividend, because earnings after tax minus preference dividend is nothing but equity, earnings available to equity shares. So earnings after tax includes preference dividend. Earnings before tax is nothing but before tax. EBIT, earnings before interest and tax, includes interest. Operating profit, only operating items. So now, if you want me to match the things out here, I will be matching it something like, for equity shareholders funds, it is purely belonging to equity, earnings available to equity shares. So EAES, I will be matching the same. And shareholders funds includes preference share capital, and hence I will be matching with preference dividend. And I'll be considering capital employed with EBIT, and I'll be considering capital employed in business with operating profit. These are the four things that I would like to match. I mean to tell, now let me give you the ratios of 1, 2, 3, 4. Return on capital employed. Return on capital employed is equal to operating profit divided by capital employed into 100. Return on capital employed in business is equal to operating profit divided by capital employed in business into 100. Return on capital employed is equal to EBIT divided by capital employed into 100. Shareholders funds, return on shareholders funds is nothing but EAT divided by shareholders funds into 100. Return on equity shareholders funds is nothing but EAES divided by equity shareholders funds into 100. Again, out of these four things, these two are absolutely after tax, but these two are absolutely before tax. So if you want me to tell, return on equity shareholders funds, EA is divided by equity shareholders funds into 100. Return on shareholders funds, earnings after tax divided by shareholders funds into 100. Return on capital employed before tax is equal to operating profit before tax divided by capital employed into 100. After tax is equal to operating profit minus tax rate divided by capital employed into 100. Return on capital employed in business before tax is equal to EBIT divided by capital employed in business into 100. After tax is equal to EBIT minus tax rate divided by capital employed in business into 100. Take care, one important thing that you need to understand: operating profit after tax and EBIT after tax is not operating profit minus tax amount. That is wrong. Operating profit minus tax rate is to be considered. I mean to tell all about whatever the operating profit you are having, that operating profit is before tax, And now if you're considering your capital is capital employed in business, then the total return on capital employed in business is nothing but operating profit. So after tax is nothing but minus tax rate. In the same way, EBIT is also applicable. So whatever the ratios we have learned, return on capital employed in business before tax, after tax, return on capital employed before tax, after tax, return on shareholders funds, and return on equity shareholders funds. All these four elements or six elements where we have learned, these are called as overall return ratios. And these overall return ratios are expressed in percentages. And these are the ratios from trading P&L account to balance sheet or balance sheet to TPL account. So take care. This is what your overall return ratios. Let's continue with the ratios, further ratios in the next session. Thank you.
The next chapter is called working capital management. Working capital management. What is the working capital? This is a very, very important chapters. In this examination point of view, the three areas are very, very important. I'm going to cover the three areas. Number one, what is the working capital? It is the minimum capital required to run the business. So it is the what is the working capital? So it is the amount of capital required for smooth running of business. Smooth running of business, or it is used for day to day smooth running of business transaction. Day to day business transactions. It is used for day to day business transaction should run in a smooth manner. Or you say it is the difference between current assets minus current liability. It is also net working capital. So what is the working capital? Working capital is amount of capital required for the smooth running of business operation. It is used for day-to-day business transaction. It is the amount allocated by the company to make investment on current assets, because fixed assets alone cannot generate return. In order to extract a return from fixed assets, the company must investment on current assets also. Okay, so now the how to estimate the working capital. You have to understand how the corporate companies estimation of working capital. In order to estimate the working capital, I will advise you the following steps. You can follow this identity. See, working capital estimation has a different methods, right? But in public exam, we used to estimate basing on operating cycle period or inventory norms. So that's why first you should understand working capital estimation basing on operating cycle period, where you should understand the following terms. Number one, inventory norms. What are the various inventory norms? Inventory norms. So you take it the inventory norms. A, raw material holding period. B, work in progress holding period. C, finished goods holding period. D, debtors collection period. E, creditor payment period. F, any time lag. Okay, this is the inventory norms. Okay, thereafter you should understand cost structure. it is essential for one should estimate what is that cost structure. Inventory norms. Thereafter, understand cost structure. That is a raw material plus wages, manufacturing overheads. You will add and what is it? Selling distribution expenses. If you add it, you will get the cost of sales. Cost of sales. Generally add the profit. You get the sales. So this is the another important point. So inventory norms, cost structure, you have to keep it in mind. Next, we will take the statement, right? Statement showing working capital requirement of concerned company. Once this is finished, a statement showing working capital requirement. In order to estimate working capital, what you have to understand? Understand the format, particulars, amount. So what you can do is A, you have to take current assets. You have to take current assets. So what you will get it in current assets? A, stock of raw material you will get it. Stock of raw material. How do you get the stock of raw material? Raw material consumed during the year. So raw material consumed during the year divided by 12 months into raw material holding period. You can take into the consideration raw material, you will get it. Thereafter, what you have to do, work in progress holding period. Work in progress, work in progress. In order to calculate work in progress, you have to estimate on first stock of raw material. On stock of raw material, what you calculate? Raw material consumed during the year divided by 12 months into work in progress holding period into conversion cost. 100% you have to take into consideration. So this is stock of raw material. Thereafter, what you do is next wages. You can take the wages. Wages. For this, what do you do? Wages incurred during the year divided by 12 months into work in progress holding period into conversion cost. Generally, it would be 50%, it would be 100%. Okay, then you take the wages also. Next, overheads. If at all overheads are there, overheads incurred during the year divided by 12 months into work in progress holding period into conversion cost. Nothing is mentioned, take 50%. Now what you do is whatever the data you got it, stock of raw material, current stock of raw material, work in progress, stock wages, overheads, right? You understand, add this all these things, three things, A plus B plus C. You will get uh, current as a stock of raw material, work in progress. Thereafter, you will have what is that stock of finished goods. 3. Stock of finished goods. Stock of finished goods equal to cost of production divided by 12 months into finished goods holding period. You will get the stock of finished goods. Next, if at all debtors are there, either cost of sales or credit sales. Later may go with the credit sales. Credit sales divided by 12 months into creditor payment period. Right? If at all any advances the company made, advances, take it. Now total this all these things. Total current assets. So now try to understand these students. The procedure is very clear. The procedure is very clear to find it out the working capital of the concerned company. So current statement showing working capital, current assets, you estimated all these things, current assets, total current assets, you got it. Next, what you take it, B, take a current liability. Current liability, what do you say? Trade creditors. Trade creditors, what do you say? Credit purchases divided by 12 months into creditor payment period. Right. Thereafter, any wages, time lag. Wages, if you make a delay payment, that is also current liability. Next, overheads, if at all any time lag. Overheads, that is also current liability. Make it a sum it up of all. You will get the total current liability, that is B. Now, what you say here, you have A, here you have a B. From A minus B, what you will say, you will get what is that net working capital. Net working capital you used to get. Okay. After that, what happens? Net working capital. Current assets, current liabilities, net working capital. And if at all any margin is there, margin of safety. So finally, working capital. So this is the procedure to calculate the working capital. First of all, you should understand what is that inventory norms, because you are calculating working capital basing on what is that operating cycle. Working capital estimation basing on operating cycle. Working capital can be estimated a specific percentage on fixed asset. Working capital may be estimated a specific percentage on sales, but in the CA inter majority of books, majority problems are covered basing on operating cycle period, where operating cycle period includes raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, and time lags. So by considering all thereafter cost structure, thereafter statement showing working capital requirement, and this is the procedure: current assets, current liability, margin of safety, working capital. All these things comes under this category. So this is the procedure, dear students. Now, first model, we are going to solve the problem working capital. This is the problem, very, very important problem. This problem I extracted from new study material, old study material, even practice manual also is there. This problem is very important. If you are able to solve this problem from this model, any of the problem you can comfortably solve. Right. Aneja Limited is newly formed company. It applied for the commercial bank for the first time. Financing of working capital requirement. The following information available. The projections for the current asset. Estimated level of activities. How many units they are going to produce? 1,04,000 completed units. Production is 4,000 units. It means that what they're saying, they want to produce the complete production of 1,04,000 and work in progress 4,000. Okay. And the raw material price is 80, wages is 30, other exclusion of depreciation. If inclusion means, then it is okay. Exclusion means no need. Overheads 60,000, total cost 1,70,000, selling price is 200. Okay. Raw material average in stock means raw material holding period is 4 weeks. Work in progress units are given, so there is no need to expect a time, right? Work in progress, assume 50% completion stage in respect of conversion cost. Material issued at the start of the processing. Okay. The start of the process itself is the raw material is using, means take the raw material into 100%, and wages Other expenses other expenses related to work in progress, take it for 50%. Finished goods in stock 8,000. Credit allowed by supplier 4 weeks. Credit allowed to debtors 8 weeks. Lag in payment is 1.5 weeks. Cash at bank for the smooth is expected to be 25,000. Assume that production is carried on evenly throughout the year 52 weeks and wages and overheads accrue similarly. All sales are on credit basis only. You are required to calculate net working capital required. Okay, investment on debtors, you have to understand cash at bank is expected 25,000. Assuming that production is carried evenly throughout the year and wages over accrue similarly, all sales are on credit basis only. You are required to calculate net working capital requirement. Investment in debtors must be valued on total cost or cost of sales. Stock of finished goods must be valued at factory cost. This is the problem they have given. Right now, how do you calculate the working capital? So various holding periods are given. First of all, understand what are the various holding period is given. Raw material holding period 4 weeks. Work in progress holding period is not given. So you see, raw material holding period, how much they given? Raw material holding period, here given it is 4 weeks. For B, work in progress holding period, they have given units 4,000 units. Next, finished goods holding period, they have given units. In this units, you see, stock of finished goods 8,000. And what is that? Debtors collection period, they have given debtors collection period 8 weeks. Allowed to debtors. Creditor payment period 4 weeks. Time lag is 1.5 weeks. So debtors collection period is 8 weeks. Creditor payment period is 4 weeks. Time lag is 1.5 months, right? So this is the problem. Now let's take. I already given a format to you, right? Keep that format. Immediately it will make you pass at any cost. If you follow this class, right, I will assure you that you will clear, right? Just to try to understand the what is the procedure, what is the concept, listen carefully, and even by solving writing formula also I explained. Okay, once again, if you can't understand this video initially, listen again once again, you can, right? Coming to here, you have to solve this problem. First of all, holding period, we got it. Stock of raw material. Raw material consumed during the year divided by 12 months into raw material holding period. Okay, total raw material consumed for 1,04,000 units. Here, raw material consumed. They have taken raw material consumed, or you can say stock of raw material. Stock of raw material formula, raw material consumed divided by 12 months into 52 weeks into raw material. How do you get the raw material? Here you try to understand here. For finished goods 1,04,000 into 80, 83,20,000. For work in progress 4 lakhs into 80, 32 lakhs. In total 86,40,000. So raw material consumed 86,40,000 divided by 52 into 4 weeks, 6,64,615. 6,64,615. I am happy. Work in progress. Work in progress is just 4,000 units. That is the reason 4,000 units. Here you can understand the work in progress. Work in progress they have given. Work in progress. In work in progress, you have stock of raw material 4,000 units into 80. Next, B, wages 4,000 into here. Your 100% is there, raw material conversion 100%. Whereas direct wages incurred during the year 4 lakhs into 30 into conversion cost 50, 60,000. Overheads 4,000 into 60 into 50%, 1,20,000. Total 5 lakhs. So you got the 5 lakhs. Okay, matter ends. Next, stock of finished goods. You hold it for how many units? 6,000 units. For 6,000 units cost of production, if you multiply, you will get the cost of production or stock of finished goods. You can write like this: stock of finished goods here. Stock of finished goods. How do you compute this? 8,000 units. 8,000 units into 170. 1 lakh, 13 lakh 60,000, right? Directly you can show this value here, 13 lakh 60,000. Next, debtors. Debtors may be valued at cost of sales or cost of production. So here debtors, they valued on the basis of what is that? Cost of production. Okay, you may take it a credit sales also. Now for this purpose, cost of production, you have to find it out. Cost of production, opening stock of raw material plus purchases minus closing stock, you will get the raw material consumption. Next, direct wages, direct overhead, you will get the gross cost. Add opening stock of work in progress, closing stock of work in progress, you will get the cost of production. So that is the way you have to find it out, the cost of production. Here, raw material, direct wages, direct overheads, you got the total cost of production. Cost of production would be 1,81,000, 80,000, 1,81,000. For this 63,000 overheads, you will get the gross factory cost. Opening stock of 50,000, closing stock. Okay, and we need to find it out the datas, right? Datas. So for this datas, you need the cost of sales. How do you get it? I once again, opening stock of raw material plus purchases minus closing stock, you will get the raw material consumption during the year. For that, direct wages, direct overhead, you will add, you will find the gross work cost. Add opening stock of work in progress less closing stock of work in progress, you will get the cost of production. Add stock of opening cost of production, you got it, right? Then opening cost of production. Thereafter, you have to consider add opening stock of finished goods less closing stock of finished goods. You will get the cost of goods sold. Add selling expenses to it. You will get the cost of sales. So now we need to find it out the cost of sales. So whatever the way I explained, this is the cost of sales. Cost of sales, you got it 1,63,200. So 1,63,200 divided by 52 weeks into 8, 25,10,769. You got the cost of sales. Okay, cost of sales, you got it. Whereas cash balance directly given, if you submit up the total, it would be 50,60,394. Coming to liabilities, if you want to find it out liabilities, what you have to find it out? Trade creditors, you have to find it out. Okay, trade creditors. Trade creditors equal to credit purchases. Since Aneja Limited is a newly formed company, you have to take not only opening stock but also closing stock for the concerned year. Why? Because this year you have taken your how much of raw material you are consumed. You have to consider that one, and how much of raw material you are holding for the sake of next year also must be considered. So that would be the point, dear students. So creditors for raw material. Here you see creditors for raw material. Trade creditors, material consumed, you have taken, this is for final product, this is for work in progress, 86 lakh 40,000, and closing stock of raw material also you have to add 93 lakh 4,615. So 93 lakh 4,615 divided by 52 weeks into 4 weeks, 7 lakh 15,740. 7 lakh 15,740. Okay. Then creditors for wages. Wages, two things are there. Up to 1,04,000 units, you have to take the raw material 100%. For remaining, you have to take for 50%. So creditors for wages. Wages incurred during the year, you have to take 31 lakh 80,000, which includes 1 lakh 4,000 and 4,000. So 31 lakh 80,000 into 1.5 weeks divided by 52 weeks, 91,731. So 91,731. 91,731. If you sum it up, you got the total current liability 8,07,471. From the current assets, if you deduct the current liability, you will get net working capital. So 42,52,913. In this model problem, you have a doubt. The doubt is that why we have taken closing stock of raw material while estimating credit purchases. Dear students, you should not forget Aneja Limited is newly formed company. A newly formed company comes and takes manufacturing. It holds how much of raw material it consumes. You have to take into consideration. And the same this year, the company who entered into the field and it is holding a closing stock for the sake of next year in the year means that that raw material also you purchases, right? Otherwise, purchases, how do you get it? That is the point. You should keep it in mind. So with this, working capital estimation topic is finished. Thank you. Hello, good morning, dear students. Now we're going to take a advanced concept in investment decision. The fact is this, that I already covered all the concept in investment decision. Payback period, NPV, IRR, all these things. But in this problem, in this session, I'm going to analyze the few concepts where while taking investment decision, you have to consider some of the important concepts. The important concepts are this. What is that? While the fact important concept means, try to understand a company need a capital. When company need a capital, it raises funds from the various sources, right? It rises. After rising of these funds, what rises? After rising of these funds, it has to make investment. So that investment may be done at what assets? Fixed assets, and investment may be done at current assets. So systematically, investment on fixed asset is called capital budgeting or investment issue. Capital budgeting or investment issue. So the fact is, while evaluating investment decision, we learn different types of concepts. One is a payback period, NPV, IRR, where is a discounted payback period, okay, discounted payback period. All these techniques, IRR, NPV, IRR, profitability index also, profitability index we consider. But some of the cost, while evaluating certain concepts, we have to consider certain concept, the certain cost. By considering that cost, right, we have to evaluate what are the cost. I'm going to discuss that cost. Certain advanced concept you have to consider. Number one, sunk cost. Sunk cost, it indicates before commencement of the project, any cost you already incurred while evaluating investment decision, you should not consider it. So sunk cost must be ignored. Okay, keep it in mind. Another one is sunk cost, also called historical cost, and opportunity cost. This may be benefit. What is this opportunity cost? While evaluating an investment decision, because of your investment, you got an opportunity. Because of that opportunity, you are getting certain benefit. That benefit also you must be considered, that is a benefit of the project itself. That is called opportunity cost benefit. It should be considered. Then you have opportunity cost loss. Opportunity cost loss. Whenever you are evaluating a project, because of your investment in decision, you lost an opportunity. Because of that opportunity, the income what you supposed to get in future, you may not get because of investment decision. In such a case, in order to evaluate a project, you have to reduce or deduct this opportunity cost loss. This also must be considered. Thereafter, you have what is that? Opportunity sunk cost, opportunity cost. Yes. Thereafter, what is that? Financial cost. Financial cost, or you can say cost of capital. While evaluating a project, you raised funds from the various sources. So you have to discount this interest, this cost while evaluating a project. Otherwise, without deducting your financing cost, how do you evaluate a project? Even that project gives a benefit. Will it believe this is the real benefit to you? No. That's why financial cost or financing cost. Financing cost means the cost of capital interest to be paid. So that cost must be considered. Another one is common cost. Common cost. Common cost means what? If you are evaluating a project, right? Be evaluating a project. For that purpose, you have to incur certain cost. But if you undertake this project, there are certain costs remain constant. If you won't undertake a project, there are certain costs remain constant. When the project, either you make investment on the project, the cost which is remain constant, such a cost is called common cost. While evaluating a project, such a common cost should be ignored. You should not consider. Why? Because this cost is common. General administrative overhead comes under this category. So in this building, in top floor, I am going to construct a project, right? Down watchman is there. Watchman salary. If I construct that floor or that business in upstairs, right? Watchman salary will be there. If I don't construct, watchman salary will be there. In such a case, that watchman salary is considered to be the common cost. That common cost should be ignored. So sunk cost, already I told you, before commencement of the project, whatever the cost you incurred, that cost should be ignored because that cost is sunk cost, historical cost. Common cost should not be considered. This cost also you must be ignored. Right. Another one is a specific cost. Specific cost. Specific cost. For the sake of commencement of this project, you identified watchman salary, watchman salary is a common cost. But watchman for specifically for your project, this is called, what is that? Specific cost. So any cost you incurred only exclusively for that concerned project, such a project should be accepted. Such a project should be accepted. That is a specific cost. The cost which clearly incurred for the sake of only that project, such a cost to be considered while evaluating a project is called considered specific cost. Thereafter, non-cash cost, that is depreciation. Non-cash cost, while evaluating a project, certain cost should not be considered. While evaluating a project, certain cost should not be considered because it is a non-cash cost. Non-cash cost means particularly depreciation. So depreciation should not be considered, but depreciation treatment could be considered. Depreciation provides you tax advantage. So that would be the reason while estimating non-cash costs, when you are going to pay, when there is a tax, in order to reduce the tax burden, the company has to decrease, the company has to consider depreciation, and it has to reduce the tax, and it has to reduce the depreciation, and it has to reduce the taxable income, and basing on that it has to calculate the cash flows or whatever the profit. That is a non-cash cost. And thereafter, H, legal cost. That is nothing but tax. So legal cost, that is tax to be considered, dear students. So tax is the legal cost. Whenever you make a profit, it is your due responsibility to pay tax to the government. But in the problem, we can take an assumptions like this. Whenever company makes a profit, we will pay tax. When company won't make any profit, right? Any profit, sometimes it make loss, we will take an assumption also. The company able to get what? Tax or tax shield. Here the student should understand tax or under tax shield. When company makes a profit, you have to pay tax. When company makes a loss, you have to get tax shield. So these are the certain advanced concepts. While evaluating a project, you have to consider all these costs, and then you have to identify sunk cost, opportunity cost, benefit, opportunity cost, loss, financial cost. That is nothing but cost of capital, common cost, specific cost, non-cash cost, legal cost. All this cost by considering, you have to evaluate a project. Such a problem, let's solve one simple problem. This is an extension point for investment decision, dear students. Let us take. Here, there is a problem. A manufacturing company is presently paying a garbage dispose of common company 0.5 per kilograms to the dispose of waste resulting from its manufacturing operation. Let us take a company is the manufacturing company. It's presently paying garbage outside dispose. The company is 0.50 kilograms. Okay, 50. At normal operating capacity, the waste is about 2 lakhs kilograms per year. How many? 2 lakhs. After spending 1,20,000 on research, the company discovered that waste could be sold for 55 per kilogram. Try to understand. Currently, the company manufacturing, okay, manufacturing. Presently, the wastage or garbage is there, and 0.5 per kilogram dispose of waste resulting from its operation. Normal capacity it was 2 lakh rupee kilogram per year. So that means 50,000 into 2 lakhs. It is nothing but normal they used to make a cost. But after spending 1,20,000 research cost, after spending, not before commencement, you spend this cost. This is called a historical cost or sunk cost. A company discovered waste could be sold for 5 rupees. Additional processing would, however, require an investment of 12 lakh in new equipment, which would have an estimated life of 10 years. Life is 10 years. Additional processing, however, require investment. You can sell this waste for 5 rupees only if you are able to process the wastage. In order to process this wastage, you need a machine whose cost would be 12 lakh rupees. Right? This life is 10 years. And the depreciation to be calculated on straight line method. Depreciation. What is this? Non-cash cost. Straight line method, cost minus scrap divided by life. Whether depreciation to be taken or not taken is depends upon tax, right? No change in present selling administrative expenses is expected except for cost incurred in advertisement, because the waste you are processing and you are making a final product worth of 40,000 per year. If the new product is sold, additional processing cost would be include variable cost. Specifically, you are incurring variable cost 2.5 per kilogram waste put into the process along with fixed cost of 60,000 a year. Okay, then there will be no loss in processing, and it is assumed that the total waste processed in a given year will be sold in the same year. Estimates indicate that 2 lakhs kilograms of the product could be sold in each year. The management, when confronted with the choice of disposing of waste or processing it further and selling it, seeks your advice. Which alternative would be recommended, assuming that the firm's cost of capital is 15%, paying average 50% of tax rate? You see, tax is there, so that's why you must identify depreciation. Now there will be no loss. Estimates that this machine can process 2 lakhs kilograms of product could be sold each year. So cost of capital is this. Now, while evaluating a project, advanced concept, what are the advanced concept we will discuss. Right here, this is 2 lakh 50,000. Generally, company loss getting loss of 2 lakh kilograms 50 paise. If the company invest on fixed asset, what happens? This cost is going to be saved, right? This cost is called opportunity cost benefit. This to be considered. So this is what cost? Opportunity cost. This is opportunity cost. We try to understand, dear students, opportunity cost. This to be considered. And at the same time, the research cost, what it incurred already before commencement of the project, this cost should not be considered because this cost is sunk cost. Okay, sunk cost. But whereas here the problem is specifically given and discovered that waste could be sold for 5 rupees, but here in order to make 40,000 rupees is the variable cost. Additional processing cost incurred, here it is 2.50 is the variable cost, advertisement is 40,000. These are specific cost. Project, for the sake of project we are incurring this cost to be considered. Whereas the fixed cost processing, fixed cost also to be considered. And what about the depreciation? Depreciation, even though problem is given, it is a SLM method, it should not be considered. But considered. Why? Because tax is there. For the sake of tax purpose, initially we will reduce this depreciation, then we pay the low tax. Once the tax payment is finished, again we will add back to problem. Add, but not a problem, add back to uh, PAT in order to find it out the CFAT. Right? Depreciation is a non-cash expenses. You try to understand its treatment. Thereafter, cost of capital, the project cost you raised it. 15% is financing cost, must be considered. 50% is legal cost, a tax rate must be considered. Okay, these are the concepts to be identified. These students, right? Now evaluation. What we say evaluation? Step number one, we will calculate what is the initial investment. 1,20,000. Okay. Then what is the saving disposing of waste? Here you said that outflow 2 lakh is there into 50. 50. That is a 1 lakh rupee. 1 lakh. Less on this tax advantages also is there, you know. That's you have to deduct. So net outflow would be, what is that? 50,000. Then now coming to PV of operating cash inflow, sales value 2 lakhs into 5 rupees used to sell in the market, right? And less variable cost processing 2 lakhs 2.50 50,000 fixed cost you deduct, advertisement cost you deduct. Then after deducting you will find what is that PBDT. From that PBDT you can deduct depreciation, you will find what PBT. From that PBT you can pay tax PAT, add back to depreciation CFAT. But here one more expenses also left out. Benefit you got it, right? Okay, add back to depreciation, annual cash inflow 2,60,000. So finally, annual cash inflow is nothing but 2,60,000 here plus 50,000 you saved this amount, right? This saved amount, net cash inflow also 50,000. But instead of saying two tables, you can also project in one table, but no problem. So institute material referred like this. That's the reason we have followed this technique. So 2,60,000, 7,50,000, total 3,10,000 rupees. Now initial investment would be 3,10,000. Initial investment 12 lakhs. Total annual net benefit would be 15 lakhs. How do you get it? 3,10,000 into 5.019. That is 15 lakhs 55,890. NPV would be 3,55,890. So this is the way you have to understand certain important concepts, particularly cost, sunk cost, historical cost, opportunity cost benefit, opportunity cost loss. Okay, all this cost you have to consider. So this is the procedure. Actually, this is not an exclusive chapter. This is just an extension for investment decision. One of the topic, one of the area very important. This is advanced concept, right? Thank you.